Before we start this video, do like and subscribe to our channel and not miss on any updates.
Hello friends, welcome to the AFM CA Final revision session. Today's revision session, I will be taking you through this chapter on foreign exchange. Now this is a very important chapter from CA Final exam perspective. So if you see the past 3 or 4 attempts, the kind of questions that are being asked in Forex, though not very difficult, but it is one of the definite questions in the exam. So it has a good amount of weightage in the exam, and every single attempt, there is at least one, if not 2 questions from this particular chapter. More so from practical questions perspective than theory questions. So this is a chapter a lot of students find it difficult, a lot of students are getting confused, a lot of students actually leave it in choice, but I believe this is one of the more simpler chapters as long as you understand the logic. So today my attempt in this entire revision session will be to help you understand the logics and solve problems. We will spend some amount of time understanding logics. I will not go too deep into logics because this is a revision session, this is not a full-fledged session. I will go through only basic concepts, and basic concepts we will try and understand quickly, faster, easy to remember manner. Okay, so we'll be understanding both concepts as well as solving problems. And problems also, I will not be solving some 30, 40 or 50 problems. We will solve about 12 or 13 problems, max to max 12, 13 problems. In that, I will try and give you 100% clarity on this particular chapter. And in this chapter, most of the students actually get confused in one concept, which is fate of forward contracts. We will leave it towards the end because rest of the chapter also has very important questions. And in fact, if you look at the last 4 or 5 attempts, questions from fate of forward contract has appeared only twice. Rest of the times you have had questions from other topics. Okay, within this chapter, other topics. So it is very important that you know other topics also, and most likely there is a chance that you'll actually get questions from those rather than fate of forward contracts. We'll anyway cover it towards the end. Now, before you start off, there are a few things I want to highlight to you. For your exam prep, whenever you're writing exams, it can be upcoming November or the May after that, or whichever one it is, please ensure when you're watching this video, you have access to these 3 things, right? Along with the revision video, you need to have these 2 books, rather to these 2 PDFs. If you have books, it is great. If you don't have books, it is fine. You can download the PDFs from our website. They are free of cost. You can download them. First one is something called as P600. This is the book that I am showing you, P600 plus. This is fully all the questions, of past exam. It's more like a, compiler come classroom discussion, everything in one place, where you will get access to all the past exam questions solved in a very easy, simple manner along with solutions. Please note, along with solutions. Then we have the second book, which is P380 plus. This book is all about your theory concepts, and it is also again a Q&A format, made easy for you to understand. So when we are going through this chapter or any other chapter, please keep these 2 books aside along with this CA Final formula sheet. This formula sheet also is uploaded on our website. Anybody can access it. If you purchase our books, you will get it free along with the books. Okay, please keep all of those aside because I may be looking at or solving only one kind of a problem in a variety, whereas there is multiple problems of the same variety in this book. Okay, so you can go through that at your own pace. Now, what are the concepts that we will first look at? Okay, these are the concepts that we will start with, because these are the basic concepts. With these concepts, we can directly jump into Q&A. Basically, you're looking at questions, basically past exam questions, and solving them. We can directly jump into it. There is no need to learn the entire chapter and go. These are the 5 concepts what I have here, which if you understand, you can directly get into problems. Okay, and there are some more concepts which I will teach you as we move along. This is not an exhaustive list. Exhaustive means everything together. This is not everything together. This is basic concepts that you need to know before we start off. Okay, now what are the various problem types? This also I want to give you a clear highlight about the varieties of problem types that are available. First one is, you have invested somewhere. What is the return for a domestic investor or a Forex investor or foreign currency investor? What is the gain or loss on a square off? What is a square off? When you buy and when you sell, what is the gain or loss? What is arbitrage transactions? That is, if you want to do an arbitrage, that is, you buy somewhere cheap, sell somewhere it is costly, what is the gain that you make? Is it possible? If possible, how much? Then what are the swap points? How do you find out the swap points? Then, you have these questions on interest rate parity, then you have this purchasing power parity and covered interest arbitrage. Then what should you do? Whether you should borrow in USD or borrow in IRR or borrow in some other currency. Money market hedge, then supplier financing or letters of credit. forward transactions, options, nostro vostro. Nostro vostro is a smaller element, so you need not worry about it, and fate of forward contracts, which is where a lot of students get confused. So we will be solving problems of all these 12 varieties. Most likely I will solve one problem. If something I am not able to explain in a problem, I will solve it in two problems. But it is more likely that you will be able to understand, remember and completely get knowledge of the entire Forex chapter with these 12 problems only. Okay, so that is the first part, and I presume that most of you have taken some kind of classes already, and you are attending this class purely for a revision perspective. Please note, this is not a full-fledged class. This is an exam-oriented crash revision session. Okay, please do not think that this is how I'll explain in class. In actual full-fledged class, I explain it in great depth. Go slowly, go easily, explain related concepts and all of that. Because we are focusing on exam preparation, we're not going to get into all of that. We'll directly jump into concepts. From the concepts, go to problems and then solve all these problems. Okay, fair enough. Now let's proceed. So friends, now let us understand these 5 concepts to start off with, and then we'll move into questions, and along with questions we'll learn more concepts. The first concept what we need to learn is direct versus indirect quote. What is a direct quote versus what is an indirect quote? So easiest way for any of you to remember is USD INR is equal to, let's say, 85 rupees. Okay, this rupees 85 per dollar. This is a direct quote. Whatever we hear about rupee is a direct quote. Now, as far as CA Institute is concerned, we need to remember a few things. The institute has unnecessarily complicated certain things, which is certain places they have used USD INR. This is the international notation, by the way. Some places they have used USD by INR. Some places they have used INR by USD. Some places they have used INR per USD. But everywhere they have given the same number 85. I recently came across one more also, USD hyphen INR. Okay, so they have used this particular multiple kinds of notations to determine or denominate what is a USD INR exchange rate. Please note, the important point what you have to understand is, if USD INR is 85 rupees, it is a direct quote. That is what you have to understand. Even though this is the international notation called USD INR, and our institute does variety of things, please note this is the direct quote. Now from here we will move forward. What is it that the things that we are required to learn? First thing that we are required to learn is, when you say USD INR direct quote, we mean this is foreign currency, this is domestic currency. Okay, and this foreign currency is known as base currency, and this domestic currency is known as quote or price currency. Okay. Now in our case, domestic currency is quote or price currency. Now USD INR can also be quoted ulta. That is, instead of quoting it as 85, we can quote it as 1 by 85, which is 1 divided by 85, which will be 0.117. So in that case, that will be an indirect quote, where you are quoting everything in terms of 1 unit of domestic currency, or 1 unit of this currency, 1 unit of domestic currency, which is INR. Right. Now, what is base currency? What is price or quote currency? That is, for $1, how many units of INR? So for $1, how many units of rupees are given? So this $1, right, when we are referring to USD INR 85, we are saying $1 is equal to rupees 85. When we are saying USD INR is 85, we are saying $1 is equal to 85 rupees. So in a direct quote, the base currency, you will quote everything for 1 unit of base currency, and you will quote it in terms of price currency or quote currency, which is, in our case, 85 rupees per dollar. Now, can this 85 be 75? It was 75 some years ago. Will it be 90? It will probably be 90 some years later. Okay. So this rate is direct quote. If you understand this, first hurdle you have crossed in this chapter. Okay. Irrespective of which way ICAI gives, USD INR, USD by INR, INR by USD, INR per USD, USD dash INR, all these things, if they give you the rate as 85, please believe me, this is the direct quote. You need not think, you need not bother about what ICAI does. Now, after having understood what is a direct quote, what is an indirect quote? Very simple, I already explained to you. Indirect quote. It is 0.01176 INR USD. This is for 1 rupee, how many dollars? It is $0.01176. How did I get 0.01176? It is simply 1 by 85. So when I did 1 by 85, I've got this number. Okay, so this is an indirect quote. So when you are quoting per 1 unit of domestic currency, number of units of foreign currency, that is an indirect quote. Okay, this is the second aspect that you should understand. Now, when you look at the foreign exchange market, do all currencies quote like this? That is, number of INR per USD, number of ZAR per USD, number of pound per USD, number of euro per USD. No, it doesn't work that way. There are few currencies which are not quoted like this. So, few currencies by default. So, Indian rupee is always quoted in this direct quote, which is number of units of rupees per dollar. But euro, then AUD, Australian dollar, then NZD, New Zealand dollar, then GBP. These currencies are always quoted indirect. What do you mean by indirect? For 1 unit of, let's say you are within Europe. So, for 1 unit of euro, how many dollars? So, when you look at a euro quote, Indian quote, direct quote is USD INR. But when you look at euro quotes are always euro USD, or for GBP it will be GBP USD. So, for 1 unit, how many USD are there? That is how they are always quoted in the foreign currency market. Now, as far as CA exam is concerned, they may give you euro per USD, GBP per USD, or USD per euro, USD per GBP. All such variants are possible. Please note, all such variants are possible. But how do you figure out? How do you figure out whether it is a direct quote, indirect quote? See, in India's case, it is very simple. We know that the rate is 85, right? For 85 rupees, make a dollar. But how will you remember, or how will you know how many euros make a dollar, how many CHF make a dollar, how many New Zealand dollars make a dollar, AUD makes a dollar, GBP make a dollar? We do not know. So, please remember this one very, very important element, which is, please remember this particular, currency rates what I have given. Don't need to remember the amount, okay? That amount I am just giving you as indicative. But please remember the order of stronger currency. What do you mean by stronger? Stronger means for 1 pound of GBP, if you need more dollars, then pound is stronger than dollar. But 1 pound of GBP, you require less than $1, then dollar is stronger than GBP. That is a simple logic. In our case, in today's case, these rates are subject to change. 1 GBP is equal to $1.28. So, think of it as 1 GBP is 1 iPhone. 1 iPhone is equivalent to 2 Samsung phones. So, what is costly? An iPhone is costly. 2 Samsung phones are cheaper, correct? So, 1 is equal to 2, meaning that 1 iPhone is costly. So, GBP is a stronger currency. So, GBP is stronger than CHF. What is CHF? Swiss franc. Which is stronger than euro, which is stronger than USD. So, USD is actually weaker than pound, Swiss franc and euro, and USD is stronger. These are the 3 currencies that USD is weaker than: pound, franc and euro, but USD is stronger than several other currencies, which are your SGD. SGD is Singapore dollar. Then you have CAD, which is Canadian dollar. Then you have AUD, Australian dollar. Then you have New Zealand dollar. Then you have rupee. Then you have JPY, which is yen. So, this is the order in which the strength percolates downwards. That is, first GBP followed by Swiss franc, then euro, then US dollar, then Singapore dollar, then Canadian dollar, then Australian dollar, then New Zealand dollar, then rupee, then yen. Okay, these are the 10 currencies in which you may be asked questions. Okay, these are the 10 currencies in which you may be asked questions, and most often than not, I have at least not seen ICA asking twisted questions where they give you that pound is weaker than dollar. They never give questions. They follow some logic. Okay, so if you remember this logic, right? If you remember this logic, you will be able to understand what is base currency and what is quote currency. What do I mean by that? Let us say they say GBP USD. They give a number of 1.1. What does this mean? Is GBP stronger, USD stronger? What is stronger? I have already told you GBP is stronger than US dollar. So, moment you see this, you should realize this is 1 GBP is equal to 1.1 USD. Okay. Nowadays, they have also started giving the exam USD by GBP or USD per GBP is equal to 1.1. This is very clear, no? USD numerator, GBP denominator. So, 1.1 by 1 or number of USD per GBP is 1.1. This way also you will be able to understand. So, unnecessarily do not get confused. If you get one quote right in the exam, all subsequent quotes you can figure out on your own. Okay. So, this is the second important thing I want all of you to note. Right. This is the second important thing. Now, as I said, these four currency world over are quoted always indirectly, but in our exam case, they may be given whichever way. For you to remember, you have to follow this logic. Pound greater than franc, greater than euro, greater than USD, greater than SGD, greater than CAD, greater than AUD, greater than NZD, greater than rupee, greater than your yen. Okay. So, it may appear complex, it is not complex. If you look at it once or twice, you will know it. Okay. Now, after having understood this, let us move to the next aspect, which is what? Which is direct and indirect quote. We have understood what is direct, what is indirect, and direct is equal to 1 by indirect and indirect is equal to 1 by direct. Okay. So, we have finished the first aspect. Hopefully, you have understood. If you have not understood, ask questions in forums on our website or app, I will respond. Next, coming to next point, which is spot versus forward. What is this spot versus forward? So, spot basically means, buy today. Even when you buy today, you will not actually get delivery today. So, if you go to the share market, how does Indian stock market work? It works on T+2 settlement. T+2 settlement. That is, you buy today, money gets blocked. After 2 days, or that is ideally day after tomorrow, your money goes out and share comes in. Same logic works even in case of your currency markets. So, spot means T+2 settlement. Spot means T+2 settlement. So, if you buy something today, you will actually get delivery of it after 2 days. And if it is cash, cash means T+0, term means T+1. Cash means T+0, term means T+1, and spot means T+2. This is the typical settlement process. Now, in our exam questions, they don't typically get into all of this, but I have seen one question where they said that, the importer or exporter cancelled something on 13th or gave the instruction on 13th and all transactions happened on 15th. There was one case I remember very, very clearly in the last few years. Okay. This is good to know, but no need to worry about it. Now, if this is spot, what is forward? All of us have gone through the derivatives chapter. Forward is basically sometime in future, a rate that you are contracting for a future date. So, future date, it can be any day after T+2, where settlement is any day after 2 days, it is a future or forward contract. If it is done on the over the counter, it is called a forward contract. If you do it on an exchange, it is called as a future contract. Okay, so that is a forward contract. Now, with respect to this chapter, most of the questions we will look at in terms of forward dates only. That is, importer is planning to do something, as exporter is planning to hedge something. So everything is a plan. So basically, everything is related to future. So you have to understand that when you are talking about futures, if it is done on an exchange, it's a future contract. If it is done on OTC, that is a banker. You do OTC means over the counter. That is, you do a deal directly with a banker. Such kind of a deal is called forward contract. Okay. So this is second point that you need to learn, and this is very, very simple, very, very clear. It comes directly from your derivatives chapter. So unnecessarily do not bother about it. But the thing that you need to bother about with respect to spot and future is, if spot is equal to 10, I will take that 85 rupees, what example we have taken, then 1 month future is equal to how much? If you remember the derivatives rules, or rather how a derivative is priced, or how a forward or future contract is priced, it is spot plus cost of carry. And in case of commodities and all, there is some subtraction and addition and all of that, convenience yield, storage cost, insurance cost, a bunch of other things. Ignore those. Spot plus cost of carry is what your forward or future contract. So if spot is 85, Cost of carry is what? Basically the interest cost. So your future, 1 month future probably will be 85.5. Probably, more often than not, it will be 85.5. Unless people think that, the rates are going to come down, or there is a, weird situation in the market. Indian interest rates are always higher. So because Indian interest rates are higher, our forward contracts are always higher than your spot. So this is called spot plus premium is equal to forward rate. It can be also called future. This premium is directly linked to interest. What interest? Interest of India and US. So it is actually the difference between these two interest rates. How it is, we will understand in the next concept, what we are talking about, that covered interest, arbitrage and all of that. But please note at this point that spot plus premium is equal to forward rate. Okay, so if spot is 85, the forward rate should be 85.5. So forward rate is always summation of spot plus premium. Can this premium be discount? That is, can premium, instead of being a positive number, can it be negative number? Yes, it can be negative number also. How will a negative number work and all of that, we will discuss separately. But for now, you please understand, this can be premium. If it is premium, it is plus. If it is discount, it is minus. Okay. Then moving to the next aspect. Currency strength. I have already explained to you what is currency strength. Okay, we have finished this. That is, pound is stronger than euro, pound is stronger than Swiss franc, which is stronger than euro, which is stronger than USD, which is stronger than CAD, which is stronger than AUD, which is stronger than NZD, which is stronger than rupee, which is stronger than yen. Okay, I think SGD comes before AUD, but please note that this is the strength that we have discussed about. So there is nothing in beyond that you need to understand at this point. Next, coming to something called as bid and ask. Bid and ask. So when I talk about bid and ask, right, please remember this one particular easy way to remember, and this is called B power 4C. Okay, B power 4C. What is it? Banker bids to buy the base currency. So B, 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 C. Okay, banker bids to buy the base currency. What do I mean by that? So when you look at a foreign exchange quote, let's say you go into the market, when you go to talk to a dealer or you go to the exchange, you will not see quote of 85 USD INR. You will not see a quote of 85. This is for you and me to understand. Actually, the quote will be 85.00 by 85.02. What do they mean by that? What do they mean by that? Here, this is bid part. This is ask part. Ask or offer. Okay, it's also called offer rate. So bid is buy, ask is sell. Now, what do all these mean? If you as an individual are going to buy in the bank, if you as an individual are going to the exchange or going to the dealer to buy, what are you buying? When the quote is 85, when the quote is 85, okay, 85, 8502, what are you buying or what are you selling? If someone says, what is the price of this iPhone? Okay, either buying or selling, you will always say it is 2 Samsungs or 3 Oppos. Now, what are we buying and selling? Are we buying iPhone or are we buying Samsungs or Samsung mobile phones or Oppo phones? We are actually buying an iPhone, which is why per unit of this iPhone, we are giving the quote in terms of Samsung or Oppo. Same way, when you see a quote of 8500 and 8502, this is the number of rupees. What do you give number of rupees for? For buying an item. What is the item here? Here the item is dollars. So for $1, this is the quote. So when you see a price of 8502, it is for buying $1, how much does this cost? But what is the dollar here? Dollar here is the base currency. What is dollar here? Dollar here is the base currency. So which is why I said banker bids to buy the base currency. So if you look at this bid is to buy base currency. By whom? By the banker. So banker will always want to buy the base currency at this rate, at 85. So if banker is buying at 85, what is 85.02? It is the rate at which banker is selling. ask or offer or sell. And what is he selling? He is selling $1 for that. That is, if he is selling $1 is going out from him and rupees are coming to him, correct? Which is why he is charging you 85.02. Arey boss, so I am a banker. If I have to buy dollars, I will give you 85 rupees and take $1. If I have to sell dollar, that is, the dollar is the base currency. If I am selling the dollar, I will sell $1 and get 85.02. Arey, this took sulta. Which is, if I have to buy, if I as an individual am owner of an iPhone and I am buying an iPhone, I will give you 2 Samsungs, right? If I am selling an iPhone, I will ask you 3 Samsungs. How is that possible? That is what is the whole point. The banker is a dealer. A dealer deals in bid-ask spread. So a dealer is someone who makes money of this 0.02. So a dealer is someone who provides liquidity in the market. So a dealer will always quote for his benefit. That is, when he is selling, he will always want more of what he is getting. When he is buying, he will always give less of what he is giving. If the unit of currency what he is buying or selling is $1, the only change of giving less or taking more can happen in rupee. So when the banker is buying $1, he gives you 85 rupees. When the banker is selling you $1, he is asking you 85.02 rupees. You have to remember this concept very, very clearly. Banker bids to buy the base currency. Banker is always at profit. If you understand this part, second part of the problems that you will encounter when you are solving questions in this chapter, you will be easily able to overcome. Okay, so we have understood what is bid, we have understood what is asked, we have understood what is the difference between those two. What is the difference between these two? This is called as 0.2. 0.02 is known as bid ask spread. 0.02. What is this 0.02? 85.02 minus 85.00 is known as bid ask spread. Now, after having understood this, let us move to the next aspect. What is the next aspect? After finishing bid ask spread, next aspect is covered interest arbitrage. Okay. Now, there are various theories. We will understand the theories in as we move to the problems. But there is one point that I want you to understand, which is related to this cost of carry concept. Where I said it is the difference between USD interest rate, INR interest rate. Okay. So what I wish to explain is, or what you need to understand is, 85 is 1 USD equal to question mark INR. Correct. Now again, I am not using bid ask spread, just take simple 85. It can be bid or it can be asked, doesn't matter. It is some code. Now in this is today. And I said tomorrow or 1 month later. It is 85.5. Why is it being 85.5? It is 85.5 because there is a cost of carry. But cost of carry, how did you arrive at it? Is it India's interest rate, what is charged in Indian markets, 5%, 6%, 7%, what RBI charges? Is it that rate at which you compound? No. The way international Forex markets work is, forward rate, which is 85.5, is equal to spot into, which is 85 into, so this is the numerator part, into 1 plus domestic interest by 1 plus foreign interest. So let us assume domestic interest is 8.6% and foreign interest is 8%. Okay, I'm just make some random assumptions. So when you take interest rate, you always do 1 plus. There is a compounding impact, right? So what is 85 into 1.086 divided by 1.08 is equal to, you get 85.47 or 48. So this is the way you got 85.5. You take forward rate is a function of your spot rate plus your 1 plus domestic interest rate divided by 1 plus foreign interest rate. And here these two are direct quotes. Correct? So if you are trying to use direct quote and arrive at a forward rate, this is the formula. If it is indirect quote, it is exactly ulta. Why? Because you are doing 1 by spot. So this side also will change to 1 plus F by 1 plus D. Okay. So you are doing 1 by direct quote, right? 1 by direct quote. So the second part of the equation will also change to 1 by 1 plus d by 1 plus f, which is 1 plus f by 1 plus d. Okay. So as far as direct quotes are concerned, forward rate is equal to, or expected spot is equal to, your current spot into 1 plus domestic interest rate by 1 plus foreign interest rate, and this is direct quote, please remember. Now this part, you have this terminology called interest rate parity, covered interest arbitrage, there are a bunch of things, purchasing power parity, where instead of taking interest rates you take inflation differentials. So you do a bunch of these things that we will be learning here as we move forward, but for now, covered interest arbitrage or interest rate parity. Okay, in this particular aspect, we are learning about how interest rates help determine the foreign exchange rate. How interest rates help determine the foreign exchange rate from a future perspective and from a based on current spot that it is quoting on. Okay, so we have understood these 5 very, very important concepts. After having understood these 5 important concepts, now let us jump into the problems. And in the problems, we will solve one problem of each variety, and in that problem, we will try and cover everything comprehensively. Okay, we will try and cover everything comprehensively. Okay, chalo, let's move forward. But before we go there, one small problem concept which I want to do, which I want to highlight to you, which is probably called the transition from these concepts to problem, which is cross rates. Basically, I give you USD INR, that is number of INR per USD. Then I also give you GBP USD, which is number of USD per GBP. I want you to find out what is GBP INR. Okay, so example is USD INR. Let us take a simpler example, 90 rupees. Okay, let's say this is 90 rupees. That is 90 rupees equal to $1. GBP USD. Let us take again a very simplistic this thing, 1.5 USD. 1.5 USD make 1 pound. So 90 rupees is equal to 1 USD. 1.5 USD is equal to 1 GBP. Now the question is, 1 GBP is equal to question mark INR. So this is one way, or the crosses means you basically having 2 quotes, and in these 2 quotes there are 3 currencies. So how many currencies you have? USD, INR, GBP. So there are 3 currencies in 2 quotes. Now you are trying to arrive at a third quote of a currency for which quote is not available. Okay. Now this can be direct, indirect, all that doesn't matter. 1 by indirect is direct, 1 by direct is indirect. So that is not a concern at all. So that is not a concern at all. What is of concern is how do you compute it, or how do you arrive at it. See, I have written it down in very, very simple terms for you to understand. Okay. Now if you look at it itself, you will understand that this is 1 USD. Now you need 1.5 USD. So what will you do? You will do 90 into 1.5, which will give you 90 plus into 1.5 is half of 90 is 45. So 90 plus 145 is 135. So you will say 1 GBP is equal to 135 INR. Now this is easily understandable for you because I have given it to you in INR terms. You are broadly aware of USD INR, you are broadly aware of USD GBP and all of that. Suppose I give you some complicated things, yen versus CHF, okay, and yen versus some Brazilian real. Now I ask you Brazilian real versus CHF, how will you do it? Right, that is where the complication comes. Okay, so and there are methods, easy method only, nothing complicated. According to me, the most logical way is this. It may, even if it takes time, if you can put it everything in terms of 1 unit of what is equal to how many units of other, half your problems will be solved. If you are not able to do this, see, in our case we did a direct multiplication. In certain cases there may be division. Why will there be division? Because instead of asking GBP INR, if I ask INR GBP, right, then there may be a division. We will come to that. Okay, I will explain to you that also, but let us look at a problem wherein I have an opportunity to explain. Okay, so that is how I wanted to move into the problems part. So let us look at this point, cross rates. Let us look at this particular question. Given $1 is equal to 107 yen, okay, very simple. 1 pound is equal to $1.26 and 1 Australian dollar is equal to 0.7 US dollars. Now calculate the cross rate for pound in yen. So you see how many currencies are there here? USD, yen, pound, AUD. You have 4 currencies and 3 codes. Now they are asking calculate the cross rate for pound in yen terms. So given these data points, compute pound in yen terms. That is, for 1 pound, how many yen? So, be very clear. Pound in yen terms means 1 pound, how many yen? See, 1 pound is equal to $1.26. $1 is equal to 107.31 yen. So, $1 US dollar. Okay, in fact, I'll be even more specific. 1 USD. 1 USD is equal to 107.31 yen. So, 1 pound is equal to 1.26 USD, okay, into 107.31 yen per USD. This is what I wanted to highlight to you. So, what happens? USD get cancelled and you get the answer in yen terms. So, for 1 USD, this is what it is. This is for 1 pound, this is the number of USD. So, you multiply that with the number of yens per USD. So, USD gets cancelled. So, you will get the answer. What is the answer? 1.26 into 107.31. So, 1 pound is equal to 135.2106 yen. Clear? Now, because it is a simple one, you are able to do it. Now, let us go to the other one, which is calculate the cross rate for Australian dollar in yen terms. So, 1 AUD is equal to how much? Is 0.7 USD is equal to 0.70 USD. Same logic. And 1 USD is equal to 107.31 yen. So, 1 AUD is equal to 0.70 USD into 107.31 yen per 1 USD. Correct, no? This particular equation I am simplifying it, which is right, this particular equation I am inserting it here, or this particular computation I am inserting here. So, what will happen? USD will get cancelled, but this number denominator 1 will remain. So, you will have 0.7 into 107.31. So, 0.7 into 107.31. So, you will get 1 AUD is equal to 75.117 yen. Okay, this is the symbol for yen. Okay, so 1 AUD is 75.117. Now, what is the next point? Calculate the cross rate for pounds in Australian dollar terms. So, pounds in Australian dollar terms. So, they are asking 1 pound is equal to question mark AUD. This is what they are asking. Now, what are the numbers that we have here? 1 AUD is equal to 0.7 USD. Let me highlight with a different color. 1 AUD is 0.7 USD. And what is the other one? 1 pound is equal to $1.26. So, 1 pound is equal to $1.26 US dollars. 1 AUD is equal to 0.7 USD. Correct, no? 1 AUD is 0.7 USD. So, because here you have in dollar terms, you have to eliminate dollar, the denominator here has to be dollars. That is, 1 USD is equal to 1 by 0.7 AUD. Correct, no? If 1 AUD is 0.7 USD, 1 USD is equal to 1 by 0.7 AUD, which is what? 1 USD is equal to 1.42857 AUD. Correct? Now, you come and substitute that here. Come and substitute this here, which is 1 pound is equal to $1.26 and each dollar is how much? 1.427 AUD. So, into 1.42857 AUD per $1. Okay, this USD or dollar is both same. So, USD gets cancelled, but this 1 remains in the denominator, 1.26 is there in the numerator. So, 1.42587 into 1.26. So, you will get 1.7999 AUD, 1 pound, or 1 pound is equal to 1.8 AUD. So, this is how you compute. Now, the problem what may happen in exam, or even in fact what happens more in real life is, we have taken only one side. I have given you simple quotes 1.26 and all that. Is the real quote in market like this? No, quote in market is bid ask. So, when you take bid ask, when you have bid ask spreads, when you are buying 1 USD, what will happen? When you are selling 1 USD, what will happen? Both of the quotes will vary. So, this numerator, denominator business, whatever I have, they both will change to bid and ask depending on what you are buying or what you are selling. Okay, we will see a problem on that as and when we encounter a problem, you'll understand it much better. Rather than me trying to complicate it now, I would rather take it when there is a more detailed problem. But first, understand what is this whole cross-wala business and what typically basically happens in this, or how you are supposed to compute with simple logic. As you move forward, we will look at the complicated questions. Okay, now after this, let us move to the first question. What did I discuss as the first question that we are going to be solving? I said first question, return for domestic and foreign investor. In fact, I think I will say 0th question, we have solved cross rates. And if any of you are using my P600, this cross rates question is question number 14 in P600 plus. It is question number 14. I will also write down question number so that it is easy for you guys to look it up. Now, return for domestic and foreign investors. Let us go and look at the first question, what it is. This is question number 5. Question number 5 in P600 plus. From there, you can look up this question. What is the question? Let us read it. With relaxation of norms in India for investment in international market up to 2.5 lakhs, the norms are relaxed in India for investment outside. Mr. X decided to hedge himself against the risk of declining Indian economy and weakening of Indian rupee during last few years. He decided to diversify into international markets. So, because all this is general gyan, that's all. Accordingly, he invested a sum of 1.58 crores on 1st Jan 20x1 in S&P index. On 1st Jan 20x2, he sold his investment. Other relevant data is given below. What are they saying? What are the other relevant data points? Index of stock market in India 7395 on first year. S&P is 2028, exchange rate is 62 or 62.25. This is where that bid ask wala portion comes. On 1120x2, they have not given the Indian stock market index. I presume it is Nifty or Sensex. S&P value is given, exchange rate is given. Now, what are they wanting to do? What do they want us to do? You are required to calculate the following: the return for a US investor. Return for a US investor. If a US investor invests, or US investor invests in US market, what is their return? Holding period return for X, because X has invested in US market, what is the return? The value of index on the stock in India as on 1x202, at which X would be indifferent between investment in S&P and Indian stock market. So basically they are saying, if instead of investing outside India, had he invested in India, probably assume that he gets the same return as what he got in US. If he gets the same return, then what should be the closing value of the index on that date? Right. So, what should be the closing value of Indian index on that date, so that it basically is exactly the same return of what he has got from outside India, considering currency appreciation, considering S&P movement. Okay. Okay. So, now after having read this question, let us go and solve for this particular problem. So, now let us look at this solution. And friends, please note, this is a revision session, rather a fast track batch. So, or a fast track session. Don't expect me to solve exactly step by step as required in the exam. I will move faster because that is in your interest. Okay. So, what is the return for a US investor? Return is equal to closing minus opening by opening plus capital plus dividend, if any, into 100. Are there any dividend story here? Nothing. So, what is the, for a US investor, the return is, what is closing? Closing is 1919. So, 1919 minus 2028. So, opening was 2028. So, it actually reduced. Dividend is 0. Okay, into 100. So, how much will it be? 1919 minus 2028 is equal to minus 109. So, it will be minus 109 divided by 2028 into 100. That will be 5.37%. 5.37%. This is the first part. Now, what is the second part? What did they ask in the second part? Holding period return. What is holding period return for Mr. X? Mr. X, what did Mr. X do? He had rupees. How much did he have? He had 1.58 crores. 1.58 CR. Okay. 1.58 CR, he first has to convert to USD. Then he invests in S&P. Then he sells S&P, right? Then he converts to INR. This is the process, correct? This 1.58 crore, when he converts into USD, how much USD will he get? Please see here. On 1101, okay, on 11x1 rather, The rate is 62, 62.25. What is bid and what is ask? Ask is the rate at which the dealer is willing to sell. Sell what? Sell dollars. What do you need to do? You have 1.58. X has 1.58 crore rupees. So he needs to convert into dollars. So he has to buy dollars, means the dealer has to sell dollars. If the dealer is selling dollars, he will sell dollars at 62.25. So 1.58 CR divided by 62.25. Correct only, no? Divided by 62.25. Correct? Yeah, 62.25. So he'll get equivalent dollars. How many dollars? 1 crore 58, 12 lakhs divided by 62.25. That gives you $253815.26. This is the dollars. This dollars he has invested in S&P. So he has invested in S&P this many dollars. Now if he has invested this many dollars in S&P, what has happened to S&P? S&P has fallen. Fallen by how much? Fallen by 5.37%. So if you invest this much in S&P, the value after 1 year, this is 20x1. So this is 20x2. After 1 year, the value of the same investment in S&P after 1 year is into 5.37%, no? 5.37%. So it is reduced by 13,000. If you reduce it, you get $2,40,185.38. So he gets $2,40,185.38. How did I get this? This into 1 minus 5.37%. What is 5.37? It is the return for a US investor. Why is it return for you? Why are we considering that? Because once you have dollar money, you are as good as a dollar investor. Right. So this money now you convert to INR. When you convert to INR, you are selling a dollar. Mr. X is selling a dollar. So the banker is buying the dollar. If banker is buying dollar, what is the rate? 67.25. 67.25. So he will convert this into 67.25. It is not 67.50, it is 67.25. So into 67.25. So you multiply into 67.25, you get 1 crore 61 lakh 52,466.91 rupees. This is what he got. Now this is what is the exact question? The exact question that they have asked is holding period return. So holding period return is what? Closing minus opening by opening. So holding period return for X in rupee terms is equal to 161,52,466.91 minus 1 crore 58 lakhs divided by 1 crore 58 lakhs. Right. So minus 158 divided by 158. So you get 2.23%. You get 2.23%. You get 2.23%. This is what return in rupee terms for this particular investor X. Now what is the third question? What is the third question that they've asked? Now what is the third question that they've asked? The value of index in India as on 1x at which he would be indifferent between these two, in S&P and Indian stock market. So instead of investing in US stock market, had he invested in Indian market, let's say he got 2.23% return. So what is the closing value of the index? What is opening? Opening index is how much? 7395. 7395. Closing should get him 2.23% return. So closing is equal to 7395 into 1 plus 2.23%. That's all, very simple. Plus 1 into 7395. So you will get closing should be 7559.96, or you can round it off to 7560. So index value is also in decimal. So you can directly give this the answer. Closing index, Indian index value is 7559.96. Okay. So this is how you compute, where you have this whole holding period return, return invested in foreign currency, bringing it back. There is an exchange variation, bid, ask, everything is involved, everything is integrated into a single question. Okay. Now let us move to the next question. What was the next question that we thought of? This one was question number 5. Okay, this is question number 5. Then gain or loss on squaring off and other questions. Let us see. This is question number 3. This is question number 3. So this is question number 3 which we are going to solve now. So friends, so let us look at this question. This is on squaring off and all that. So what is it? What is the question? You're Forex dealer. You are Forex dealer. So you're a bank. There is a dealer in your office. Okay, or think of it as you're a company. You have a dealer. Has entered into a cross currency deal. What's a cross currency deal? Where there are three currencies, and has sold US dollar 10 million, not 10 million, 1 million. I'm sorry, 6 zeros is a million. Okay, against euros at US dollar 1 is equal to euro 1.44 for spot delivery. What does this mean? They said they use the word cross currency, but they have given only dollars and euro. Okay. Then however, later during the day market became volatile and the dealer, in compliance with his management guidelines, had to square up the position. When the quotations were spot US dollar 1 is equal to INR 31.43 by 45 and spot US dollar 1 is equal to euro 1.44 by 445, and they have given 1 month, 2 month margin and all of that. All those is not relevant. Why? Because he purchased, or rather he sold dollars for spot, so he will, whatever he has to do, everything has to be in spot. It cannot be on forward rate. What will be the gain loss gain or loss in the transaction? Now it's a very simple question, but there are layers to this. Now, let us see what are the layers. First part is they are saying cross currency. Arey boss, but where is rupee? All your quotes are in dollars and euros. Where will rupee come? See, because they say you are dealer. In this question, you have to assume that you are based out of India. And when you are based out of India, all your gains and losses at the end of the day are computed in rupee terms. So whether you make a gain or a loss, that has to be converted into rupees. That has to be converted into rupees. So let us see what happens. So first, what will happen is, what is the first transaction? Sold USD. So please note, sold dollar 1 million. Okay. So let's put minus, and purchased euro. How much? At what rate? You won't get 1 million euro, no? If there is an exchange rate at 1.44, at US dollar 1 is equal to euro 1.44. So plus euro 1.44 million. Why am I doing directly like this? $1 is 1.44 euro. So $1 million is equal to 1.44 million euro. Okay, this is what you've got. Now what are they saying? During the day market became volatile and dealer in compliance had to square off. What do you mean square off? Square off means cancelling. Cancelling means doing an exactly ulta. So what do? You now see, you sold off this much. Now you have to, and you have this many euro in hand. This many euro you need to sell off. This many euro you need to sell off. When you sell off this many euro, well, how much will you sell? You have 1.44 million euro. So now you have to sell minus euro 1.44 million. Okay, so when you sell 1.44 million, what has happened? At what rate? The US dollar euro spot rate is 1.44 by 4450. Now, which rate will be applicable? This rate is for what? $1 is equal to so many euro. So, bid and ask. Banker bids to buy the base currency. So, banker will buy $1, banker will sell $1, banker will buy $1 at 1.44 euros, banker will sell $1 at 1.4450. Now, banker is buying and selling. So, what do you have to do? So, you need to sell euro. If you have to sell euro, you have to buy dollar. If you have to buy dollar, banker has to sell dollar. Banker is selling dollar means the rate applicable will be 1.4450. So, what you do is you sell 1.44 million euro at 1.4450 euro per US dollar. So, how many US dollars will you get? You have to do 1.44 million, that is 144 and 4 zeros divided by 1.4450. So, how much will you get? You will get USD 996539.79. So, this will be, you sold 1 million, but you got back 9965,359.79. So, what is the loss? Minus 1 million. Your loss is equal to 3460.200, this many USD. Now, here there is one point, okay. When you square off, do you square off by selling what you have already bought? Okay, you have bought euro here. Do you sell off exactly what you have bought, or do you enter into an ulta transaction? That is a key question. See, as far as I know, right, whatever we do in the market, when we square off, if I am buying $100 million, everything is in dollars terms, okay, or if I am selling in dollars, I will do ulta of dollar. So this whole thing about I have euro and this euro I will convert it, whatever euro I bought I will sold, it doesn't work that way. I have initially sold dollars, so now I will buy dollars. So if you have made this, if you have worked out on this basis, to that extent there is a small error. Why? Because you are selling off euro instead of buying back dollars. If you buy back dollars, you have to buy back entire 1 million. But here you are getting less than $1 million. Right? You are getting less than $1 million. So this is one way. Ideally, an examiner should give you marks. But typically, from a market perspective, it is not how it is done. You will say, initially you sold dollars. So now you will buy dollars. Buy dollars 1 million. What is the exchange rate for buying dollars 1 million? Same exchange rate, whatever you have seen here, 1.4450. So buy dollars, sell euro at 1.4450 euro per dollar. So you have 1.4450 euro per dollar. What will you do with this exchange rate? You will buy $1 million. So if you are buying $1 million, how many euro will you have to give? You have to give 1,445,000 euros. Extra zero I put, 1,445,000 euros. But how much did you originally purchase? This is sell this many euros. So how many do you have actually? You actually have 1.44 million only, but you have sold 1.445. So this is what you sold from 1.44 thousand euro. So you sold more than what you have. So you have a 5,000 euro ka loss. You have a loss of 5,000 euros. This 5,000 euros, you have to now buy 5,000 euros and sell dollars. So how many, if euro you have to buy and you have to sell dollars, if you are selling dollars, banker is buying dollars. If banker is buying dollars, what is the rate? If banker is buying dollars, the rate is 1.4400. So you have to buy 5,000 euros and sell dollars. How many dollars should you sell? $1 is equal to how many this thing on spot basis? 1.4400. I'll clean this up. 1.4400 by 4450. So if you have to buy euros, you have to sell dollars. If you are selling dollars, banker is buying dollars. At what rate banker will buy? 1.44. So you will buy $1 is equal to 1.44 is the applicable rate. So you buy 5,000 euros at 1.44 euro per dollar. Okay, so you basically sell dollar and buy euro. Correct? In order to square off your position. If you have to buy euro at 1.44 euros per dollar and you have to buy 5,000 euros, how many dollars do you have to sell? You have to sell 5,000 euro by 1 divided by 1.44 euro per dollar. Correct? This is the rate. So if you do this, you will get 5,000 and euro gets cancelled, $5,000 by 1.44. So you have to sell 5,000 by $1.44, which is $3472.22. So you have to sell this many dollars. So originally you sold $1 million. Now you are again selling another 3472. So you see the point I was trying to highlight here. What is it? If you do in this way, you have to sell $3472. Whereas if you come back here, you have to sell $3460. There is a slight difference. What is the difference? In first case, you sold off whatever euros you have. Whereas here, in order to square off your position, you are selling off equivalent amount of dollars. And why is there this difference 3460 and 3472? What is this minor difference? This minor difference is on account of bid and ask. This minor difference is on account of bid and ask. Now, this $3472.22 is in dollar terms. You are an Indian dealer. If you are an Indian dealer, right? So you have sold $3472.22, but you need to convert it in rupees. So you have sold so many dollars, but you don't have the dollars. So now you have to buy dollars. How many dollars? $3472.22. At what exchange rate? At rate of, if you have to buy dollars, what is the code that is applicable to you in dollar terms? The second one. If you have to buy, it is 0.45, because ask side is selling. That is, banker is selling the base currency. Bid is banker is buying the base currency, ask is banker is selling the base currency. So base currency here is dollar, so he is going to sell you $1 at 31.45. So if you are going to buy this many dollars, so amount is 31.45. You have to spend how much? 3472.22 into 31.45. So you spend 109201.38 rupees. So this is your loss. In this question, don't solve in the first method which I showed you, because that is not actually is what normal squaring off is. I purposely did this in this question to show you that squaring off is not exactly the ulta where whatever you have you sell off, right? Typically in squaring off, if you are doing everything in dollar terms, if you initially sold dollars, you buy back equivalent dollars. If you've initially bought dollars, you will sell equivalent dollars. Please don't think of whatever you have, I sell it. Okay, that is not typically the way. You typically look at it in dollar terms. Okay, even if you do this, I don't think the answer will be wildly different. See, because all you need to do is 3460.22 into how much? 31.45. You will get 1088 something. So you will get 108823.919. It is not significantly different, but then from an evaluator perspective, the answers are different. So if you want, you can do both methods, but please specify very clearly what you're doing. Ideally, in an ideal scenario, if the examiner is smart enough, they will realize that this is also correct. But in case the ICA method is what you choose to follow, you should follow this method wherein if you have initially sold dollars, you buy back dollars. If initially you have bought dollars, then you sell dollars equivalent value. Don't try and convert everything, whatever is the currency you have, I sell it off and then close it. That is not the way. Okay. Now let us move to the next question. Next question is Bharat Silks Limited. This is a question on, I think this is a question on arbitrage transaction if I am not. Arbitrage gain. I think this is a question number 6 if I am not wrong, 6 or 8, let me just check. Yeah, this is question number 6, Bharat Silks, this is an arbitrage transaction. Let me go there and write down also. So here we will be solving 6 and 8, okay, these are numbers in P600 plus, okay. So we are going to be solving 6 and 8 here, right now we are at 6. Let us go and look at that problem. So friends, what is this question number 6? Let us read. Bharat Silk Limited is an established exporter of silk materials and they have a surplus of $20 million. So the surplus is in dollar terms. On 31st May 2015, the banker of the company informs the following exchange rates that are quoted at 3 different markets. So 3 different markets, 3 exchange rates are quoted. GBP INR and INR GBP, USD INR, INR USD, USD GBP, GBP USD. Now you see here, one of the problems with these quotes, 1 by 99.1, 0.0100908, it is not actually exact. Then 1 by 64.1, 0.015600, it is given as 0.02. So I am very, very wary of taking rates which are not rounded off. I would rather take rates which are more specific and clear. So I will consider 99.1, 64.1 and 1.5530. So if you do 1 by 1.5530, you get 0.64391. Here they have rounded off to 0.65. I would not want to consider this the second decimal round off. If there is more information, I would want to use it. So now let us see. Assuming that there are no transaction costs, advise the company how to avail the arbitrage gain from above quoted spot exchange rate. What is arbitrage gain? Arbitrage is buy plus sell, same time, same product, different markets to make a gain. You buy something in one market, sell the same thing in another market. So here what are they saying? You have to figure out this $20 million what you have. How are you going to make a gain? So you have this 20, you convert to some other currency, then again convert into dollar, see whether you have this 20 million less or more. So let us look at what are the ways in which we can do. $20 million convert to, what are the other currencies that they have given? Pound and INR, right? Convert to INR, then pound, then back to USD. Will I get more money? Or what is the other rate they have given? $20 million. Convert to pound, then to rupee, and then back to USD. There are these two methods, right? There are these two methods. You can go from dollar route to INR via pound and come back to dollar, or dollar to pound via INR and come back to dollars. Okay, both of them, they have not given bid ask, thankfully. If that was there, there would be additional complication. So first you have dollar. Now case 1, let me call this as 1, let me call this as 2. In case 1, you are converting dollars into rupees. So $20 million into rupees. If you convert it into rupees, how much will you get? Each dollar is 64.1. So you simply get $20 million in equivalent INR is equal to 20 million into 64.1 rupees. This is $20 million into 64.1 rupees per dollar. So dollar get cancelled, what you are left with is rupee terms. So 64.1 into 20, that is 1282 million rupees. This is what you have. Right, this is rupee. Now what you are supposed to do, this rupee you are supposed to convert to pound. Rupee to pound exchange rate, what is that? They have given some number somewhere. Rupee to pound, 99.1. So 1 pound is this many rupees. So 1282 million rupees by 1 divided by 99.1 rupee per pound. So rupee cancel, this pound goes to the top, you get 1282 by 99.1 million pounds divided by 99.1, that is equal to 12.9364 million pounds. Okay. Now some of you may be wondering, why did I divide? How did I know I have to divide? Arey kuch nahi boss, it is very simple. You already have money in rupee terms. You have to convert into pound terms. If rupee has to be converted into pounds, denominator also should have a rupee which should get cancelled. So here, if I put directly if I put directly the denominator here, that is 99.1, that is when rupee will get cancelled. So you put 99.1 in the denominator and obviously pound will go to the top and you will be able to convert into pounds. Okay. Now this 12.9364 million pounds to dollars. What is dollar pound exchange rate? 1.5530. What does it say? 1 pound is so many dollars. Please note, each pound is this many dollars. Each USD is this many rupees. Same way, each pound is this many dollars. So 1.5530 dollars. So that will be 12.9364 into 1 point, what was that? 1.553, 5530. 553, so into 1.5530. So you will get 20.09027 million rupees, not rupees, I'm sorry, this many US dollars. So 20.09, so that is $90,272 is a gain. Now this is a very simple question. If they had given bid ask, then the story would have been different. Let us go and see a question where they have given these bid ask issues. This is, next question is question number 8. This is question number 8 from my P600 plus. Here they have given bid ask. Okay, so this is where it is going to be interesting. So now let us look at this question where there is bid ask wala story. You are a Forex dealer of your bank. So you are in a bank and are informed that your bank has sold a TT on Copenhagen for Danish kroner at the rate of 1 kroner is 6.5150 rupees. What are we saying here? What is this whole story? Have we sold kroner or have we sold dollars? See, you have sold a TT on Copenhagen. What is a TT? Telegraphic transfer. What is a telegraphic transfer? Somebody is making a remittance. You have sold a TT on Danish kroner, meaning somebody wants to make a remittance, so to them you have sold a kroner. So you have to buy from the market and give it to this somebody who wants to remit this Danish kroner. Okay, Danish kroner is the currency of Denmark. Now you are required to cover the transaction either in London or New York market. So either you can cover in London or you can cover in New York. In which market will you cover the transaction, London or New York, and what will be the exchange profit or loss in the transaction, ignore the brokerage. So they're saying exactly what we discussed earlier, that is DKK, I will use Danish kroner. You have to now buy. If you have to buy, you buy either in New York or you buy in London. One of these places you will buy. But when you buy New York, right, you look at, let us look at the codes. Mumbai, London, Mumbai, New York, London, Copenhagen, New York, Copenhagen. What does this mean? So you have rupees. Rupees you give and buy pounds. Pounds you give and buy DKK. Or rupees you give and buy USD. USD you sell and buy DKK. So this is case 1, this is case 2. So in both of these cases, you are supposed to evaluate which one gives you a profit or which one gives you higher profit, lower profit, doesn't matter. Right now you need 1 million. This is also 1 million, 5, 6 zeros, right? 1 million. You need to buy 1 million kroner. If you have to buy 1 million kroner, okay, you have to buy 1 million kroner, you have to work backwards. If you have to buy 1 million kroner, let us look at the first scenario. What is first one? Case 1 through London, right? You have to buy 1 million. Buy 1 million DKK. Sell how many GBP? You have to sell some GBP, no? What is the exchange rate? Exchange rate is London, Copenhagen. DKK is this much, DKK is this much. What does this mean? This is bid, this is ask. And London, Copenhagen means this is 1 pound. This is $1. Because please note, pound and dollar are stronger currencies. So 1 pound is this many DKK. This is bid, this is ask. Now what are you supposed to do? You're supposed to buy DKK. That means you're supposed to sell pound. If you're going to sell pound, banker has to buy the pound. Banker has to buy the pound. What is the code that is applicable? Banker buys the base currency. Base currency here is pound. So banker will buy this pound at 11.42 DKK. So 11.42, correct? No, 11.42 only, right? Yeah, 11.42 DKK per pound, right? So you have to sell your pound and buy DKK. So how many pounds will you sell? You will sell 1 million DKK, right? Divide by 11.42 DKK per 1 pound. So again, same logic happens. So 1 million divided by 11.42. That is, you will sell 87,565.67 pounds. So you will sell this many pounds. But for you to sell this many pounds, you should buy those many pounds. What is the cost of each pound? Each pound is, from a pound perspective, if you have to buy pound, the rate is 74.32 because banker buys the base currency. If banker is selling the base currency, which is pound here, he will sell it to you at 74.32. So if you have to buy this many pounds, you have to spend how many rupees? 74.32 rupees per pound. So this pound gets cancelled. How much will you spend into 74.32? So you will spend rupees 657,880.91. This is the rupees that you will spend, right? You will spend this many rupees. But what have you purchased it at? This is the rupees that you will spend. That is, this is the rupees that you will give and buy so many pounds. Those many pounds you will give somewhere and buy kroner. Now with this, how much did you originally sell the TT for? Original TT. 1 million pound, 1 million DKK sold. You sell this, basically this is an outflow and you have an inflow of 1 million DKK. But the same 1 million DKK you sold and you got how much? How many rupees? 6.5150. So you got 6.5150, right? How many zeros? Yes. 1, 2, 3, 4, 5, 6, 7. 1, 2, 3, 4, 5, 6, 7. Yes. You got this many rupees. When you sold 1 million TT in 1 million DKK TT. So what is happening? This 1 million DKK gets cancelled. What you are left with is 6515,000 minus 650,7880. That is, you are left with rupees 7119.08. So you are left with this many rupees. Okay, so this is the number of rupees that you are left with. Now this is which route? This is the route of going through pound. Now what will it be if you go through the route of USD? That is, you need to buy 1 million DKK. That is, how many USD should you sell? What is the USD DKK rate? Is 7.5670 and 7.5840. So that is, so you are buying DKK and selling dollar. So banker bids to buy the base currency. This is for buying dollar. This is for selling dollar. So you need to buy 1 million DKK. That is, you need to sell dollars. If you are selling dollars, banker is buying dollars. What is the rate at which banker will buy dollars? Banker will buy dollars at this many DKK, because banker bids to buy the base currency. What is the base currency here? Base currency is dollar. So banker will buy $1 at 7.5670 DKK. So with 1 million DKK, how many dollars do you need to sell? You need to sell 7. What is that rate? 7.5670 DKK per dollar. So what you will do is, you will take 1 million DKK divided by 7.5670 DKK per dollar. So what you will get is 1 million divided by 7.567. So you will have to pay dollars 132,152.7686. This is the dollars you have to pay. If you need to pay in this many dollars, how many rupees that you have to? So you have to buy dollars 132,152.7686. How many rupees? For how many rupees? For how many rupees? Same logic what we did. Each dollar is how many rupees? Earlier pound was 74.32. So dollar also you will go the ask rate. Why? Because you have to buy dollar, that is banker is selling dollar. 49.2625. 49, this is the number here. Okay, 49.2625. So you have to buy dollars at 49.2625 into 49.2625 rupees per dollar. So dollar cancel, you'll have to spend 6510175.76 rupees. But how much did you get initially when you sold 1 million DKK? You got how much? There was a number they gave, no? 6 point something. What is that? 6.5150. So this is the outflow. Inflow was plus 6.5150 rupees per DKK into 1 million DKK. Correct? So DKK get cancelled. So what you will be left with is 6.510175 minus 6515000. Right? Yes. You will be left with 4824 rupees. So you will be left with 4824. Now what is the whole story? The story is, you got 4824 rupees here. What is the other place? How much did you get? 7119 rupees here. You got 7119 and you got 4824. So which one will you choose? You will choose the one that is giving you maximum profit, which is 7119, correct? 7119. So you will go with this logic. So what you will state in the answer is, given that London route is giving you more profit, you are going by this route. Now, can the same question be solved in an even simpler manner, or can we compute everything in DKK terms, or can we compute anything in any other terms? Yes, you can do that also. So when you do that, what will happen is, you, instead of getting this in rupee terms, you will get in DKK terms. The solution for this is there in my P600 plus. Go through it. I am not trying to explain that here also because I have other problems that we have to go to. Okay, this is not the only problem that we will spend time. We need other problems also. This is a revision batch. I will not cover everything 100%. I will cover everything enough so that you can write the exam and get good marks. Okay, so please have a look at please have a look at my P600 plus. This is question number 8. I think the page number is also some 364 or something. Please go and have a look at it, both PDF form, book, whatever you have. Okay. There also you'll get the same answer, just that instead of getting this in rupee terms, you'll get this in DKK terms. Okay, fair enough. Now let us move to the next one. What is the next one? We have completed till where? We have completed till arbitrage transactions. Next we have swap points and we have IRP and PPP points. These are number 4 and number 5. Let us go and look at those questions. Okay. And the swap points, we will be solving question number 12. Question number 12 from P600 plus. Then IRP, PPP, covered interest arbitrage. For these, we will be solving 2 questions. Question number 17 and 22. Let me write down all the questions first. It is easier. Then borrowing in USD and INR, probably we will solve 30 and 41. Then for supplier finance or LC, this we will solve 98. Then money market and forward transactions, we will solve these 2. We will solve 73. Then options will solve 99. Then Nostro Vostro will solve 77. Then fate of forward contracts will solve 87. Okay. These are the questions that we'll be solving for each of them. Just highlighting, just so that you also know which problem to look at when you look at my P600 plus. Okay. Now, given that I've already written down everything, I don't think I need to keep coming back to this, or probably I think we'll need to come back once in a while to see which topic are we in. Yeah. So this is question number 12. Question number 12 for implied swap points. Let us look at this question. You have the following quotes from Bank A and Bank B. There are 2 banks, Bank A and Bank B. Spot, you've been given spot, and 3 months forward and 6 months forward. 3-month and 6-month forwards are given for USD CHF. USD CHF. CHF is Swiss franc. And please note, USD CHF, if you remember, I told you what? I told you this, that GBP is stronger than CHF, which is stronger than Euro, which is stronger than USD, which is stronger than SGD, which is stronger than CAD, AUD, NZD, INR, and JPY. So, CHF is stronger than USD, means that one CHF will demand more than one USD. Okay, and GBP USD, that is 1 GBP will require more than 1 USD. Now let us see here, GBP USD is 1.7645. What does it mean? 1 GBP is equal to 1.7645 USD. What is the Uparwala quote, the top one? 1 USD is equal to, if you go by the same logic here, is equal to 1.465 CHF. Array, I just told you that CHF is stronger than USD. Was this question is, I think, which question? This is a steady metal question. This is a slightly older question. It's a slightly older question. At that point of time, USD and CHF, their particular exchange rate, USD was stronger than CHF. Today, if you go and look into any website and go and search where USD is, whether USD is stronger than CHF or weaker than CHF, you will realize CHF is stronger than USD. Whereas, at a point of time in the past, from where this question is given steady material, USD was stronger than CHF. Whereas, reality today, CHF is stronger than USD. But then how will you figure this out? All this, confusion in exam. See, GBP is always been stronger than USD. So, if you look at this quote, GBP USD, it very clearly says if GBP is stronger than USD, you require more than 1 USD for GBP. So, by this logic, when they say GBP USD, they are referring to GBP as the base currency. So, GBP is stronger. Same way, USD CHF also, if you go by the same logic of GBP USD, USD is the base currency, USD is stronger. So, if you go by the normal logic today, what I have explained to you in earlier, which I showed you on screen, if you go by that, you will actually get confused. You will think, what is this? Why is this appearing like this? Is this direct quote, indirect quote, and all that? So, please always read both parts of the question, or rather the entire question carefully before you jump to conclusions. Okay. So now this is one important point why I wanted to highlight. And please note, in today's day and age, when Institute will ask you a question, they will ask you based on today's rates. And today's rate, CHF is stronger than USD. Okay. Now, they have given spot 1.4650 by 55. What is 50 by 55? This is bid, this is ask. Okay, let me clean it up again. This is bid, this is ask. Right, in both cases, bid and ask. And please note, the difference between bid and ask is positive. Okay, bid and ask difference is positive. Okay, and here they are given 3 months and 6 months. What are these 3 months and 6 months? These are forward points. So if you want to buy same, get the bid quote after 3 months for a forward contract, or for a forward contract which is 3 months maturity, it will be 50 plus this 5 forward points, and it will be 55 plus 10 forward points. Okay, then if it is for 6 months, 10 and 15 have to be added here. Now this is for bank A. Now for bank B, they have given only spot. They have not given forward points. They have just said 1.4653 by 60 and 1.7640 by 50. They have not given forward points. Okay. Now for GBP USD, first one is USD CHF, second one is GBP USD. For GBP USD, they have said 1.7645 by 60, and they have given forward rates as 25 by 20. This is supposed to be increasing. Why are they decreasing? If they are decreasing, it means it is at the particular exchange rate, the currency is at a discount. So what is discount, what is premium? If you remember, I told you rupees 85.10 by 15. This is spot. Forward 3 months is 85 point, let's take 90 by 95. What does this mean? This is bid, this is ask. There is a difference between spot and forward. What is the difference between these two? This is 0.80 by 0.80. Typically it is not same, it may be slightly higher also. Okay, let's take 96, then it will be 0.81. Okay, 0.8081. This is the premium. This is the forward premium. What is forward premium? I told you also we will be discussing. In fact, that is going to be the next topic. It is the interest rate differential between two countries. Now, the interest rate differential, if you take on a direct quote basis, the numerator is the domestic currency, denominator is the foreign currency, and multiplied with the direct quote with base currency, then this reflects this difference, this basis points, or 80 paisa, 81 paisa, reflects the interest in paisa terms, okay, for a 3-month period. Interest rate differential in paisa terms for 3 months period. But interest is positive, right? So that is, India has a higher interest rate than US. India is 9%, US is 3%. So there is a differential of 6% per annum. Now, if let us say India is 3%, US is 9%, then what will happen? The same quote, instead of having a premium, you will have a discount. You will have a discount. What is this discount? Discount is, instead of adding this 80 paisa to 10 paisa, you will be subtracting 80 paisa from 10 paisa. So instead of making 85.1 plus 80 paisa, this is premium. If it is discount, it will be 85.1 minus 80 paisa. So this will be 84.30, whereas this is 85.90. Right? So this is premium, this is discount. Please remember this aspect. If this is at a discount, then how do you communicate it is a discount? Will you write discount? No. You will say that bid is higher than ask, and typically that is what the case is. The forward points for the bid are higher than forward points for the ask. So when we come to this problem, when we are solving this, you will understand this better. But please note, on the face of it, when you look at it, when the forward points are declining and not increasing, it means it is a discount. So if it is at a discount, you have to subtract the forward points from the spot quote in order to arrive at the forward quote. Okay, for now remember this. As we solve the problem, you will understand the balance part. Now what are they asking? Calculate how much minimum CHF amount you have to pay for 1 million GBP spot. So initially they have given USD CHF, then they have given GBP USD. Now they are asking what is the linkage between CHF GBP. Basically they are asking a cross rate, and they are saying how much do you have to pay for 1 million GBP. So if you want 1 million GBP, how many Swiss francs do you have to pay? So you want 1 million, you want to buy GBP. So how many CHF do you have to sell? Second question, considering quotes from bank A only, for GBP CHF, that is for 1 GBP how many CHF, what are the implied swap points for swap over 3 months? So implied swap points. So this question is on swap points. So we will first finish the first part, then come to the second part. It's a very interesting question. It's a very, very interesting question. Let me note down the key points here, because I have written way too much here. First question is what? How much do you have to pay for 1 million GBP spot? So it is only spot. And you have to, they have not said which bank. So you can do one leg of transaction from one bank, another leg of transaction from another bank. What do I mean by that? Let us see. USD, CHF, then GBP, USD. What are the spot rates that they have given? A, B, spot, 1.4650 by 55, 1.4653 by 60, 1.7645 by 60, 1.7640 by 50. So if you want to, so what is the end transaction? Transaction 1, transaction 2. What is transaction 2? Very specifically, how much CHF amount you have to pay to get buy 1 million GBP. Transaction 2 is buy GBP, sell CHF. Correct? For you to buy GBP and sell CHF, you don't have a direct quote between, or you don't have a quote between GBP and CHF. So you need to buy GBP. For you to buy GBP, if you don't sell CHF, instead you say buy GBP, sell USD. This is the second leg, because this is the end goal. End goal is buy GBP, sell CHF. So what you will do is, in leg 2, you will buy GBP and sell USD, correct? And in leg 1, you will say buy USD, sell CHF. What is going to happen? This sell USD and buy USD going to get knocked off, and you will be left with buy GBP and sell CHF. That is what you eventually want, right? So you have to figure out that you need to buy $1 million GBP. If you have to buy $1 million GBP, how much USD should you sell? So first you have to come to the second part, the second quote, or rather the GBP USD quote. When you are looking at GBP USD quote, this is 1 GBP is equal to question mark, or rather this many USD, and this is 1 USD is equal to this many CHF. Now you need 1 million GBP and you need to buy. If you are buying, this is a direct quote. In a direct quote, banker bids to buy the base currency. What is base currency? Base currency is GBP. Banker's bid is for buying the base currency. What do you want to do? You want to buy the base currency. So banker has to sell the base currency. Banker selling base currency is ask. So ask is the relevant quote. In ask, you have an opportunity to do with either A bank or B bank. Which one is cheaper? They will sell you 1 pound at 1.7660 in bank A and 7650 in bank B. So you will definitely say, I don't want bank A, I will choose bank B. And in bank B also, what is the relevant quote? Ask quote is relevant. So this is the first part. So what you will do is, the second leg of the transaction is, which is transaction 2, what you will do is buy 1 million pounds at 1.7650. 1.7650 USD per GBP. Correct? That is 1,765,000 USD for 1 million pounds. Correct? This is the second leg. Now, what is the first leg? In first leg, you should have purchased USD. How much USD should you have purchased? You should have purchased 1.765 million USD. So what is the rate there? See, if you are going to buy USD and USD is the base currency, banker is bidding to buy the base currency, whereas you want to buy. So ask quote is relevant. What is ask quote? Ask quote is here. And which is the cheaper ask quote? Cheaper ask quote is bank A. So this is the quote that you will follow. 0.55. So 1.4655. You want to, each $1 will take you 1.4655 CHF. So $1.765 million will ask you how many, or the banker will ask you how many CHF. 1.765 million USD into 1.4655, right? That is what is the number. Yeah, 4655 CHF per USD. So USD get cancelled, you are left with CHF. So in second leg, you will require 1.765 into 1.4655. You will require 2.5866075 million CHF. So 1 million GBP is equal to this many CHF. So 1 GBP is equal to 2.5866075 CHF. Correct? Right. Now, this is the exchange rate. What is the exact question they asked? They asked, how much minimum CHF amount you have to pay for 1 million GBP. Because they ask minimum, you will choose the best quote available for you when you buy USD or when you buy GBP. So which is what you have done. You have chosen the best possible quote. Okay, now coming to the second part, which is the more tricky, fun and interesting part. What is the second part of the question? Considering quotes from bank A only. So ignore bank B. Let me clean this up. So consider quotes only from bank A. For GBP CHF, that is for GBP CHF, okay, again same logic what we did earlier, because they are also saying GBP CHF. What are the implied swap points for spot over 3 months? What are implied swap points? So, and 3 months. So, this whole thing is not about 6 months, so we should concentrate only on 3 months number. Okay, spot over 3 months, what are the implied points, forward points? When they say what are the implied forward points, basically they're asking you the difference between forward and spot. And they have not said bid or ask, so you should compute both for bid and ask. Okay, so you should compute both for bid and ask. Let us see. What are the numbers here? USD CHF 1.4650. This is spot, 3 month forward. 1.4655. How did I get 55? I have added 50 to this 5. And then this 55 I will add to this 10. 55 by 65. And what is spot? 4650 by 55. So I have added here. I've added here how much? 5 bips and or 5 forward points and 10 forward points. Then GBP USD. What is the GBP USD rate? 1.7645 by 60, and what are the points? 25 and 20. So here you actually write minus 25 by 20. Why? Because it is a discount. How did I know that it is discount? Because the ask is lower than bid, or the forward points for ask are lower than forward points for bid. Moment you see this kind of declining forward points, you have to understand that this is at a discount. So if it is a discount, you subtract. So what will be this code be? 1.76 45 minus 25 is 20. And 60 minus 20 is 40. 1.7620 by 1.7640. Right. So this is what you do. This is the first part. What part is this? This is giving you what? This is giving you just the forward rate. From this forward rate, what are they asking? What are the implied forward points of GBP CHF? They have not directly asked you. They have not asked you what is it for USD CHF or GBP USD. They have asked you GBP CHF. That is basically what did we do earlier? We simply multiplied these two rates. Same way we have to multiply it again these. And GBP CHF is what? For 1 GBP, how many CHF? So if you have CHF, you will buy dollars, right? So if you're buying dollars, what is the code that is applicable? Same logic what we did earlier. If you're buying dollars, this is the banker bids to buy the base currency. Base currency here is USD. If the bid is for buying dollars. Bid has to be for, ask is for selling dollars. You are buying means banker is selling. So selling dollars bid is this 55. So the relevant code for CHF, USD CHF is this one. Okay, ask. Same way for GBP USD also, same logic, it is again ask. So you have to now multiply these two ask rates. How did I get GBP USD also? Same logic, which is you have to sell USD and buy GBP. If you are buying GBP, banker is selling GBP. Banker is selling GBP, the base currency is GBP, then ask is the relevant thing, because banker bids to buy the base currency, which is banker will ask to sell the base currency. So ask is the relevant code. So 40, 60 and 40. So the rate will be GBP CHF 1 CHF is equal to 1.46565. First I'll do spot is 1.4655 into 1.7660, and 3 month forward is 1.4665 into 1.7640. So you multiply these two, you will get how much? 1.4655 into 1.7660. You will get 2.588073. This is spot. This is 3 month forward is 1.4665 into 1.7640. You will get 2.586906. If you subtract both, so the difference between these two is minus 2.588073 minus 0.588073. 0.001167. You can round off to the fourth decimal. Okay, so minus 0.0012. Okay, minus 0.0012. This is spot over forwards, implied swap points. Implied swap, and this is what? This is the ask quote. Okay, implied swap, ask spot over 3-month forward. Okay, this is the ask quote. Now, if you look back at the question, did they say only ask? Considering the quotes, what are the implied swap points for spot over 3 months? See, they never said that you have to buy only or sell only. So, I assumed that same like previous logic or previous working, where we wanted to buy 1 million GBP, how much CHF we have to give? But here, the question is not that they're asking you both bid and ask. So, you have to do the same way, both bid and ask. So, here we have done the ask part, now you have to do the bid part. What is the bid part? Bid part. What is bid part? Bid part is whatever we have taken here, same way you take the in case of bid as well. 1.4650 spot 1.4650 into 7645. Why am I doing this? Because if you see, I multiplied 55 into 60. See here, 55 into 60. Then 65 into 40. 65 into 40. This is for ask. Now for bid, I have to multiply 50 into 45 and 55 into 20. So which is what I am doing. 3-month forward, 1.4655. 0.7620. Correct? Yes, 7620. So you will get 1.4650 into 1.7645 is equal to 2.58499925, and here 1.4655 into 1.7620 is equal to 2.582210. Okay, minus 2.58499925. So you get minus 0.002785. Right, now you see 3-month ideally should be greater than spot, because typically we remember or we understand things as spot, forward is greater than spot, because for usually currencies are at a premium, but that is not the logic, because we are all trained under Indian circumstances. See, 5822 is 3 months is lesser than 5849, so it is also at a discount. So the bid quote, bid swap points approximately minus 0.00278 ko, I will round off to 8. So the answer is bid swap points are this and ask swap points are this. Now when you write in the exam, you can actually put a neat table, clean table. In fact, even in my P600 plus, I put it in a neater form. But now I was actually trying to explain, in a small space how you can actually basically solve this problem, right? So minus 0.0028 and minus 0.0012. These are the swap points for bid and ask for GBP over CHF. So in exam, you have to write towards the end the implied swap points for GBP CHF. Bid is this much, ask is this much. Only then you will get marks. Please remember that. Okay. So friends, before we move to the next topic, which is interest rate parity, purchasing power parity, or international Fisher's effect, let us understand the theory aspect. This is slightly important from an exam perspective, as well as for you to understand the problem. I can't just directly jump in and solve the problem. You need to understand this basic concept. There are 3 kinds of exchange rate theories. One is called interest rate parity theory. Then you have purchasing power parity and international Fisher's effect. All 3 are very closely related. No need to worry. The first theory, IRP, basically says that size of the forward premium or discount, that is the discount or premium, whatever I explained you in the previous problem with respect to that swap points and all that, should be equal to interest rate differential between 2 countries. So India is 10% and US is 3% interest rate. Indian currency always will be depreciating from 85 to move to 90, 95, 100 and so on. So if you know, or if you go and Google it up, in 80s the exchange rate was 20s and 30s. In 90s it was 30s and 40s. In fact, even in 2000s it sometimes was 39 or so, I remember. Then after 2000s, into entire 2010 to 20 decade, it was in 60s, 70s. And 2022 onwards, it is fully above 70 and it is 80s and probably it will touch 90s also very soon. So rupee will continue to depreciate because Indian interest rates are much higher than US interest rates. When interest rate parity means equality exists, covered interest arbitrage is not feasible. Covered interest arbitrage means I will cover all my risks and I will take advantage of interest rate differences. So that kind of a profitable or that kind of an arbitrage is not possible. Covered interest arbitrage, the word arbitrage means making riskless profit. Covered interest, that is you are covering your exchange rate risk and you are making arbitrage profits out of interest rate differentials is not possible. So covered interest arbitrage is not possible because when interest rate parity exists. Interest rate parity means exchange rates keep adjusting to the interest rate differentials, because any interest rate advantage in foreign country will be offset by the discount of the forward rate. So discount or premium of the foreign rate, so it depends on what it is, right? So if there is an interest rate differential between two countries, it will reflect in foreign exchange rate. If it does not reflect, then you can have arbitrage situations. If it reflects, then you will not have a covered interest arbitrage. And what is the logic here? Forward rate. Forward rate is equal to spot rate direct quote. So please always think, I myself actually always think of this, 85 rupee is equal to 80 rupee into 1 plus 9% divided by 1 plus 3%. What am I talking here? USD INR. Direct quote. Okay, 85 is forward, 80 is, and please don't, I am not giving you the period, assume for some period, 3 months, 6 months, 1 year, right? Direct quote spot multiplied by in domestic currency interest rate, which is INR, by 1 plus 3%, which is foreign currency interest rate. And please note, interest rates are not added, they are always multiplied. It is always 1 plus 9% by 1 plus 3% or 1 plus 9 into 1 plus 3. It is never 9 plus 3 or 9 by 3. Or 9 minus 3. Okay, this is covered interest rate parity. Basically, it gives you this equation of how forward rates are arrived at. And then you have uncovered interest rate parity, which is basically instead of forward rate, if you are looking purely at spot rates, that is, you are not looking to hedge, you are not bothered about what is the forward rate, you are not making any hedging decisions, but what will be the future spot? Future spot also will follow the same logic, which is current spot into domestic interest rate by foreign market rate, foreign interest rate. Forward rates are expected values of spot rate on that date. That is what we do, no? Even in case of futures and forwards, when we discuss in the derivatives chapter, expected value of spot rate and the future date, that is what gives you a forward rate. Same thing, even when you talk about buying options, right? Expected value of spot or expected value of the spot price on the day of maturity basically will help you arrive at the future rate. That is how we work out the probability. P is equal to E power RT minus D by U minus D. If you recollect this, please go back to my classes where I explain how you derive. There also we are saying expected value of future spots is equal to the value of the forward. Same way here also, the forward rate is basically the expected value of spot on that date. So expected value of spot is equal to current spot into 1 plus domestic by 1 plus foreign. Okay, next you have this second theory called purchasing power parity. So in purchasing power parity, instead of talking everything about interest rates, you are talking about inflation rates. It focuses on inflation exchange rate relationship. So in this theory, there are again two forms, absolute form and relative form. Absolute form states that exchange rate between two currencies shall be such that price of similar products in countries after adjusting for costs, etc. should be equal. So what they are saying is, spot rate is equal to some alpha. Alpha is a sectoral constant into price level in domestic market by price level. I think here it is not visible. Price level in foreign market. Price level in domestic market by price level in foreign market. So you have some sectoral constant or you have a relative form. What is relative form? Relative form is the same logic what we discussed earlier in interest rate parity theory. Expected spot rate is current spot into 1 plus inflation by 1 plus foreign inflation. So instead of talking about interest rates, we are talking about inflation rate, right? And you have third thing called international Fisher's effect. This combines both of them. What does this say? This uses interest rate rather than inflation rate differentials to explain why exchange rates change over time and is closely linked to PPP. So what it says is nominal risk-free interest rate. So you saw here current domestic interest rate in IRP theory. This is nominal. This is also nominal. What they are basically saying is this nominal contains real rate and anticipated inflation. So 1 plus nominal is equal to 1 plus real into 1 plus inflation. So they are making this statement. They are making this statement. And in this statement, what are they saying? Expected spot rate by current spot rate is equal to 1 plus domestic interest rate by 1 plus foreign interest rate. So they are saying the same thing. That is, you take this here, expected spot is current spot into 1 plus domestic interest by 1 plus foreign interest rate. Right, they were talking all about linkage of inflation and interest rate, where did it go away? So what they're basically saying is, see here, According to IFE, nominal risk-free interest rate contains real rate of return and anticipated inflation. This means if investors of all countries require the same real return, if all of them require same real return, that is in the numerator, you have 1 plus nominal India is equal to 1 plus real India into 1 plus inflation India, and denominator 1 plus nominal US is equal to 1 plus real US into 1 plus inflation US. If this is the case, if this is valid, or if this is how you look at interest rates, and if both these real rates are same, then this part gets cancelled. If then the exchange rate of 1 by nominal of India by 1 by nominal of US is same as 1 plus inflation of India by 1 plus inflation of US. So, if the real rates are same, then your nominal rates will be same as, or the ratio of nominal interest rates will be same as the ratio of inflation rates. However, we do not know exactly what the real rates are, whether they are same or not, which is why you directly take the nominal rates instead of considering inflation rates only independently. Okay, instead of considering inflation rates only independently, you take the nominal rate. So that is what they are basically saying. Expected spot rate by current spot is 1 plus domestic interest rate nominal by 1 plus foreign interest rates nominal. Now, what are the comparison of these three, the IRP, PPP and IFE? IRP focuses only on forward rate, differs from spot rate, and the degree of difference that should exist. This relates to a specific point of time. So, why forward and spot? There is a difference. How is forward spot? How is spot used to arrive at forward? PPP suggests that spot will change in accordance with interest rate inflation differentials. PPP is all about inflation. IFE, which is international Fisher's effect, suggests that it will change in accordance with interest rate differentials. IFE talks about integration of both inflation and interest rate. PPP is related to IFE because inflation differentials influence the nominal interest rates between both the countries. Now let us look at this. IRP, forward rate, premium or discount, interest rate differential, and forward rate of one currency will contain a premium or discount that is determined by differential interest rates. PPP, percentage change in spot exchange rate, and it is due to inflation rate differential. So spot rate of one currency will change in reaction to differential inflation rates between two currencies. So if you come back and look, expected spot by current spot. So in relative form of PPP, we are talking about spot, whereas in case of covered interest parity IRP, we are talking about forward rate is spot rate into something, right? We also have expected future spot, which is basically what is an estimate of the forward rate, right? Then, what is international futures effect? Percentage change in spot rate is basically interest rate differential. So, it is integrating both the above theories, and it says spot rate of one currency will change in accordance with differential interest rates between two countries. Returns on uncovered foreign money market securities will on average be no higher than return on domestic market securities from the perspective of interest in home country. That is, let's say if you are an Indian and let's say there's an American. Let's say American invests in Indian market, India is giving 9% interest rate. But after a year, when he takes back the money of that 9% interest, the rupee is also depreciated by 6%. So 9% increase in the value of the investment by 6%, which is decrease in the value of investment because of rupee depreciation. So the foreign currency, the USD investor will make same 3% if he invests in US securities, or he will make 9% minus 6%, which is again going to be same 3%. So either ways, you will make the same 3% gain. That is what they are trying to explain here. Okay. Now after having understood this, let us go and solve some problems on interest rate arbitrage, or rather IRP, PPP, or covered interest rate arbitrage, all these theories. Okay. Chalo, let's move forward. So friends, now after having understood about interest rate arbitrage, or rather the interest rate arbitrage theories, interest rate parity, then purchasing power parity, international Fisher's index, let us now look at some problems. Okay, there are a couple of problems. I'm not going to solve too many problems. In fact, the first one is, I think, problem number 17 from P600 plus. You can go and look it up. This is a problem on CAD and Deutschmark. Okay, let us see. Problem on CAD and Deutschmark, and also it is a question from study material. Okay, now, given the following information, exchange rate, CAD 0.665 per DM. So what does this mean? 1 DM is equal to 0.665 CAD, because they very clearly said per DM. Okay, so this is spot, this is 3-month forward, is how much? 1 DM is equal to 0.670 per CAD. Think of it in USD INR terms. USD INR direct quote, rupee is a depreciating currency and rupee has higher interest rate, so in rupee keeps depreciating versus dollar. Dollar is same, $1 for 85 rupees, after 1 year $1 for 90 rupees. Okay, same logic works here. What is it? It is depreciating, meaning the interest rate of Canadian dollar or Canada interest rate should be higher. So what are the interest rates? Deutsche Mark is 7%, Canadian dollar 9%. Exactly what I was saying. The Canadian dollar is having 9%, or rather Canada is having 9% interest rates, and Deutsche Mark is only 7%. What operation should be carried out to take possible arbitrage gains? So this is based on interest rate arbitrage. You know, the covered interest arbitrage is possible here. Right? How is it possible? We'll see. But first you have to understand this logic. That is 7%, 9%, and there is a depreciation. Let us see what is the implied depreciation. So, and again, I'm not solving it from exam perspective, step by step. That solutions are there in the material, or rather in the notes that I've given, or in the videos. What I'm going to do is try and explain to you the logic. Okay? Implied depreciation of CAD. What is implied depreciation of CAD? 0.670 minus 0.665, this is how it is depreciating, on 0.665, that is the base, and it is depreciating, this depreciation is happening over 3 months period. So into 12 by 3 into 100, this will give you in percentage terms. So what is the number? 0.005 divided by 0.665 into 4 into 100 is how much? 3.0075%. Right? 3.0075. You may round off to 3 also, that is fine. But typically, you know, if I get something, I typically keep 4 decimals everywhere. It solves all confusion. So this is the implied depreciation. Now, what should be the ideal depreciation based on interest rates? What are the interest rates? 7%, 9%. So ideal depreciation should be 1.09 divided by 1.07, and I am computing this per annum. Please note per annum. I am not looking at interest rates, always have to be looked at per annum. 1.09 by 1.07 minus 1. As I told you, don't subtract 9 minus 7 and say depreciation should be 2. Okay. You get 1.87% or 869%. So I'll put 1.87%. So ideal depreciation is this. Ideal depreciation is this. Actual depreciation is this. Now, what is the story here? In any of the arbitrage scenarios, please always remember one simple logic. Whatever is costly, sell. Whatever is cheap is buy. Okay, that's the easiest way to remember. Now, here whatever is costly, this is costly. That 3% is higher than 1.87, no? So sell. And 1.87, which is cheaper, so buy that. Buy cheap, sell costly, or sell dear. That is where you make money. Okay. Now, in this context, what do you mean by buy cheap, sell dear? Buy cheap, sell dear means there are 2 ways to look at it. Okay, and I'll explain both the ways. So, if you from a currency, or rather from a perspective of money, buy cheap, sell dear means borrow cheap, lend costly. So, borrow cheap and lend at higher rate, right? From a money perspective, this is same as buy cheap, sell dear. It's called dear. Dear means higher value. Okay, so you have 1.87 is what rate at which you should borrow, and you should lend it at a higher rate. What does this mean? If you have to borrow at 1.87, it basically means that your ideal depreciation is lower. Actual what is indicated by forward currency or forward rates is higher, because over a long period of time your markets will revert to the mean, or they will revert to the ideal situation. This 3% will ideally likely come down on the after 3 months. This 3% may come down to 1.87. They may, okay, they may come exactly to 1.87, below 1.87, above 1.87, but on a long term sustainable basis, they will revert to the mean. So this 3 will come down to 1.87. If the ideal depreciation is going to be 1.87, then this 6.7 what you got as 3 month forward, that will not be the spot on the due date. Spot will be slightly lower than this. What will the spot be? You can actually compute what is the ideal spot also. Ideal spot after 3 months is 0.665 into 1.87% divided by 4 plus 0.665. It will be 0.6681. So ideally it will be that rate. So instead of you entering into a contract where it is 0.670 3-month forward, the 3-month forward, even though the forward rate is that, the spot on the due date will come down. So you basically have to enter into a contract wherein on that day you are selling at 0.670 and buying in the market at 0.6681. That is the end goal. That is one way to look at it. Other way I said is borrow cheap and lend at higher rate. So borrow cheap and lend at higher rate, how it works is, if forward premium greater than interest differential is greater than interest differential, then borrow domestic, invest abroad. That is outflow. If forward premium less than interest differential, then inflow, that is borrow abroad and invest domestic. In our scenario, in our case, what is the scenario? Forward premium is greater than interest differential. So there is an outflow, that is you borrow domestic, invest abroad. And when you say borrow domestic, invest abroad, here please think of it as you have a direct quote where USD CAD or USD INR. Think of everything in USD INR terms. If forward premium rupee dollar is 10%, whereas the interest differential is only 5%, then you borrow in India and invest outside India. Why? Because you can enter into a transaction to sell foreign currency at a much higher premium than what ideally it is supposed to be. You borrow in India, move it immediately to dollar, when it comes back, you sell back the dollar at a much higher rate. So that is the logic for this particular statement, right? In this context, for USD, for DMCAD, in this context for DMCAD, that is per 1 DM how many CAD? You borrow in CAD. So you borrow in CAD. This is one way to remember, okay? These two statements, this is one way to remember. What is the second way? Buy cheap and sell dear. What do you mean buy cheap, sell dear? What is costly? What is not correct? What is not correct, and what is not correct? Is it higher or it is lower? See here very clearly the 0.6681 is correct, but what is not correct is 0.670. Is 0.670 higher than 0.6681 or less than 0.6681? It is higher than 6681. So 670 is higher and it is wrong. So what is wrong, and if it is higher, sell it. If what is wrong is lower, then buy it. That is second way to look at it. So if you have to sell Deutschmark at 0.670 CAD, right? You have to sell a Deutschmark at 0.670. That is, you have to enter into a contract today to agree to sell one Deutschmark after 3 months at 0.67 CAD. I am explaining both the methods, okay? Sell Deutschmark today using 3-month forward at 0.670 CAD per Deutschmark. What does this mean? This means that today you are entering into a contract wherein after 3 months you will deliver a Deutschmark and get 0.670 CAD. So 0.670 CAD, you will deliver one Deutschmark after 3 months and get in return 0.670 CAD. If you have to get something, if you are going to deliver Deutschmark after 3 months, you should have Deutschmark after 3 months, no? If you don't have Deutschmark after 3 months, how will you deliver it? So you first need to get a Deutschmark after 3 months, which you can deliver using this forward contract. How will you get a Deutschmark after 3 months? There has to be a deposit of Deutschmark somewhere which will mature after 3 months. If you have to have a deposit of Deutschmark which will mature after 3 months, you have to place a deposit today. You have to place a deposit today. If you place a deposit today, that will mature after 3 months. You have to place a deposit in Deutschmark. If you have to place a deposit in Deutschmark today, you don't have Deutschmark. So what you will do is you will borrow in CAD, convert it into Deutschmark and place that Deutschmark in a deposit which will mature after 3 months, which you will get after 3 months, which you will sell again at 0.670 and get the CAD in return. So I'm writing down the steps. First, borrow in CAD, convert to DM, this I will say day 0, okay. Then deposit in DM day 0. Then deposit maturity 90 days in DM, right? Everything is in DM so far. Then sell Deutschmark using forward after 90 days. Get CAD in return after 90 days. Then pay back or repay the loan. CAD loan after 90 days. So you see, this borrowing in CAD, what you did is getting knocked off here. Then you may be left with surplus. On 90th day. So this is one way of looking at it, and I actually am more logically inclined towards this. Okay, because for a lot of students I have discussed this. If forward premium is greater than interest differential, then it's an outflow. People actually get confused when you make statements like this. Okay, for some of you may be easy to remember and all of that, but I typically believe that if you have a logical method, follow this logical method so that you don't miss any steps, because anyway you are having to do this logic when you are going to solve the problem. Okay, so let us see how you solve the problem. We take any random number, $1,000, borrow 1000 CAD. At what rate? At 7%. No, at 9%. CAD is 9%, at 9%. Okay, this is first step. Then convert to Deutschmark. Okay, convert to Deutschmark. Convert to Deutschmark at what? At spot. So what is Deutschmark and this spot rate? 0.665. So you convert this into 0.665. 0.665 Canadian dollars per Deutschmark. So what will you get? 1000 CAD by 0.665. 1000 CAD by 0.665. That gives you 1503.76 Deutschmark. Deposit 3 months DM. Okay, so 3 months. Then enter into 3-month forward to sell DM. Okay, at 0.670 for X DM. How many DM we will see. Now 1503.76 DM you deposit. Okay, at what rate? At 7%. Into 7% by 4 plus memory recall 1503. So the deposit maturity amount 1530.075. So for same value you enter into a forward contract today. So 1530.075. Okay, so you enter into a 3-month forward contract to sell DM at 0.670 for so many Deutschmark. 0.07 CAD per DM for so many Deutschmark. Now after 3 months, get deposit maturity amount, which is 1530.075, which is 1530.075 Deutschmark. Convert to CAD at 0.670. So we get into 0.670, you get 1025.15 CAD. Okay, then repay CAD loan. How much was the loan? 1000 CAD plus 9% for 3 months. So 1000 into 9% divided by 4 plus 1000. You get 1022.5 is a CAD loan. Repay. Balance money left 1025.15 minus 1022.5. So you are left with 2.65 CAD in hand. So by doing this entire list of transactions, you have made arbitrage profit. This is covered interest arbitrage. Why? You have covered your foreign exchange risk by using a forward contract, and you have ensured that you have made a gain. So whenever there are these interest rate differentials and not matching with the forward premium, if the forward premium is greater than interest differential, so as I said, think of India perspective, forward premium is 10%, whereas ideally it should only be 2%. So you will take advantage of that higher forward premium. If you want to take advantage of that higher forward premium, you have to enter into a contract. So if you have to enter into a contract, either one way to look at it is you sell the forward premium. Basically, you sell a contract so that you get the premium. That is one way to look at it. Or the other way, which is what I did here in this entire exercise. Okay. Or the other way to look at it is there has to be an outflow. Borrow domestic and invest abroad. Borrow domestic and invest abroad. Why? Because why are you investing abroad? Because if you invest abroad, you can get the money and take advantage of this higher forward premium by entering into a forward contract. So if the premium is higher, invest abroad, there is an outflow. If the premium is lower, invest in India. Why will you invest in India? Because you can borrow the money from outside and enter into a contract to repay it at a lower premium. So basically both of these are same. It is just that the way to look at it, and some people try and remember this logic. I would rather actually go by this full-fledged logic where I don't make a mistake. Okay. So if you want to remember this logic, please feel free to remember premium greater than differential, P greater than I, borrow domestic, PIBD, or P less than I, borrow foreign. Okay. So P greater than I, borrow domestic, P less than I, borrow abroad. Okay. Yeah, borrow abroad or borrow foreign. PGIBD. Okay. PGBP you can use probably to remember that. PG, premium greater than interest, right? Premium greater than interest, BD, PGIBD. Okay, if you want to remember it, this is one way to remember it. Premium greater than interest differential, borrow domestic. Okay, PGIBD. This is one way, one mnemonic. Okay, if you want to remember, or use this logical approach. I use logical approach. Okay, fair enough. Now let us move to the next problem. We have finished problem number 17, right? Then we will now move to problem number 22. Okay, what is problem number 22? So friends, now let us look at this question, question number 22. This is also very similar to what we solved earlier, P600 question number 22. Following are the rates quoted on Mumbai for British pound. Spot is 50 to 60 by 70, interest rates India, London, 3-month forward is 20 by 70. Now, what is you mean by 3-month forward? Is it directly are they giving the last 2 digits, or they mean these are the swap points? I think these are swap points because you have to add them. 3-month forward and 6-month forward, I think you have to add 60 to 20 and 60 50 you have to add. They have given both bid and ask, and they have given 3-month, 6-month interest rates 8%, 10%, 5%, 8%. India is higher than London, so Indian rates are India's interest rates are higher, so rupee will depreciate. Because rupee is depreciating, these have to be added. So that so far that logic is good. Verify whether there is scope for covered interest arbitrage if you can borrow in rupees. So they themselves are saying you have to borrow in rupees. If you are borrowing in rupees, is there any scope for covered interest arbitrage? What was the logic that we learned? P greater than PGIBD, right? PGIBD. So premium greater than interest differential, borrow domestic. So here they are saying borrow in rupees. So is premium greater than interest differential? See, the problem in this question, no, if you go by this approach of looking simply at the PGIBD and then respond, they've given both bid and ask. Will you take average of bid and ask and then figure out? No, you cannot do that. So you have to actually solve the problem. So how do we solve the problem? Let us see. And you have to solve this both for 3 months and 6 months perspective. And they themselves have said borrow in rupees. So borrow, let us take how many rupees? Borrow equivalent of 1,000 pounds in rupee terms. What is 1,000 pounds on spot? 50 to 60. Now, what happens is, are you supposed to borrow at 50 to 60 or 50 to 70? See, what are you going to do? If you are going to borrow money in rupees, you are going to invest in pounds. If you are going to invest in pounds, you are going to buy pounds. So, if you are going to buy pounds, bank is going to sell pounds. If bank is going to sell pounds, bank will buy the base currency at bid. So, they will sell the base currency at ask. So, the relevant quote here is ask. So, you have to borrow 52.70. So 52.70 into 1000. So borrow this much amount of money. That is how you arrive at 52.7. So 52.7 into 1000 is what? 52700. So 52700. 52700, right? Then borrow at what rate? In India, the rates are 8% and 10%. At 8%, at 10%. For how much? For 3 months, for 6 months, correct? So, what will be the loan repayment due? 52,700 into 8% divided by 4 is equal to plus 52,700 is equal to 53,754, and 52,700 into 10% divided by 2 is equal to plus 52,700. Loan repayment will be 55,335. So these are the two amounts that you have to repay. Now, once you have borrowed, convert to GBP. How will you convert? You will buy pound. If you are going to buy pound, the ask quote is relevant. Convert to GBP, you get 1000 GBP. Correct. What are you converting this? For 52,700, this 52,700 you are converting. Then invest in GBP deposit for 3 months at what rate? 5% and 8%. At 5%, 3 months, 6 months at 8%. So 1000 into 5%, 1000 into 5% is 50, 50 by 4 is 12.5. Okay, 1000 into 8% is 80, 80 by 2 is $40 pounds. So what have I computed? I have computed the, what have I computed? I have computed the interest accruing on deposit, right? So at maturity, GBP amount is how much? Plus this 12.5 and here 40. So 1012.5 and 1040. Then convert GBP to INR. At what rate? After 3 months, what is the rate they have given here? Right. Now, what rate will be applicable? Will it be bid or ask? You know, you have pounds, you are selling it to the bank. Bank is buying, and bank will buy the base currency at bid. So the relevant quote is this 20. Relevant quote is 20. Please don't directly take 52.20. Please take this quote of 52.60 plus 0.2 at 52.80. Then in second case, what is it? It is 52.60 plus 50, so it will be 53.10. So amount of INR available. Amount of INR. How much is the amount of INR? 1012.5 into 52.8. You get 53,460, and 1040 into 53.1 is 55,224. So this is the amount of INR you will get, less loan repayment. What is the loan repayment? You have borrowed here, no? You have, where is this? 53,754, 55,335. 53,754, 55,335. So you will get 55,224 minus 55,335. You will get minus 111 rupees, and 53,460 minus 53,754 minus 294. Right. In both cases, you actually made a loss. You made a loss. So you actually have to work this out. See, had they given simply only one quote instead of bid and ask, I could have easily computed using this logic. But even then, in exam, I don't think any examiner or any evaluator will give you marks if you just say, you know, premium greater than interest differential, then borrow in domestic currency, so premium is greater or premium is not greater, and hence do this or do that. If you give such kind of statements, I don't think the examiner is looking for that. They are looking for a working like this. So please do the full working and say that you have got a loss. As there is a loss by borrowing in rupees and investing in pounds, there is no possibility of covered interest arbitrage by borrowing in rupees. Is it available if you borrow in pounds? It may be or may not be available. We have to check clearly because there are bid and asks of quotes available. You have to work backwards. It is exactly not opposite. Okay. Please don't think that is ulta of this, because there are bid and ask rates for forex that are given. You have to whatever borrowing you do, you have to use the relevant rate and then again check. It is not a simple straight working. Okay, fair enough. We have covered these two questions, and we have also finished this interest rate parity or covered interest arbitrage theory. Now let us move to the next aspect, which is where you have to evaluate whether you have to borrow in USD or you have to borrow in dollar, or what is it that you are supposed to do. So these are questions number 30 and 41. Let us go to them. So friends, now let us look at this point. This is question number 30, not 31. I'm sorry. This is question number 30, and this is on borrowing in rupee or dollar or any other currency, rupee versus some other currency, or between any two currencies. How do you evaluate? An Indian company obtains the following quotes. Rupee dollar spot is 35.90 by 36.10. 3 months forward rate is 36 or 36.25. 6 months forward rate is 36.10 and 36.40. Okay, everything is at a premium, so no problem. The company needs dollar funds for 6 months. Determine whether the company should borrow in rupees or dollars. Now, this entire 3-month data what they have given is irrelevant. What is relevant is only this 6 months data for the first part of the question. Given 3 months interest rates are so and so, 6 months interest rates are so and so. For rupee, this is the interest rate, dollar is the interest rate. Please note, interest rates are always per annum. Also determine what should be the rate of interest after 3 months to make the company indifferent between 3 months borrowing and 6 months borrowing in case of rupee borrowing or dollar borrowing. Okay, we will come back to the second part of the question later. First, let us look at the first part of the question, which is, if the company needs for 6 months, you should borrow in dollar or you should borrow in rupees. Okay, should you borrow in dollar or should you borrow in rupees? So let us see. Okay, given the 6 month interest rate and 6 month forward rate. So I will write down the basic points. 6 month spot, 6 month, then interest rate. Spot is how much? 35.90 by 36.10. Six month is 36.10 by 36.40. Then borrowing in rupees for 6 months is 11.5. Because that is the question, right? The question is, the company needs dollar funds for 6 months. Determine whether you should borrow in dollar or rupees. Okay, 11.5 rupee and dollar is 5.5. Okay, these are again per annum basis. Okay, now with this, you are supposed to determine whether you should borrow in rupees or you should borrow in dollars. You need 6 month money. Okay, so let us see how to solve it. First, we'll do USD borrowing. USD borrowing $100. Okay, so if it is $100, you borrow for 6 months. What is 6 months interest rate for $100? They have given as 5.5%. 5.5%. See, you have a requirement in which currency? You have a requirement in dollar. A requirement is in dollar. So you borrow in dollar directly. So interest is equal to $100 into 5.5% into 6 by 12. So that is half of 5.5, which is 2.75%. So dollar repayment is $102.75, correct? If you borrow in dollars, right? So you have to repay. So you have borrowed 102.75. So you borrowed 100 and you're going to repay 102.75. But you are an Indian company. You don't have this money in dollars. Your requirement was in dollars. But after 6 months, when you make the repayment, you have to repay dollars. But for that, you have to buy dollars. So you'll have to buy 102.65. So let us say you enter into a contract today itself using this forward rate. What is this forward rate? Forward rate 36.10, 36.40. Today itself, you enter into a contract to buy. You have to buy means the bank has to sell. Bank has to sell means ask rate. So 36.40 is the rate at which you will enter into a contract today for delivery of $102.75 after 6 months. So rupee repayment after 6 months, assuming a forward contract is entered into today, is that is at 36.40, no? That is what is the number they gave, 36.40, yes, is 102.75 $102.75 into rupees 36.40 for 1 USD. So this gets cancelled. You will get 36.4 into 102.75. You have to repay INR outflow 3740.10. Okay, this is first case. Case 2 is what? Rupee borrowing. So what is the second case? Rupee borrowing. What do you mean by rupee borrowing here? You borrow in rupees. How much? Equivalent to $100. Right? So you borrow in rupees today itself and convert it into dollars. So you will convert into dollars at what rate? You will buy today dollar, which will be at 36.1, and you keep the dollars, and because you are supposed to make some payment in dollars, you're borrowing it in rupees and converting it into dollars right away and making of that payment, and the rupee borrowing you will repay. So what it means is equivalent to $100. What is $100 equivalent today? You borrow 3610. How did I get 3610? $100. Okay, you borrow some amount, convert it into $100 and make the dollar repayment. That is what they mean. So if you have to make $100 ka repayment, you need $100 in hand. If you need it in hand, you need to buy dollars. If you are buying dollars, what is the quote? Quote is the ask quote. What is quote for ask quote and spot? Spot here is 36.1. So you borrow 3610 rupees, convert to dollars, pay off dollar liability, whatever that liability is, and after 6 months repay rupee loan. So 3610 into what is the rupee borrowing rate? Rupee borrowing rate is 11.5%. into 11.5% into 6 by 12. What does that get us? 3610 into 11.5% by 2. That gets us 207.575. So if you add these two plus 3610, rupee repayment is 3817.575. Now you see here, if you are borrowing in rupees and paying off your liability, dollar liability today itself, you have to pay after 6 months 3817.575. Whereas instead of that, you borrow in dollars, use that dollars, whatever you borrow, to make a repayment of your dollar liability, and the dollar liability, and you keep that dollar borrowing that you have made with you, and on the due date, you remit INR, or you exchange INR and get dollars and make the dollar repayment, right? And on due date, you exchange your whatever rupees that you have and buy fresh dollars and make the loan repayment. So in that case, you are incurring how much? 3740.10 in rupee terms. So 3740 is less than 3817. So dollar borrowing is cheaper. Dollar borrowing is cheaper. Is that the question that they've asked? The company needs 6 months. Determine what rate of interest. No, the question that they've asked is company needs determine whether company should borrow in dollars or rupees. So you need to very clearly say you need to repay. You need to borrow in dollars because the total outflow is only 3740.1 after 6 months in rupee terms if you borrow in dollars compared to rupee terms where it is 3817 compared to rupee borrowing where it is 3817.575. Okay, this is the first part. What is the second part of the question? Second part of the question is also determine the rate of interest after 3 months to make the company indifferent. So after 3 months, indifference rate between 3-month and 6-month borrowing for rupee and for dollar. So for rupee, what is the rate? So this is a bootstrapping concept, what you have learnt in fixed income chapter. Rupee, what are the borrowing rates? 3-month, 6-month. 3-month is 12%, 6-month is 11.5%. Correct? So it's a downward sloping yield curve. So what is month 4 to 6? Right? So 1 plus 12% into 3 by 12 into 1 plus x percent into 3 by 12. Now this is for first 3 months. This is for second 3 months is equal to 1 plus 11.5% into 6 by 12. Okay. So, first 3 months this is the rate into second 3 months rate, okay, will give you the overall 6 months rate. This is how we did bootstrapping even in case of fixed income chapter. Please recollect that. So, 12% into 3 by 12, that is very simple. 1.03 into 1 plus x% by 4 is equal to 1.0575. 0575, yeah, 0575. So, 1 plus x% by 4 is equal to 1.0575 by 1.03. One plus x% by 4 is equal to 1.02669, or x% is equal to 0.02669 into 4. So, x% is equal to 10.679, so 68%. So, x% is equal to 10.68%. This is the answer. So, this is the rate that will make you indifferent, because what is the specific question that they have asked? What should be the interest rate after 3 months to make the company indifferent between 3 months borrowing and 6 months borrowing in case of this? So, whether you borrow now for 1 3 months lot and again refinance it to another 3 months borrowing, or make a full 6 months borrowing, in case of rupee, if the rates are like this, rates are like what? First 3 months 12 months, second 3 months 10.6 months, both combined together, you will arrive at 11.5%. So, either ways, either you borrow a full 6 month rate or do it in 3 months and then refinance with another 3 months, both the ways outflow will be same. Same thing you have to do for dollar. What is 3 months rate? 3 months rate they have given is what? 3 month rate is 6% and 6 month rate is 5.5%. Right, same logic, which is 1.1 plus 6% into 6 by into 3 by 12, this is 3 by 12, right, into 3 by 12 into 1 plus y% into 3 by 12 is equal to 1 plus 5.5% into 6 by 12. So, this will be 1/4 of 6. So, this is 1.015 into 1 plus y% by 4 is equal to 1.0275. Okay, I am converting directly percentage into decimal. So, 1 plus y% by 4 is equal to 1.0275 by 1.015, or y% by 4 is equal to 1 plus y% by 4 is equal to 1.0123, or y% is equal to 0.0123 into 4, or y is equal to, that is equal to y is equal to 4.93%. 4.93%. So, 4.93% is the rate at which 3 months for borrowing from month 4 to month 6, at which if you borrow first for 6% and next 3 months for 4.93%, or you borrow for the entire 6 months period at 5.5%, the interest expenditure that you will incur will be same. Okay. So, this is problem number 30. Next, we will go and look at problem number 41. Okay. This is question number 41 from P600 plus. Okay. This is again also is a similar problem on whether you are supposed to borrow in USD or INR or from the supplier, or what you are supposed to do. Z Limited importing goods worth $2 million requires 90 days to make the payment. They require 90 days. The overseas supplier is offered a 60 days interest-free credit period, and for additional credit period of 30 days, an interest of 8% is charged. So, first 60 free, then extra 30 days, 8% per annum. Please note here this 8% per annum is on foreign currency. It is not on domestic currency, it is on foreign currency, because you are liable or due to make the payment to the foreign supplier in foreign currency. The bankers of Z Limited offer a 30 days loan at 10% per annum, and their quote for foreign exchange rate is as follows. So, this is a 10% per annum is in INR. Okay. Now, what are the quotes? Spot for 1 USD is 56.5, 60 day forward is 57.10, and 90 day forward is 57.50. we require to evaluate the following options. First, pay the supplier in 60 days or avail the supplier's offer of 90 days credit. So, whether you are supposed to make the payment to the supplier in 60 days, in which case what will you do? You will make payment to the supplier, but because you don't have the money, because you need a credit period of 90 days, you will borrow for the next 30 days from the Indian bank at what rate? 10% per annum. Whereas you will make payment directly in the foreign currency and you will make it at that extra 30 days at 8%. So, let us see how you will solve this particular problem. One, option A, pay supplier in 90, in what is, they said 60 days, my bad, in 60 days. Pay the supplier in 60 days. So, in this case what will happen? What is the total value? $2 million. Pay on day 60. So, use forward to hedge. So, applicable, that implies applicable rate is, what is 60-day forward? You have to make the payment to the foreign supplier in 60 days. So, you will 60-day forward is 57.10. There is no beta, so don't complicate it. So, the rate is 57.10. 57.10. So, payment made in INR on day 60 is equal to 2 million. A million is 6 zeros into 57.10. That will be 11 crores 42 lakhs. Then you don't have money to make payment. So, borrow 11.42 crores rupees from bank at 10%. That is what they said, right? Bank is willing to lend you for 30 days a loan at 10%. So, you borrow this for 10 days, for 30 days at 10%. So, into 10% into 30 divided by 365. Did they say anything about the day count? 30 divided by 365. So, add interest 11.42 CR into 10% into 30 by 365. That is equal to 9,38,630. Okay. So, amount of outflow on day 90 is equal to A plus B, which is 11 crore 51 lakh 38,630. So, this is the amount payable after how many days? After 90 days under option 1. Now, what is option 2? Avail the suppliers of 90 days credit. So, 2 million 60 days no interest. Last 30 days interest at 8% per annum. So, here this interest is on foreign currency amount. So, 2 million into 8% into 30 divided by 365. So, 2 million, you have to compute everything in million, in USD only, 2 million into 8% into 30 divided by 365. 13,150.68 is the interest. So, net amount payable after 90 days to the supplier is equal to 2 million plus 13,150.68. Okay, and 90-day forward rate. Because you are going to make the payment on 90th day, you assume for making supplier payment, okay, what 5750 I think, no, 5750, yes, 5750 is what they said. So INR amount payable, INR payable is equal to 2,2013,150.68 into 57.5. That is equal to 11 crore 57 lakh 56,164.38. So now you see, where are you making higher amount of payment? It is very, very clear. Here 11 crore 57 lakhs, 11 crore 51 lakhs. So it is advisable to borrow from Indian Bank at 10% for 30 days instead of availing supplier credit. Okay, so this is the thing. Now from a purely understanding perspective, I will tell you something else, which is very, very simple. See, foreign currency borrowing rate is how much? Foreign currency borrowing rate is 8%, INR is 10%. If foreign currency borrowing plus depreciation is less than 10%, that is 8 plus rupee depreciation. What is rupee depreciation for this 1 month? It is depreciated by 40 paisa, 5710 to 5750. So 0.4 divided by 57.1, and this into 100 you will get in percentage term. This you have to multiply by 12, because for 1 month it is depreciating by this much. So it is 8.4%. So what is happening? Rupee is depreciating by 8.4. On top of that you are paying 8. So total interest that you are paying is 16.4 compared to 10% which you pay. If you were to just make a rupee payment. So this is a logical way. This is how actually I used to do when I was dealing with similar kind of situations in my earlier organization. So we would actually compare the premium percentage, add to that the foreign currency cost of borrowing, compare that with the domestic cost of borrowing, and see which one is higher, and then take a decision. Okay, now we have finished question number 41. The next question that we are supposed to do is, if I am not wrong, is question number 98. Let us go to question number 98. So friends, now let us go to this question number 98. This is again part of P600 plus, and this is a continuation of the previous kind of problems, but there is a twist. That is, instead of looking at purely borrowing in USD or INR or supply financing, we also add a LC element in this. And this question was asked, if I am not wrong, in May 22. So friends, if you in fact look at last 3-4 years question papers, right, most of the questions either dealt with something like this kind of LC plus supply financing, or a fate forward contract, or some kind of options. They have not been asking very simple questions. They have been asking questions where there is some amount of effort and working that is involved. Okay, so this kind of question assumes importance in that particular context. So let us read this question. Mrs. Daksh Limited is planning to import multipurpose machines from USA at a cost of $15,000. The company can avail loans at 19% interest per annum with quarterly rest with which it can import the machine. What are they saying here? What loan is this? This is a rupee loan or dollar loan? This very clearly is a rupee loan. However, there is an offer from a New York branch of an Indian-based bank extending credit of 180 days at 2% per annum against opening of an irrevocable LC of credit. So if you open an LC, after the LC period is over, I will extend you additional credit. That is called buyer's credit. And supplier's credit is one where within the LC period itself, you will integrate the financing component, that is called supplier's credit, or sometimes it is also called as seller's credit. I have explained this in the full-fledged classes. Now what are they saying? Spot rate is 75, 180 days forward rate is 77, commission charges for an LC are 12% per annum. Justify why the offer from the foreign bank should be accepted. Based on the present market condition, if the company is not interested in taking the risk of currency fluctuations and wanted to hedge with an additional expense of 30,000, if so, what is your advice? So the question is about what credit period? Question is about 180 days credit period, because everywhere they have been using the word 180. Right now, within the LC period itself, they extend you credit, which is what I called as which is what I told you as seller's credit or supplier's credit. So you open an LC, within the LC period, for the LC you pay commission independently, and commission is always paid upfront, please remember this. And in addition to that, you also add a credit cost of 2%. But again, whenever you do any foreign currency borrowing and related trade, the cost, the 2% is on foreign currency amount and not the rupee amount. Please remember that. Okay, and they've given 180 days rate as 77. What is your advice? Okay, so let us see. Evaluate the first option, and they've also said assume 360 days in a year. So that is makes life simple. You need not do 180 by 365 and all that weird working. The cost of the machine is $15,000. Okay. Okay, then they're saying spot rate is 75, forward rate is 177. So if you take, what is the use of the spot rate? Basically, you are buying dollars and paying off the supplier and availing complete credit from the bank. Company can avail loans at the rate of 19% interest per annum with quarterly rates with which it can import the machine. So you, instead of borrowing in dollars, you're borrowing in rupees. So if you're borrowing in rupees, it is 19% with quarterly rest. Please note the word quarterly cost or quarterly rest, interest cost INR 19%, right? Spot, what did they give as spot? Spot is 75. So today itself you purchase a foreign exchange, you make payment to the supplier, but for making that payment you borrow, and borrow in rupees. Okay, so amount of, or rather foreign currency payment, 15,000 into 75, it comes to what? Comes to 11,25,000. Then interest cost for quarter is for how many days? 90 days, right? 3 months make a quarter. So here they've said use 360-day convention. So you have 2 quarters. For 2 quarters, so quarterly interest is equal to 19% by 4. That makes it 4.75% per quarter. So quarterly interest cost is equal to 11,25,000 into 1 plus 4.75% whole power 2. Why whole power 2? Because it is for 2 quarters into 1.0475. So that makes it rupees 12,34,413.28. So this is your total cost including interest. Import plus interest cost, both put together. Okay. Next, if this is the borrowing from Indian bank, cost of borrowing from what did they say? They said a specific word, no? From New York branch of India Bank for 180 days. Right. So $15,000 first open LC for 180 days. LC charges is how much? They said 2%. So 2%, and this also please note LC charges are debited today. See, please note one more thing in this kind of questions. No, the ideal way to respond is everything you have to compare for a same date. So here all this cost, when I say same date, you either have to do everything on day 0 or everything on day 180. So if there are any costs that are incurred in between, you have to arrive at forward value or rather future value of those costs. So here this cost is on what? Day 180. Right. So LC charges debited upfront, that is equal to 15,000 into 2% into 180 by 360 into, because 2% is per annum, into 75, because LC is for $15,000, dollars today's rate, the day when you open LC, 75. That is how you do it. So 15,000 into 75 into 2% divided by 2, that is equal to 11,250. But this 11,250 is day 0. you actually have to compute future value of 11,250 as on day 180, because you can't have some costs on day 0, some costs on day 180, everything has to be at day 180, right? So that is equal to 11,250 into 1.0475, which is the Indian borrowing rate, which is what we computed here, 19% by 4 whole square. That is equal to rupees 12,344.13. Okay, this is number 1. Number 2, what are the other costs that you are making payment or that you are incurring? They have said what, 2% per annum, credit cost. And there they didn't say it is quarterly rest, only for Indian borrowing they said quarterly rest. 15,000 into 2% into 180 by 360. That is what LC, this is the borrowing cost against the LC. This you will pay on the due date only. So this you need not do forward value, but you should multiply it with some other rate. What is that rate? Future rate. 15,000 into 2% into 0.5. That is equal to $150. And what is the forward rate? Forward rate is equal to where is that? 77. So interest cost is equal to 150 into 77. That is equal to rupees 11,550. Then third part. What is the third part? Amount to be paid after 180 days at 77 is equal to 15,000. You have to pay the basic amount, no? Whatever is the cost of the machine, that also has to be paid. That is equal to 15,000 into 77 is equal to 11,55,000. So total cost of foreign currency borrowing is equal to 1 plus 2 plus 3. That is equal to 11,55,000 plus 11,550 plus 12,344.13. That makes it 11,78,894. Now, what is cheaper? 11,78,000 or you have this amount. Where is this? 12,34,000. Which is cheaper? 11,78,000 is cheaper. So, what is the question that they have asked? Question is very, very specific. Justify why the offer from foreign bank should be accepted. Offer from foreign bank should be accepted because the cost of borrowing from foreign bank is cheaper than making any domestic borrowing. Very, very simple. Now, you have to write that answer. Again, as I am repeating multiple times, I am not solving this from exam perspective, I am solving this from understanding perspective. So, which is why some steps you may sometimes feel that I have missed. I have tried not to miss any steps, but generally I am saying. So, because cost of foreign currency borrowing is cheaper by how much? 11,78,894 minus 12,34,413 by 55,519. It is advised that Daksh go with foreign currency borrowing. Now, what is the second part of the question? Second part of the question is, based on present market conditions, the company is not interested in taking the risk of currency fluctuation, wanted to hedge with an additional expense of 38. So, if the cost of hedging is 30,000, what is your advice? Even if the cost of hedging is 30,000, this 12 lakh will remain the same. This 11 lakh 78 will go up by 30, it will become 12 lakh 18,000. Even then, so this difference will come from 55,000 to 25,519. Why? Because if the gap is 55,000 and cost of the cheaper option is going up by 30,000, obviously this gap will come down to 25,900. So, you say even after considering hedging cost, foreign currency option is better. You have to write as it is still cheaper by 25,519 rupees. Okay. So, this is the answer to this question. This is question number 98. This is that whole LC wala thing. Now, after this, we will move to money market hedging and comparison of various kinds of hedging, forward contract, options, money market, no hedge. Okay, we look at this question number 73. It's an interesting question. Let's go there. Let's move to question number 73. What is this 73? This is a question that is money market hedge plus forward options and bunch of those. Let us look at this. And I think this is also an exam question. I think this is May 19 question. Sun Limited, an Indian company, will need $5 lakh in 90 days. In this connection, the following information is given below. Spot rate is 71 rupees per dollar. 90 days forward rate of $1 as on today is 73. 90 days forward is 73. Interest rates are as follows: USD, India deposit rate, borrowing rate, they are given. A call option on $1 that expires in 90 days has an exercise price of 74. So, strike price of 74 and premium of 10 paise. Sun Limited has forecasted the spot rates for 90 days as follows. Probability 72.5, 73, 74.5. Sorry, future rate 72.5, 73, 74.5. Probability 25, 50 and 25. Which of the following strategies would be most preferable to Sun Limited? Forward contract, money market hedge, an option contract, or no hedging? Show your calculations in each case. So, you have to figure out, or rather you have to compute what is the overall cost that you will incur as what is the outflow for this company if it does a forward contract, if it does a money market hedge, or if it does a option contract. Okay, there are no other costs associated with them in terms of any present value, future value. So, it's a simpler one to that extent. Let us go ahead and solve this particular question. First, forward contract cost. How much is it? See, first of all, amount is $500,000. Amount is $500,000. Then forward contract 90-day forward is 73. 500,000 USD at the rate of rupees 73 per USD. Okay, so USD cancel, you multiply. Total payable if a forward contract is entered into. Total payable after 90 days is equal to 36 million. So, that is 3 crores 65 lakhs. Okay, this is first part. Then what is the second part of the question? Money market hedge. What is a money market hedge? Money market hedge is one where you basically, instead of directly buying dollars, so here what have you done? You have agreed to buy dollars after 90 days at 73. Instead of buying dollars later, what you will do is, you will do a mix of rupee borrowing or rupee deposit and foreign currency borrowing or foreign currency deposit. So, there are these 4 transactions. Out of these 4 transactions, you will choose to, that is either you will borrow in rupees and place it in an USD deposit, or you will borrow in USD and place it in an INR deposit. So, one of those things you will do, and eventually using this interest rate differential, you will gain or make gains or losses. You will make some interest payments on your borrowings and you will make some interest gains, or rather interest income you will get on deposits that you make. Using this, instead of entering into a direct forward contract, you borrow money in one currency, deposit in another currency, and you get foreign exchange at the end of the period. So, what do you mean by money market hedge in this context is, you need on the last day, you need 500,000 USD. This is the money that you require. You require 500,000 USD in hand on which date? They said some days, no, 90 days, no? After 90 days. So, if you require this much, then you would have actually placed a deposit of USD, some deposit, such that along with the interest, you get 5 lakh amount as $5 lakh as the maturity value. So, deposit plus interest. Interest, what is the USD interest rate? USD depositing rate is 2.5% plus 2.5% for 90 days. Did they say anything about 360-day convention? No, they did not say anything about the 360-day convention, right? So, you eventually need $500,000. For that, you need to make some deposit at 2.5% for 90 days. So, working note 1, let x be deposit value, x into 1 plus 2.5% into 90 by 365 is equal to $5 lakh. Correct? So, this x basically the principal value plus deposit interest on the deposit. So, you compute this as 2.5%. 2.5% is 0.025 into 90 divided by 365 plus 1. So, x into 1.00616 is equal to 5 lakh USD. So, x is equal to 5 lakh USD divided by 1.00616. That gives you x is equal to 4,96,936.69 USD. Right. So, you make this deposit. So, 4,96,936.69, you make a deposit, and on that you earn the balance amount as interest, which is interest is equal to 3063.31. So, you, in order to get 5 lakh USD at the end, you made this much deposit. But where did you get this money from? You don't have this money, you have to borrow this money. So, borrow equivalent INR. So, INR borrowing is what? What is today's rate? Today's exchange rate is 71. So, today you will borrow in INR and convert the amount, entire amount into dollars. So, 496,936.69 into 71. So, borrow equivalent INR, which is 3 crores 52 lakh 82,505. Okay, so this is working note 2. So, in exam, if you don't write this working notes and randomly write stuff, you will not get marks. Please note, INR borrowing is equal to x in working note 1 into 71. Okay, so basically 496,936.69 into 71, that is equal to 35282505. Okay, it is 0.99, so which is why I rounded off. Now you borrowed this much. Now you borrowed this much, you convert to USD at USD INR 71. Okay, after doing all of this, you get 90, you convert into USD, deposit in USD, and you repay the USD. On 50th day, you get the $500,000 in hand. Make, what is this, an import payment only, no? Make $500,000 payment on day 90. Now, please note, you have borrowed in rupees. When you borrow in rupees, you are supposed to repay interest, right? So, you on 90th day, repayment due in INR. What is INR borrowing rate? INR borrowing rate is 6%, is equal to 3 crores 52 lakhs 82,505 into 1 plus 6%, no, 6% into 90 by 365. Okay. .06 into 90 divided by 365, you will get the interest rate plus 1 into 352,82,505. So, you will repay rupees 3 crores 58 lakhs 4,492.75. Okay. So, this is the second one. So, if you make payment using this money market hedge, that is, you borrow in one currency, deposit in, convert into another currency, make a deposit and use that money to repay off, and original borrowing whatever you have make the repayment on the due date, then this is going to be the cost, 3 crores 58 lakhs. If it is forward, it is 3 crores 65 lakhs. So, see, money market is cheaper than forward contract. Okay. Then third option, Third one is what? Third option is options only, I think. Yeah, third option is options, right? Using option contract. What are the rates they gave? 72.5, 73 and 74. So whenever options are given, please note, do not directly multiply the rate and arrive at an expected rate. So what I mean is, what are the rates that they've given? Let me see. 72.5, 73, 75, probability is 25, 50 and 25% rates. So please don't multiply these two for option purposes. What you are supposed to do is strike. Strike price is what? Option contract that expires in 90 days has an exercise price of 74. Exercise price is K is equal to 7. At this point, will this option get triggered or not? So here, option trigger. See, if the market is at 72.5, will you buy in option buy at 74? No. When market is 73, will you buy an option? No. But if market is 75, you will buy in exercise your option to buy it at 74. So here it is yes. And in this case, what is your cost? So if you have an option contract, how will you find out the price in each of the scenarios? See, if you're not going to exercise, then 72.5 is the cost. If not going to exercise, that is you're going to go with the market, the cost is 73. But here your cost is only going to be 74. Why? Because your option contract has a strike price of 74. You have a right to buy call option. You have a right to buy dollars, okay, at 74 rupees per dollar. So here your cost is 74. So cost with option contract. Using option contract. 72.5, 73, and here it is 74. Okay, then probability is 25%, 50% and 25%. Then you compute weighted average rate. Please do not directly multiply 72.5 into 25, 73 into 50, 75 into 25, arrive at a rate, whatever that rate is. How much will it be? 72.5 into 0.25 is equal to m plus, 73 into 0.5 is equal to m plus, 75 into 0.25 is equal to m plus memory recall. You will get actually a weighted average rate of 73.375. You will say my option strike price is 74, the weighted expected price is 73.35. So anyway, option will not be triggered. Let me consider this as the cost. If you do that, it is wrong, especially from an option contract perspective. When you are evaluating an option contract, this is not the way that you are supposed to do. You cannot use this. The right approach is this, what we have done below. This is the right approach. Okay. Now in this right approach, what happens? Expected value of contract using options. It will be 72.5 into 0.25 plus 73 into 0.5 plus 74 into 0.25. So it will be 72.25 into 0.25 is equal to m plus, 73 into 0.5 is equal to m plus, 74 into 0.25 is equal to m plus memory recall. You will get a value of 73.125. So this is very, very different from this. Okay. So this is the right value. So at this point, using options, cost of foreign currency or outflow, and here there is a, even though I said initially there may be may not be any back and forth or future value, present value, there is. Using options, applicable rate for 500,000 after, for USD 500,000 after 90 days is 73.125. Outflow is equal to 73.125 into 500,000. That is equal to rupees 3,65,62,500. But please note, you have also paid premium. Add premium. What is premium? How much premium did you pay? Premium of 10 paise per dollar. So premium paid is equal to 500,000 into 0.1 rupees per dollar. This is this many dollars. So dollar cancel, you get 50,000. And please note one more thing. Please note one more thing, interest on premium. Interest on premium, this is what I was telling you, that there is a future value concept. Why? Because you are paying premium upfront. All the costs, in case of forward contract, in case of money market, in case of your option contract, in case of no hedging, everything you should evaluate at a certain date, and the certain date, that is all cash flows are for the same date. Here this premium is paid upfront. So you have to add interest on premium, because if you're paying upfront, the cost is incurred on day 0, not day 90. All costs we have to evaluate on day 90 basis. So what is the interest rate? What is the INR rate? Because you are in India, you have to borrow that 50,000. What is the 50,000 rate? 6%. Equal to 50,000 into 1 plus 6% into 90 by 365. That is equal to, here if I do 1 plus, no, then it will include this 50,000. So I will just do directly into 6% into 90 by 365. This is equal to 739.73. So total cost for options is equal to this 3 crore 65 lakh 62,500 plus 50,739.73. 3 crore 66 lakh 13,239.73. Okay, now this is the third option. This is the third option. Options is 3 crore 66 lakhs. Your this one is 3 crore 58 lakhs. The other one is 3 crore 65 lakhs. So far, money market looks cheaper. What is the fourth point? Fourth point, they said no hedging. If you don't do any hedging, then what? If you don't do any hedging, what will happen? You have to assume the rate on the future date. So basically, what is likely to happen on the 90th day? Do you know what is likely to happen? No, it is they've given forward rate and they've given some probabilities. So using these probabilities, you'll find out what is the expected rate. That is where this number comes in, what we computed earlier. I said cross, no, this number. So expected future rate, expected, this is for no hedging, future rate is equal to this one 73.375 is equal to, what are those? 72.5 into 0.25 plus 73 into 0.5 plus 74.5 into 0.25, that is equal to 73 point, what was that? 73 point, that is equal to 73.375. So outflow after 90 days is equal to 73.375 into 500,000. That is equal to 3 crore 66 lakh 87,500. Now please see which one is cheaper, which one is 366, 87. So anyway 366, 13, 367, 87 are out. What is left? What is left is money market, which is 358. This is also 365. Forward is also 365. So money market hedge is the best form. You have to write money market. That's the question, no? Which of the following would be most preferable? Money market hedging is the most preferable, as it results in cost of 358,04,492 is best strategy with lowest cost. 358,04,492.75. Okay, so you please have to remember and understand what is this money market hedge. We've, it is simple back working. Okay, and even in the exam, you are supposed to work backwards like this. Okay, you're supposed to call this as step. Okay, this is 1, 2, 3, 4, 5. You're supposed to write a step number here. Okay, in fact, if you look at my P600 plus, I have given it in a proper tabular form. So you have to give it in tabular form. I am explaining you the concepts, which is why I am not giving it to you, not spending so much time on making this table, wable and all that stuff. Okay, so if you look at my P600 plus, it is given in a very, very neat, easy to understand form. Okay, fair enough. Now we have finished this question. This is question number 73. Then we have to go to question number 99, which is purely on options, and this 99 question also, if I am not wrong, is one of the recent, very, very recent exam questions. This is a question from 99 is a question from if I am not wrong, yeah, November 23. It's a question from November 23. It's a very, very recent exam. Okay, let us go and look at this number, November 23, question number 99 from P600 plus. So friends, now this is the problem on options. This is question number 99, and as I said, if I am not wrong, this is question from November 23. Let's look at this. A Japanese company imports high-tech printer cartridges from US worth $1 million. So Japan and US. The chief financial officer of the company wishes to know the best strategy for protection against uncertainty. So this is all with respect to Japanese chap. For the payment that has to be made at the end of 3 months. So Japanese CFO is bothered about what payment he should make to the US guy. Financial team of the company has collected following options for evaluation. Exchange rates quoted in the Forex market. Yen to dollar. If you remember, I told you yen is far, far weaker than dollars. Okay, so they've given bid price of 146.03 and 146.63 offer. What does this mean? $1 is equal to so many. Okay, they have given here as yen by dollar. It is yen per dollar, or if you look at it as USD by yen. If you look at this as the code, this is what it is called. All it is yen per dollar. Okay, that is what they have given. Spot rate they have given bid and ask. 3 month forward they have given bid and ask. 6 month forward they have given bid and ask. Now why is 6 month relevant? Payment has to be made at the end of 3 months. So this 6 month rate is just for confusion. Okay. Options market rates for the European options with 3 months expiry are very clearly 3 months. Call and put strike price is 145.2. Call premium is this much. Put premium is this much. Call and put for 146 as the strike price. Call premium is this much and put premium is this much. So when a given premium percentage, it is percentage of the strike price. Please note, not percentage of spot. The expected spot price on expiry, they have also given one more variation, which is what is the expected spot price on expiry? It is 144.90 by 145.05. Suggests the best strategy for the CFO of the Japanese company to protect against uncertainty with respect to the following alternatives. Should you do a simple forward hedge? Should you buy a 3 month call? Should you sell a 3 month put? Should you buy call and sell put, both having a strike price of 146? Now you see, friends, here the key thing is you are a yen company, you need dollars. Okay, you will a call option, a right to buy dollars. So if you buy call implies you buy dollars, correct? Because you have a right to buy and you are buying that right to buy. Put option is right to sell dollars. So you will not see, you want dollars, why will you sell dollars? So you are selling a put so that somebody has a right to sell you. So sell put implies someone else has right to sell us dollars. In both cases we end up having the dollars. In one case we directly buy it, in another case somebody is forced selling it and we are forced to buy. In first case this is option to buy, that is you may want to buy, may not want to buy depending on market circumstances. But here depending on market circumstances, the other party will give it to you and you have to necessarily buy it. Okay, so this is what is a buy call, this is what is a sell put, and they have given what will happen if you do a simple buy call, what will happen if you do a simple sell put, or if you do both of them together. Now let us see, using forward hedge, what is the cost? What is the forward? And here is there a time value component? They have not given interest rate, so I don't think there is any time value related issue. So you have to compute this 3 month forward rates, use these, and in case of 3 month forward rates, which one will you take, bid or ask? See, you are a person who is buying dollars and this quote is USD yen. So banker will buy at base currency at bid. So banker will buy yen, buy USD at this quote of bid. Banker will sell USD at this quote of ask. So when you are buying dollars, banker is selling dollars, so ask quote is relevant for you. So ask quote is relevant. So forward currency, forward contract, ask quote is relevant. So forward contract ask quote is relevant. Now what is the ask quote that is relevant here? Please do not get confused. You have a spot, you have 3-month forward, you have 6-month forward. They have given 3 quotes only to confuse you. Okay, spot is 146.63, but forward rate, I'll clean this up. Spot is 146.63, for 3-month forward is 145 and 6-month forward is 146.7. So you will take 145. Please don't take 146.63, gone. Whole question is gone. Or don't take the bid side, take the ask side. In the ask, which quote is relevant, take it. They are unnecessarily giving you to confuse you. So $1 million buy at 145 after 3 months. So outflow after 3 months is equal to $1,060,000 into 145 yen per dollar, that is equal to yen 145 million. Okay, this is the first step. Second step is options. Options also, first thing they said is what? Buy call at x is equal to 145.20. So they have given buy call at 145.2. 145.2 call premium is 1.6766%. So premium is equal to 1.6766%. Please note here the premiums are directly, they are not per annum premiums. Okay, they are all direct premium percentage. On this 145, 1.61% is not per annum. So the premium is 1.6766% directly of 145.2. So and please note, you are buying a call at 145.2. What is the expected spot price? Expected spot price is 144.9 and 145.05. So again here also this is bid, this is ask. Expected spot on the date of expiry is 144.9 and 145.05. You have a right to buy it at 145.2. So will you exercise the option? You will buy in the market at 145.05. You will buy in the market at 145.05. First I will write premium paid is equal to 145.2 into 1.6766% into $1 million. This is yen per dollar, dollar gets cancelled. 145.2 into 1 million into 1.6766%. 2434423.2 yen. Okay, this is premium paid. On maturity date, spot is equal to how much? 145.05. Okay, spot ask, because we have to buy, no, banker has to sell dollars, so we have to buy. So banker ask quote is relevant, 145.05. So option is not exercised. You have to write this whole story. If you don't write the story, you will not get marks. Option is not exercised. Company purchases USD on spot on maturity date, that is equal to 1 million into 145.05, that is equal to 145,050,000. Okay, so plus 145,050,000. So that makes it total cost. And this premium, it is paid upfront, but we don't know the borrowing cost. So time value ignored. Time value, TVM, time value of money ignored. Okay, in exam you have to write it in much better form. I am just showing you. Total cost is equal to A and B. A plus B plus is equal to 147,484,423.2 yen. Now if you compare this 147 here and here it is 145, your forward contract is still cheaper than a buy call. Now let us go to sell put. Sell put, what is the sell put rate? Same 145.2. Please note there is one small thing, one small important thing. X is equal to 145.2, premium is equal to how much? 1.7414%. But here when you are selling, premia is received. So please, you should not make a mistake. So 145.2 into 1 million into 1.7414%. That gives you 2528512.8 minus, this is premia received, and on due date N is same. On due date N is 144.90 by 145.05. So the other party to whom you have sold the put, he has a right to sell to you at 145.2, whereas in the market is 145.05. So will he sell in the market or will he sell it to you at 145.2? So 145.2 is what they will sell. So on due date N, so put is exercised by put buyer. Okay, instead of selling it to you at instead of selling in the market at 145.05, they are selling you $1 at 145.2. So price of USD is equal to 145.2 into 1 million less this is not price of USD, outflow for purchase of USD 1 million is equal to 145.2 into 1 million dollars. This is yen per dollar, so dollar gets cancelled, minus 252,850,8512.8. So 145.2 plus, you do this, you get 14267,1487.2. Net cost is 14267,1487.2. This is number 3. Okay, then number 4. What is number 4 that they have given? Buy call and sell put both having strike price of 146. So 146, this is the premium. So buy call and sell put. Buy call strike price 146, sell put strike price 146. Spot on maturity is 144.90, no? 144.90 and 145.05. So for both of them it will be 145.05. Yeah, 145.05. Right. And premia percentage, they have given something, no? 1.3505% and 2.1006%. This is premia paid, premia received. Okay, and on due date, in market you have a right to buy at 145.05, whereas contract is at 146. Will you exercise? Not exercised. Not exercised. In market, somebody has a right to sell to you at somebody has a right to sell to you on due date at 146. In market is 145.05. So they will sell to you at 146. Exercised by put buyer. Okay. So total net cost is equal to 145. It's not 145. I'm sorry, 146. On account of exercise of put by put buyer 1 million into 146, that is 146 million yen, add buy call premia less sell put premia. Okay, this is, both of them will be on your strike price. Strike price is 146. So buy call premia is this working note 1, working note 2, working note 1, buy call premia is equal to 146 into 1 million into, what is that percentage? 1.3505%. 146 into 1 million into 1.3505%. That is equal to 197 730, 197, 730, and sell put premia is received. So there it is, working note 2, sell put premia received is equal to 146 million into, what is the rate here, 2.1006%. That is equal to minus 3066876. 3066876. This is 7 digit, this is 6 digit. So I think there is some error here. 146 million into 1.3505. So this number is 1971730. See, that is what you should be careful. When I saw the digits, I realized that something is wrong. 1730. Okay, 1971730. 1971730 and minus 3066876. So if you do total cost minus 3066876 plus 146 million, 144.904854. Now you see which is the cheapest of the 144 is buy call sell put, 142 is simple sell put, 147 is buy call, and forward is 145. Very, very clear. Sell put is the best option available, which is at what? 142.67 million. So you write sell put is best strategy as it has lowest cost of 142.67 million yen outflow. Okay, you can write the exact number also, 142.671487.2. Okay, fair enough. Now this completes this question. This is a question on options. This is question number 99 what we have solved. Now let's go and look at question number 78, which is on Vostro, Loro and so on. So friends, before we jump into this problem number 78 where we are going to solve Nostro, Vostro related, we have to understand the concept. What are the concepts? Fairly simple, nothing complex. Elaborate how Nostro, Vostro and Loro accounts operate. You have to first understand this. In interbank transactions, foreign exchange is transferred from one account to another account and from one center to another center. Banks maintain 3 types of current accounts to facilitate quick transfer. There are 3 accounts maintained by banks. These are not maintained by you and me, they are maintained by banks. These are called Nostro, Vostro and Loro. What is Nostro? My account in your bank. That is, SBI India is maintaining an account with JP Morgan, New York. That is called SBI's Nostro. Okay. So, bank's foreign currency account maintained by bank in a foreign country with home currency of that country. That is State Bank of India's US dollar account with JP Morgan in US. That is called as a Nostro. Now, Vostro, your account in my bank. Account which is held by foreign bank with a local bank. So, if State Bank of India maintains an account with JP Morgan in US, it will be a Vostro account for JP Morgan. So, the same account which is maintained by JP Morgan, in their books, the Nostro of SBI is called as Vostro for SBI. That's all. It is very, very simple. Okay, it will be a Vostro account. Nostro, Vostro, they both pertain to the same account. Nostro is I maintaining an account abroad. For me, it is called Nostro. The same account denominated in dollars, which is the home currency of that country, which they maintain for a foreign country, that account is called as Vostro. The account in which is Nostro for one bank is Vostro for other. Obviously, that is what I explained. When domestic banks use account for third-party banks which hold Nostro to settle foreign exchange transactions, these are transactions are included under Loro account. What is Loro account? My account in somebody else's bank. That is, State Bank of India has an account with JP Morgan, but IDBI Bank does not have Nostro with JP Morgan. Now, if IDBI Bank has to pay bill of imported auto parts from USA on behalf of its customer, IDBI shall approach SBI and request them to settle invoice on its behalf. So, SBI would work as an intermediary between JP Morgan and IDBI, and this is a Loro. This is a Loro account for IDBI. If IDBI themselves directly maintain an account with JP Morgan USA, it is IDBI's Nostro, it is JP Morgan's Vostro. But because IDBI is asking SBI to handle the transaction, SBI's account in JP Morgan USA is Loro for IDBI. It is Loro for IDBI. My account in somebody else's bank. So, IDBI's account in somebody else's this thing. Exchange position. What is exchange position? Once you understand these three, nostro, vostro and loro, you have to understand certain concepts related to this nostro, vostro and loro. What are these concepts? Exchange position. It is referred to total commitment of a bank to purchase or sell foreign exchange, whether actual delivery has taken place or not. So, SBI. So, SBI on that account that it has maintained with JP Morgan USA or New York, if they have committed to buy or sell foreign exchange in that particular account, so they are saying, dear JP Morgan, today I will buy $1 million or today I will sell $1 million. Whether commitment itself, okay, I will, that's all. Moment you say will, not the actual amount, okay, that is called as exchange position. So whether if you are going to say I am buying, then you are positive. If you are saying you are selling, then you are short. Okay, that is known as exchange position. Cash position. What is cash position? It is outstanding debit or credit in bank's nostro. Since all foreign exchange in the bank are routed through nostro, it is credited for all purchase and debited for sale by the bank. So morning the SBI does some purchase of 2 million. Afternoon it does sale of 3 million. Now let's assume they actually does it. So the net exchange position for SBI in JP Morgan's bank in New York is minus 1 million cash position. Outstanding balance of debit and credit in that bank account is basically the net balance is called the cash position. All dealings whether delivery has taken place or not affects exchange position, but cash is affected only by actual delivery. Correct? No, exchange position is just a summary intent, but cash is only pure delivery. Therefore, all transactions affecting cash will affect exchange position and not vice versa. So anything that is on cash will affect exchange, but anything on exchange will not affect or may not affect cash. Okay, so this is about broadly, very briefly about nostro, vostro and loro, and what is exchange position and what is cash position. Now, when I take an example, you will understand this better. So let us go and look at that particular example. So friends, this is not question 78, this is question 77. I kept saying 78, it is actually question number 77. There is a small correction in the question number, 77 from P600 plus. Now let us read this question. Suppose you are a dealer of ABC Bank. Okay, you are the bank, and on 2010-2014, you found the balance in your nostro account with XYZ Bank in London is £65,000. Balance in nostro. Please note, when you solve a problem like this, and by the way, this question came sometime in 2018 or 19 also, a question was asked. After that, a question was not asked on this, but there is a chance that, once in a while they may ask this, but it's a very, I don't know why you're even, this is there even in your syllabus, it's nowhere relevant. But anyway, we'll go with it because it is there. So, XYZ Bank in London, balance in your nostro, when they say balance, no, it very specifically means cash balance. We heard of two things, cash position, exchange position. This is cash position, very clear. And you had overbought 35,000. This refers to exchange position. Okay, when they say balance in your nostro, it is cash. Please remember that. Then during the day, following transactions have taken place. So beginning of the day, this is the balance, and during the day, DD purchased 12,500, purchase of bill sold forward contract remitted by TT, draft on London cancelled 15,000. You have given some transactions. What steps would you take if you are required to maintain a credit balance of 7,500 in the nostro and keep as overbought position of 7,500 pounds? Okay, so now in this, cash position and exchange position are two different things. You have to maintain accounts for both of them. That is the end goal of this kind of problems in this chapter. Okay, so nostro account, cash position. Okay, what is the opening balance? Found that balance in your account is 65,000 pounds. Opening balance, pounds 65,000. Then exchange position. They say overbought something, no? Overbought pounds 35,000. Okay, so overbought pounds 35,000. So you can write this like this also: purchased, sold, opening 35,000. Okay, you can write like this also. You can write like this also. Then what you do is, now let us go transaction by transaction and see whether it has an impact on both cash and exchange position or only one of them. Everything that has cash has an impact on exchange position. DD purchase. Now you have purchased a DD. DD purchase means you have just purchased, whether the money is hit, not hit, all of that is not known. It is just that there is a transaction. This transaction is not a cash transaction. It is just a exchange position related transaction. So this 12,500 will come here. So this 12,500 will come only in exchange position. Add DD purchased 12,500. Then what have they given next? Purchased a bill on London. You purchased a bill. Whether there is any foreign exchange impact? No, you just purchased a bill. So commitment to buy, right? So add bill purchased 40,000. Then sold forward TD, not today's forward, sold TD. So there also it is not a cash transaction, it is a exchange transaction. Forward TT sold. So it comes under this. It is how much? 30,000. Then forward purchase contract cancelled. So forward purchase cancelled. See, if there is a forward purchase, you write here. So forward purchase cancelled, you write here. So how much is it? 15,000. Okay. Then remitted by TT. So now you see all the others were not actual cash transactions. They were all commitments, whereas remitted by TT is actual cash. So it will come both in this exchange position as well as cash position, nostro account. So remitted means out of your system. So TT remittance. How much was it? 37,500. Then the last one is draft on London cancel. Now draft on London cancel is purely an exchange transaction, not a cash transaction. If a draft is issued, right? If a draft is issued, what did we do? If the draft is issued, where bill purchase, if a draft on London, so it is not a transaction that you did it with respect to somebody else. Please don't confuse it with bill purchase and DD purchase. Draft is independent. When the draft is issued, it comes here. So when draft is cancelled, it comes here. So draft on London cancelled. How much was that? 15,000. So if you total all of these, what will you get? 30 plus 37,500, 67,500 plus 15, 82,500. What is the total here? 35 plus 15 is 50, 50 plus 40 is 90, 102,500. So net balance. So net balance is 102,500 minus 82,500 is 20,000 overbought. Okay. Now, which of these will impact the cash? Only the one, remittance by TT. So less TT remittance is how much? 37,500. All others are non-cash transactions. So closing balance 27,500 pounds. Okay. Please remember, whenever you purchase a DD, it is part of this. Whenever you purchase a bill, it is part of this. Whenever a draft is issued, it is part of this. So draft cancelled will come here. Please remember that. If you have further doubts, please go and look at P600 plus. You'll get more clarity here. So now what is the specific question they asked? What steps would you take if you are required to maintain a credit balance of 7,500 in Nostro? So in Nostro, you have to maintain credit balance. So if you have to maintain credit balance of 7,500, what is current credit balance? 27,500. So if you have to maintain balance of 27,500, you have to do something in this account, no? See, closing balance is 27,500, but required credit balance is 7,500. So what do? You sell. Sell on spot. How much? 20,000. Whenever you sell on spot, that also impacts exchange position. So what is exchange position? Exchange position minus 20,000. You have overbought here, now you sold. So new balance nil. This is first statement. They also made a second statement, which is also keep an overbought position of 7,500. Now this overbought position has become nil. So you have to make a fresh forward contract or some kind of a fresh purchase. Right. So you enter it. So you must make a fresh forward contract or some kind of fresh purchase commitment, not actual purchase. So forward purchase commitment 7,500. So for this will not impact your cash, it will impact only your exchange position. So new overbought balance is 7,500. So this is what you do. In exam, you have to write down all of these. You have to write down all of these and you have to explain what you have done each place. So, sell on spot. Why? Because you have to write a working note. Okay, you will say working note 1 and write working note 1 in order to reduce nostro balance to 7,500, 20,000 pounds have to be sold on spot. Same way, here you write based on working note 1 and working note 2, which is that working note 1 has impact both in exchange and cash. That was cash impact, this is exchange impact. Now, working note 2 is purely exchange impact. In order to maintain overbought balance in exchange position, forward purchase of pound 7,500 has to be done. So, when you write like this is when you will get marks. Okay. So, now we have finished almost everything. This is, as I said, question number 77. Last thing that we are left with is fate of forward contracts, which is question number 87 is what we are going to solve. Let us see, we will go ahead and solve that particular question. Before that, I just want to highlight if you have finished all the questions, because fate of forward contract is the last topic that we are going to address. Yeah, this is 77. I wrote 78. So, we have finished all of these. We have finished everything. We have covered all the aspects. Now, we will jump right into fate of forward contracts 87, which is where a lot of students get confused. It was asked once, I think, if I am not wrong, when was this asked? It was asked in, I will tell you, fate of forward contract was asked in November 23. Okay. Before that, in the last 4-5 years, it was not asked. There is a possibility it may be asked. It is the most confusing topic. I typically advise students, if that is a choice question, leave it. Otherwise, go and solve it. See, there are 2-3 choice questions I always tell. One is this international finance one question. Second one is this fate of forward contract. Then you have that Sharpe's optimal portfolio management. These are the 3 questions I say. Always Sharpe's optimal portfolio never has come. IFM mein the huge working FCFF working and projection and all that has come. That kind of questions have come. If possible, leave it in choice. And fate of forward contract also, if possible, leave in choice. Otherwise, go ahead and solve it. Anyway, it is nothing. It is no rocket science. Okay. Let us go and look at this last problem, which is 87. So far, how many have we solved? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 13, 14 we have solved. So, with 15 questions, you can excel in foreign exchange chapter, or okay, foreign exchange risk management chapter. Okay. So, guys, now let's look at this fate of forward contract. This particular topic, right, is where a lot of students do tend to get confused. And as I have highlighted earlier, it is a simpler topic as long as you remember certain basic rules and criteria. So, let us understand what basically this concept is. Whenever a forward contract is entered, it meets any of the 3 following fates. FATEs. Fates means what is the end goal or what is going to happen. Our fate, they say, in Hindi, Mathe pe jo likha hua hai, Telugu mein tal rata and all that. So, fate. Fate of forward contract. A forward contract can be delivered, cancelled or extended. So, if you enter into a forward contract, you can choose to take delivery of foreign exchange of that forward contract. Please note, forward contract is OTC, future is based on exchange. So, when you have OTC, you can either take delivery, you can cancel it or you can extend it. What do they mean by delivery, cancellation, extension? Let us go and look at each one of them. See, if you take delivery, it means that you are honoring the contract. Whatever you have agreed to do, as per the forward contract agreement, you are going to do that. On the due date, you are saying, I am going to, let's say you have agreed to buy some dollars. You as an individual customer have agreed to buy some dollars from a bank. So, on the due date, you will say, I am going to buy dollars, that is, I am going to take delivery of the dollars and I am going to hand over rupees to you. Okay, that is called taking delivery. Cancellation. What is cancellation? You will say, no boss, something has happened. I wanted to, buy dollars for you for making an import payment. But, what happened, that import didn't happen or import is cancelled or whatever reason. So, the contract that I have with you as me as an individual customer, that I have with you as a banker, for you to deliver some foreign exchange, that is some US dollars to me, that amount I no longer want it. So, I want to cancel our agreement. So, I want to basically cancel our agreement. This is the second one. Third one is extension. In this case, you are saying, see, I want the money, I want the dollars, I will take dollars, but not today. You'll say, I enter into a contract on 1st Jan to take delivery of some dollars from XYZ bank on 31st of March. On 31st of March or before 31st of March or just a day after 31st of March, you'll come back and say, no, I don't want to cancel, I want to extend. Now, my import payment is on 30th of April. So, please extend the contract by a month. So, that is called basically extension. Now, when can these three subcategories happen? These three things can happen before the due date, on the due date, or after the due date, up to 3 days maturity. If you look at some old questions, right, they will say up to 10 days or 15 days also. That was the old FEDI rules. But as per latest FEDI rules, even after the day of the contract expiry, up to 3 days, you can go ahead and claim certain things. What do you mean by up to 3 days after maturity? We will understand that in detail when we discuss in depth. But for now, please understand these are the three scenarios. You can take delivery, or you can cancel, or you can extend 3. So there are 3 things here, and this can happen at 3 times. 1, 2, 3. This can happen before, on, or after due date. So you basically have 9 boxes. Right, 3 into 3, you have 9 boxes. So there are 9 scenarios which can actually play out. Now, is there any other additional scenario also? Yes, beyond 3 days after maturity. So, which is why you have 3 days after maturity. So, I think I'll modify this slightly. So, you have not 9, you have 12. Whether some of these boxes are same or similar, I will showcase to you. Please don't worry about that. But there are 12 scenarios possible. Now, what is the last scenario that I was telling? After 3 days after maturity. In old exams or old questions, in fact, I think this mistake happened by ICA even in November 23, if I'm not wrong, where they asked a question as per old rules, okay, where the gap was 10 days. So, what is this 10 days? 10 days after maturity, but as per latest FEDI rules, up to 3 days after maturity, you can go and make a request for contract delivery or extension or anything like that. Right. Now, what are the things to note in this? See, we will come back to it. Don't worry unnecessarily about what is this. That is the next part that we're going to discuss. As per the FEDI rules, forward contracts which remain overdue without any instruction on or before due date stand automatically cancelled within 3 working days after the maturity date. So, if you are not instructing your banker what is supposed to be done on maturity date, so on maturity date, they take some action. They take some action, which is cancel everything. They cancel everything. So, these are the FEDI rules. They are cancelled within the 3 days after maturity. They are cancelled within 3 days after maturity. Typically, banks do it on the day when maturity happens itself. That day, you don't give an instruction. That day itself, they will cancel it. Then, since FEDI rules allow late delivery, cancellation, extension up to 3 working days, bank shall first cancel original forward contract on the date of the contract, on the date of maturity of the contract. Here it is, date of maturity of contract, and enter into new contract as possibility of delivery remains within next 3 working days. So, what they are saying is, if you have entered on 1st Jan and the contract is maturing on, let's say, 31st March, till 3rd April, you have a right to go and make a claim against that particular contract. So, what they will do is, on 31st March, they will cancel and they will enter into an optionally deliverable forward contract, ODFC, for next 3 days. After 3 days, there is another scenario. So, I will explain this even better actually. Let's say on 1st Jan, enter into contract to buy, okay, it can be buy or sell, to buy $1 million on 31 March. Okay. Now, if you cancel or extend or seek delivery on any day from 2nd Jan to 30th March, this is called early action. Correct, no? Because you are doing something before its maturity, after the date of the contract. Before the date of maturity of contract itself, you are asking for something. You are either cancelling, seeking extension, or asking delivery. Now, if you do anything on 31st, this is on due date. Correct, no? On due date only you are doing. Okay. Then you can do 31st March till 3rd April. This is 3 days after maturity. Then 4th April onwards till infinity, whenever, 3 days after maturity. Beyond maturity plus 3 days. Correct, no? After 3rd March is 4th, after 3rd April is 4th April. So, if you do any action on 4th April, it is beyond the 3 days after maturity. Okay. So, these are 4 dates, or rather these are 4 periods that you have to, that you can, in which you can take action. Now, coming back here, what are they saying? Banks shall first cancel original forward contract on the date of the maturity of the contract and enter into new contract as possibility of delivery remains within next 3 working days. So, what they are saying here is, on due date you don't give any instruction. By the end of the due date, because for next 3 days there is a possibility that you may come back and ask for delivery or cancellation or extension, they will enter into an optionally deliverable forward contract on 31st March till 3rd April. Now, what is this? We will understand. Exporter may not be able to receive money on due date, or an importer may not be able to pay on due date. In both of these situations, an extension of the contract for selling and buying will happen. Accordingly, if an earlier contract is extended, original contract will be cancelled and rebooked for new delivery period. So, when you are talking about extension, see, exporter may not be able to receive so and so. In both these situations, an extension of contract for selling and buying will happen. Accordingly, if an earlier contract is extended, original contract will be cancelled. So, when you are doing any kind of extension, old contract is cancelled and that contract is no longer valid. You are extending it to a new date or a new period, so the new contract will come into play. That's all. It's a very simple statement. These are all statements that are made so that you understand the meaning of each of these words. Then, in all these executions, except delivery on due date, there is a request by the customer to the bank. So, other than delivery on due date, wherein you are saying I am honoring the contract, there also you basically send a request letter, because we used to say, please give delivery on so and so date, on the due date, this is the due date, please, on due date we are asking you to give delivery. So, we used to send an instruction. But if you exclude that one particular instance alone out of these 12 items, what I explained to you here, 12 boxes, only box on due date you are taking delivery. That is the only box where there is no harakiri, or where there is no change, or where there is no specific request from the customer to do something special. Okay. What is that something special? I will explain. Banks normally accept the same, but it may levy some charges. So, whenever you are making out of the contract request, bank has a right to levy charges. This is because when bank enters into a forward contract with customer, it also covers itself with a back-to-back contract in interbank market. That is, if bank agrees to sell $1,000 to a customer after 3 months, it will enter into a contract to buy $1,000 after 3 months. So, there is a market called interbank market. What is interbank market? When a bank buys from you or me, it's basically they are buying from individual customers, they are buying from corporates, they are buying from retail people. But let us say they have to buy something from me. That whatever they have purchased from me, they have to sell it somewhere, no? They may sell it to some other customer who may have a requirement, or they may sell it to another bank whose customer has a requirement. So, I am repeating it. If I am agreeing to sell something to a bank, the bank is buying from me. What will the bank do with that foreign exchange? Dollars. Okay, let's say there are $1,000. What will bank do with the dollars? Either it has to sell it immediately to somebody else, which it can be another customer who has the same kind of a transaction on the same date, or it must sell it off to another bank who has such kind of a customer. So, when it deals with such kind of other banks, the market between such banks is called interbank. Whereas the market where you and I operate, or where you and I buy from banks, that is not the interbank market, that is basically the customer market. The banks operate in customer market and also operate in interbank market. So, they buy from customers, then square off. If you remember, I have told you this point, square off. That is, they whatever they purchased, they sold it, they sell it off, right? So, they purchase from us and sell it off in interbank, or they sell to us something that they don't have. Because they don't have it, they buy it in the interbank market. So, even for forward transactions, if bank is entering into a forward with you today to buy some dollars from you, bank will also enter into a forward on the same date back to back to sell the same dollars to somebody else. So, the rate at which it is entering into the contract with another bank is called as interbank rate. That is something you have to keep in mind. So, if a customer requests for an early, late delivery, cancellation, extension, this covered contract will have to be settled by the bank, and related loss, if any, will be passed to the customer. These losses charges for different execution scenarios are discussed below. So, whenever such kind of an interbank transaction is entered into, if there is any change in the original contract, that is, original contract is cancelled, original contract is extended, right, then then the back-to-back interbank contract also has to be cancelled or extended. So, there are, whenever there is a contract with you, there is a change in the contract with you, there is also going to be a change in the back-to-back contract which the bank enters into with the interbank, right? So, that is something that you have to keep in mind. Why is that important? Because whatever are the losses it makes or incurs on interbank market, it will pass on those losses to you. As per FEDER rules, you as a customer are supposed to bear those losses. Why? Because you have come and made a certain request to make some changes to the forward contract that you enter into. If you are honoring your forward contract and taking delivery on the due date, no problem. If you are not honoring the forward contract and are asking for cancellation or extension or new forward or whatever it is, then the bank has a right to levy additional charges which are linked. There are certain charges which are, which are laid out, and there are certain charges which are linked to the interbank rate. The rate at which it has entered into a back-to-back transaction to cover your original forward transaction. Okay. Now, what are these? Let us see. Delivery on due date. As I told you, there is no charge or losses involved as customer takes or gives delivery on due date. Exchange of currency shall take place at the agreed rate between the parties, irrespective of the prevailing spot. So, no matter what the spot is, if the spot is high also, bank will give me the dollars at the forward rate. Spot is low also, I am supposed to take dollars from the bank at the lower rate. So, whether it is spot is high or low is irrelevant. On the due date, please don't think of any other date. On the due date of the forward contract, on the due date of the forward contract maturity, if there is any change in spot, it does not matter. Both you as well as the bank have to honor the forward contract on due date. This is basically taking delivery. This process is called taking delivery. If you don't take delivery, you can cancel it, you can extend it. On due date also you can do, before due date also you can do, after due date also you can do. All of those scenarios we will discuss. What is early delivery? In this case, the customer must base the loss, if any, that accrues to the bank. So, if at all there is any early delivery, if there is any kind of early delivery, that is delivery before the due date, here I gave you an example. You agreed for 31st March. Any date from 2nd Jan to 30th March, you come and say, I want delivery now. I don't want delivery on 31st March. I want delivery today. I want to change the terms of the forward contract today. So, you are asking for a change in the terms of the forward contract. The bank has right to levy certain charges. Let us see what they are. In case of early delivery, there are two kinds of charges. First one is something called as swap difference. Second one is something called as interest on outlay of funds. Now, again, with respect to both these aspects, there are certain finer aspects. We will understand that as we move forward. But let us see what is swap. Swap means the difference can be a loss or gain to the bank and arise on account of offsetting its position. Bank will buy and sell in the spot forward market to square off its position. So, swap is basically the bank is swapping its liability from one date to another date. Correct, no? Instead of your delivery on certain date, you are saying I want delivery on an earlier date, right? So, there is a change. There is a change in way in which the contract is being structured. Because of this change, the bank is forced to buy and sell in forward or spot. So, if it buys in forward, it is forced to sell in spot, or if it is selling in forward, it is forced to buy on spot. So, because of our cancellation, because of any of our early action, basically because of any of our early delivery request, bank is being forced to do either this or this. When that kind of scenario happens, you levy swap charges. What are the charges? We will understand. But please remember, one transaction has to be in forward market, other transaction has to be in spot market. One transaction has to be a buy, other transaction can be a sell. So, it can be spot buy, forward sell, or it can be spot sell, forward buy, depending on whether it is an import or export transaction, it changes. Okay, please note, it is the difference between spot buy versus forward sell or spot sell versus forward buy. So, if you remember this concept, you will be able to very easily understand what is this swap. Then interest on outlay of funds. What is this interest on outlay of funds? Because of early delivery, the bank, which was supposed to, let's say, buy dollars from you on a specific date and give you some rupees, is now being forced to buy dollars much earlier and give you rupees. Okay, and because of that, it is giving you money in advance. It has lost some interest. It has lost some interest on that money. So, because of giving you some money in advance, it has lost some interest. So, that interest you need to reimburse to the bank. Okay, so this is called interest on outlay of funds. If an early delivery request is an outlay of funds for the bank, it shall charge from the customer at a rate not less than prime lending rate for the period of early delivery to the original due date. However, if there is an inflow of funds, the bank may, as per its policy, pass on the interest to the customer at the rate applicable to term deposits for the same period. So, there can be other way also, that is, because of change in the contract, you are asking for early delivery, bank is receiving rupees. That is, you were earlier supposed to buy dollars from them and give them rupees. Now you are buying dollars much earlier and you are giving them rupees much earlier. When you are giving them rupees earlier, they are earning interest. So that interest also they may share with you, they may share. Okay. Please note, bank as per its policy may pass on interest to the customer at a rate applicable on term deposits. Okay. So these are the things. Next, this is early delivery. We have discussed early delivery. Okay, we have discussed only one aspect. Then cancellation on due date. We have first discussed delivery on due date, then early delivery, then cancellation on due date. What is cancellation due date? Difference between contracted rate and the cancellation rate, that is reverse action of the original action, is charged from or paid to the customer, which is exchange difference cancellation gain loss. It is denoted by ED by C. In all my workings, I call it as exchange difference or cancellation gain loss. And this cancellation gain loss is recovered from the customer. If it is a profit, the customer will be receiving those profits. But again, there are certain circumstances. So because of cancellation, so let us say I agree to buy something from you on 31st March at 60. Now on due date, I am cancelling the contract. I am saying I don't want this. I am agreeing to buy something from you at 60. Okay. But on the due date, I am saying I am not going to cancel. So what does the bank do? This 60, whatever it is supposed to sell me, let us say in the market it gets to sell it at 62. If it sells it at 62, this 2 rupees, it will pass on to you. This 2 rupees, it will pass on to you. Why? Because you have agreed to buy something from the bank at 60. Okay, market rate is now 62. So you have made a gain of 2, you are not taking delivery of the dollar, you are saying let us square off the position, let us do a cash settlement, so the 2 rupees gain bank will pass off to you. This is contra. Other way to look at the same thing is, you have refused to take delivery of the dollars by giving 60 rupees, bank is selling those dollars in the market, open market at 62, it has made extra 2 rupees gain, that 2 rupees it will pass on to you. Early cancellation. Bank will cancel the forward contract at the opposite date of the original contract of the date that matches the date of the original contract, and loss gain will be passed to customer. So even in this case, early cancellation also they will pass on that gain or loss. Not only for cancellation on due date, on early cancellation also they will pass off. Then when will they not pass off? We will see. Extension on due date. On due date, the forward contract can be cancelled at spot rate and new contract shall be rebooked the forward rate for new delivery. Extension is nothing. Extension is basically you do a cancellation plus new booking, that's all. That is what is extension. So there is no great magic logic to extension on due date. On due date, but on early extension what happens? First, the original contract will be cancelled at relevant forward rate, exchange difference gain and loss shall be rebooked at current forward rate for forward period. Oh, even in case of early extension, there is no major logic magic. It is just cancellation gain loss and new contract booking. Then we have something called as automatic cancellation. What is this automatic cancellation? A customer is liable to pay exchange difference gaining out of automatic cancellation, not entitled to profit resulting from cancellation. In addition, you will have to pay swap and interest for period from due date of maturity of contract to actual date of cancellation of contract or 3 working days, whichever is later. So, if you do not cancel before due date or on due date, but just leave the contract like that without giving any information, then on the last date of maturity of contract, what is the last date? In our case, it was 31st March. 31st March evening, 5 o'clock, market shuts, or 4:30 market shuts. At 4:30, the bank will automatically cancel. And if there is any gain, bank will not give you the gain. Why? Because you have not given instructions. Because you are a bad person who has not told the bank what you are supposed to do. Okay, bad person is just a way of telling you, explaining this. If you are a good corporate, you will always have control of your forward contracts and you will say, please give me delivery, please extend or please cancel. If you don't give any information, you are a bad person, and for bad person, bank does not share profits. That is a simple way to remember this. Late cancellation. If you don't give instruction on 31st March but give instruction on April 1st, even then they will say you are a bad customer. So your instruction after the maturity of the contract is bad faith. So I will not pay you any profits, but I will collect all losses from you. That is what bank will say. Then you have something called as late delivery and late extension. What is this late delivery, late extension? current rate prevailing on the date of delivery shall be applied, that is spot, in addition to exchange difference, swap and interest and outlay of funds for period from due date of maturity to actual date. So, if at all there is any late delivery, that is delivery after 31st March, the bank will charge exchange gain loss, swap, interest, new contract for making delivery for you. So, new contract will be at the new spot. What is late extension? Late extension also same thing. Relevant forward for the desired period shall be applicable in addition to exchange difference, swap, interest for period from due date of the contract to extension date. So, late delivery, late extension have something very, very similar. Now, let us see. This is where I have summarized everything in one single table. What all we discussed so far is one single table. So, you see the best part, this is the best part, that is on due date, you take delivery, you are a good person, very, very good boy, good girl. So, no impact. Whatever is as per the contract, you meet the requirements thereof. Then, what did we discuss? Let us come back and look at this. What are all the things? Delivery on due date, good boy. Okay. Early delivery, you have swap plus interest. If there is any early delivery, you have charged swap charges and your levied interest cost. What is swap? Swap charges are applicable when bank is buying and selling for different time frames due to customer actions, one spot and other forward. One spot, another forward, one buy, one sell. That is what basically is a swap. When you look at a problem, you'll understand. Interest is applicable whenever there is an inflow and outflow of funds for the bank. In case of post-maturity transaction, what are post-maturity transactions? From here onwards. In case of post-maturity transactions, bank's back-to-back rate will be considered. So, for these kind of interest on funds, the interest will be computed on back-to-back rate. Wherever there is an inflow and outflow, because bank is supposed to, let's say bank is buying from you, they are also selling it to somebody, right? Bank is buying dollars from you, they are selling it in interbank. So, that back-to-back rate will be considered wherever in case of post-maturity. So, wherever it is post-maturity, back-to-back rate will be considered for interest. This is one more thing you need to remember. Then, in other cases, the rate will be ignored. Back-to-back rate will not be considered for interest charges if it is not post-due date. In case of early delivery, interest is not computed using back-to-back rate. So, it is very specific. On early delivery, this case, interest not on back-to-back rate. What am I referring to here? Here what rate is considered? We will see. When we solve the problem, we will see. But in all these three cases, or this case, back-to-back rate for interest computation. Please remember that. This is one exceptional item you need to remember. Then, new contract is entered in case of extension or cancellation in delivery. So, new contract is in case of extension and cancellation, extension or delivery. If it is cancellation, there is no new contract. So, wherever there is extension, there is a new contract. Please note, there is always a new contract wherever there is an extension. Wherever there is an extension, there is new contract. And please I also told you, no profit share on exchange gain loss if you are a bad person. Bad person means after due date. And no interest for any transaction that is done on due date. Interest is there only for early action. Okay, interest is there for late action, but on due date there is no interest. That's it. Yeah, there are some more small points we will see. FEDI guidelines on rounding of 0.0025 rupees. Okay, 0.0025. So, every every quarter paisa. What is this? This is every quarter paisa. Over and above normal exchange margin, whenever interbank rates are given and bank has to enter into one-sided transaction due to cancellation request from customer, exchange margin will be applicable. It will be on the last cancellation by the bank. This is one more additional point that you need to remember. Whenever interbank rates are given and bank has to enter into one-sided transaction. What is one-sided transaction? You are cancelling or you are doing something due to cancellation request from customer, exchange margin will be applicable. So, the rates that they give you in the question, typically all exchange, they are post-exchange margins, which is for what? The original transaction. I am referring to the original transaction. Usually, the rates they give you in the exam are after all exchange margins. However, when there is a one-sided cancellation due to or when the bank has to enter into a one-sided transaction due to cancellation by the customer, the last cancellation by the bank on the last cancellation by the bank, there will be a exchange margin, you have to compute it. So what are the exceptions? Let us see. I will delete all of this. So we discussed 12 things. Early action, on due date, up to 3 days after due date, this is current rule, and beyond 3 days. Early action, if, and best part is on due date, there is no impact. Okay, if you make this table, life is simple. On due date, there is no impact. For early action, it is only swap, and early action, early delivery, it is only swap plus interest. Early action cancellation, you only have cancellation gain loss. Early action extension, you have cancellation gain loss plus new contract, because you're extending now, so it's a new contract. So for all extensions, there is a new contract. Okay, for all cancellations, there is cancellation gain loss. Then on due date, obviously if you take delivery, there is no impact. On due date, if you cancel, there is only exchange difference or cancellation gain loss. And if you are extending on that date, cancellation gain loss plus new contract. And please note, on due date, any transaction, there is no interest. Now, if it is late, that is up to 3 days, up to maturity plus 3 days, if you were to take delivery, you will have cancellation gain loss, interest plus swap plus new spot. That is the day on which you are entering in, you are asking for delivery, that day spot you have to pay. Whereas if you are cancelling, that is then there is absolutely no spot that you have to pay because you are cancelling. Whereas if you are entering into new contract, cancellation gain loss plus interest plus swap plus new forward rate you have to pay. New forward rate. And finally, if you come back after 3 days, or you are within these 3 days, no profit share for you. This cancellation gain loss, the bank has a right to say, I will not give you profit, but I will collect from you losses. And if it is beyond 3 days, it is simply, no matter what you do, you come back and say the automatic cancellation, that is exchange gain loss plus interest plus swap. Okay. So now I have given you a brief of everything. I know that you will not be able to understand the brief of whatever I have discussed. Let us go and look at a problem, and in that problem we will make some changes to understand all the scenarios, and then I am pretty sure you understand everything. Let us go and look at a problem. What is the problem that we chose? I think we chose problem number 87. Okay, 87. What is 87? So let us look at question number 87. This is 87. Where is this 87? 87 is in my P600 plus. Okay. On 10th July, an importer entered into a forward contract with bank for US dollars 50,000 due on 10th September at an exchange rate of rupees 66.84. So this 66.4 is a net rate. There is no exchange margin that is to be added or subtracted here. When you go through the problem, you'll understand. The bank has covered its position in the interbank market at 66.68. So they agree to deliver, right? Importer has to pay dollars to their suppliers. So bank will have to sell the importer dollars. So bank is selling dollars at 66.84, but bank is buying dollars at 66.68. See how much margin they have. How the bank would react if the customer requested on 12th September. Now here I put 12th September now, but in this particular problem we will solve it in multiple varieties. First we will take 12th August. Okay, first we will take 12th August. Then we will take 10th September, then we will take 12th September. Okay, we will take these 3 scenarios and solve all of them, all the multiple case, and anything after 12th September, let's say 13th September. So 4th scenario also we will take. What are the things? Cancel, execute or extend. Cancel, execute or extend. So, and I will take the same rates. Okay, please don't, shall I take the same rates? No, I will take different rates, otherwise you guys will get confused. So let me take different rates. Now on 12th August, how would the bank react if the customer requested on 12th August to cancel the contract, execute the contract or extend the contract with the due date to fall on 10th November. Okay, so exchange rates for US dollar and interbank market were as below. 10th September, $1 is on that day, this is the spot. 12th September, this is the spot. Now spot over September, this basically means on 10th September, what is the contract or value of a forward contract for month end. So on 10th September contract is 66.28 by 32. On 12th September rates have changed. For month end contract is 66.12 by 18. Same way for month end of October on 10th September this is the rate for on 12th September. And for November end due dates these are the rates on 10th September and 12th of September. Exchange margin was 0.1% on buying and selling. Interest on outlay of funds is 12%. You're required to show the calculation to cancel the contract, execute the contract, and extend the contract as above. So we will look at all three scenarios. We will look at all three scenarios of cancellation, extension, and delivery, and all four scenarios of when they can potentially come. Right. So what I will do is, I will actually make that table here. So here I will say, we said no, 12th August, 10th September, then 12th September, then 13th September, then delivery, cancel, extend. Correct? We have all these three scenarios, and the best, what was the contract due date for? Due on 10th September. So they entered on 10th July, 10/7 they entered for delivery on 10/9. So on this date, no, on this date nothing will happen. If they are taking delivery on due date, you are a good boy. Good boy, no charges, nothing, everything will be normal. Okay. So on this rate, what is the contract? The contract is at what rate? 66.84. So on this rate, 66.84. So you can ready-made fill everything. Okay. Then as we solve each of these varieties, we will come and fill up the numbers here. Okay. Now let us see. First is early action. See, in the question they have said you come back on 12th September. But I am changing the question to say, if you come back on 12th August, what will happen, or 10th August, let us take 10th August. No, if you come back on 10th, I will change this to 10th. You come back 1 month before, you come back on the due date, you come back within 3 days after the due date, you come back on 4th day after due date, what will happen? This I will take it as 14th, okay, 14th September, not even 13th, 14th, so that there is no confusion. Right, so this also I will change as 14th. And this I will change as 10th. You come back on 10th, which is 1 month before. You come back on the due date, which is 10th September. You come on within 3 days of September 10th, which is on 12th September. Then you come back on 14th of September, which is 3 days after the due date. Which is after 3 days after the due date. Okay. So early action, 10th August. Now 10th August, if in case of early action, what will happen if you were to extend? If you are extending, there is a new contract. Okay, there is, if you are cancelling, there is exchange gain loss. If you are extending, also exchange gain loss. If you are taking delivery, it is swap plus interest. Correct? That is what we read. I will show you if you want. See here, it is swap plus interest, exchange gain loss plus new contract. These are the three things if it is early action. Let us go back. Early action on 10th August. Now, what are the rates on 10th August? They have not given the rates, so I will assume some rates. Okay, I will take these same numbers and I will assume a different set of rates. Let us look at the rates. So, 10th August, spot 65.15 by 17. I am just taking 1 rupee less. Okay, spot by September, 65.28 by 32, spot by October, 65.41 by 43, spot over November, 65.56 by 61. Okay, these are the rates on 10th August. Okay, I have taken same rates of what they have given for 10th September minus 1 rupee I have taken. Okay, on this date, if there is a delivery, then it is swap plus interest. Delivery, it is swap plus interest. Now let us understand what is this swap plus interest. Whenever you solve a fate of forward contract problem, please put it in 2 columnar format. It is easy. Customer, bank. First part. What happens in the first part? Original contract, 10/7. Customer agrees to, what was that? What was the question? Customer agrees to buy $50,000 on 10 September at 66.84. Customer agrees to buy $50K on 10/9 at 66.84, no, correct. So bank also on same date agrees to sell to customer $50K on 10/9 at 66.84, and this transaction is on which date? 10/7. On same 10/7, the bank also enters into back to back with interbank for 50K. Because the bank is selling to the customer, bank will have to buy from interbank. To buy at 66.68. So it is buying at a lower rate and selling off at a higher rate to you. So this is the original set of transactions. So every time when you solve this problem, you have to write like this, easiest way to remember. Okay. Then when does this fellow come? This customer comes on 10th August. So 10th August, and first I will do for delivery. First we will do for delivery. That is what we wrote now here. First is delivery, where there is swap plus interest. Asks for delivery on 10/8. On 10/8. So the bank is now forced to sell the dollars to this fellow at originally agreed rate. So gets $50K at original rate 66.84. Okay, first part is over, but there is a swap plus interest. Why is there a swap plus interest? Because bank is having to give him this dollars right away. Bank is having to give these dollars right away. So if bank is giving dollars right away, there is probably a potential for some kind of a loss that the bank has to incur. Let us see what that loss is. Okay, the swap funds, the funds which are supposed, which it was supposed to get early, pay early, or whatever is there, there is some swap of funds. That swap it is supposed to recover from that customer. Okay, swap gain or loss. It also has some funds flow. The funds flow, it is probably getting funds earlier. If it is getting funds earlier, it will probably pay interest. If it is getting funds late, it will ask for interest charges. So we will compute that. So these are the two things: swap plus interest. This bank will levy on the customer. Now what is this swap? Buy, sell, one should be forward, one should be spot. On the due date, the bank is delivering the original contract at 66.84. Okay. It is making delivery. Right. But what has happened to its B2B contract? Its B2B contract is still 66.68. It is agreed to buy at 66.68. Now, if it is buying on the due date from the interbank at 66.68, what will it do with that money? It can't do anything. It has to enter into a fresh forward to sell 50K on 10/9. Okay, at what rate? On that day, what are the rates? Let's take, this is 10th September rate. Okay, instead of spot over September, let's take spot over 10 September. On that day, it has to sell. When you sell, when the banker is selling, don't think of this banker as the main bank. This banker is now acting like a customer. Interbank is the main bank. Why? Bank has some dollars. It is going to interbank and selling off those dollars, right? So when it is selling off these dollars, it is acting like a customer. So for them, this bid rate will be applicable. What is the bid rate? 65.28. So you have to enter into a fresh forward contract to sell 50K on 10/9 at 65.28. Hurry, you have agreed to buy on some rate, sell on some rate. Gone. Right? There is a loss. We'll see. Okay. Now, what is the swap here? What do you mean by swap here? In this circumstances, the swap is one has to be a forward transaction, one has to be a spot transaction. Right? Where is the spot transaction here? You know where is the spot transaction? When the bank has delivered to the customer at 66.84, where did it get the dollars from? It never had dollars to begin with, because its dollars were going to come on 10 September. But the customer fellow has come and asked for dollars on 10th of August itself. So it has to now also buy same 10/8, buy dollars 50K in spot. What is the spot rate? And when they are buying, this is the rate that is applicable, ask rate 65.17. So they are forced to buy from market at 65.17. At 65.17. So the bank is now buying something in its spot at 65.17, giving off to this fellow at agreed rate of 66.84 and entering into a fresh forward contract to sell off the interbank dollars that is going to get on 10 September at 66.68. It is entering into a contract now to sell them same dollars 65.28. What is 66.68? It is the rate at which it entered into a contract on 10th of June or 10th of July. But on 10th of August, the rates for September 10th have fallen. September 10th rates are now 65.28. So it on 10th of September, it will buy as per the 10th July contract at 66.68 and sell as per the 10th August contract at 65.28. So it is incurring a loss. It is incurring a loss. How this loss is accounted for, we will see. So now, what is swap here? Swap is one buy, one sell, one forward, one spot. What is the forward contract here? Forward contract very clearly is this. Fresh forward at 50K at 65.25. So forward contract is sell at 65.28. If forward contract is to sell, then spot contract has to be buy. So these two are irrelevant. What is the buy contract? What is it purchased on spot? It has purchased 50K at 65.17. It has purchased today in the market at 65.17. So 65.17 is the relevant rate here. So the difference between these two, is swap gain or loss. Okay, one is a spot transaction, one is a forward transaction. The difference between those two is your gain or loss, swap gain or loss. So what are the swap charges here? Are the swap charges positive or negative? That is, will the customer have to pay the swap charges or the customer will get a reimbursement? Let us see. The bank is buying at spot at 65.17 and selling in forward at 65.28. So it is buying at a lower rate and selling at a higher rate. So what is the difference? 65.17 minus 65.28. It is 0.11 rupees. And this 11 rupees is basically a gain. Swap charges in this situation are a gain. Can there be a gain? Yes, of course there can be a gain. When if the movement of the currency is in a specific direction, it can be gain. If it is in another direction, it can be loss. So let us take this example. So instead of, let us say, spot being 65 and 10 September being also 65, let us assume the one of them is 67. That is, let's say the bank is forced to buy. Let's say the bank is forced to buy at 67 and sell at 65. Then what will happen? Correct? No, if it is forced to buy at 67 and sell at 65, then there will be a 2 rupees loss. So it can be a loss or profit depending on the exchange rate. So please don't take this scenario that it will always be loss or it will always be gain. It can be charges, can be positive or negative, both for swap, for interest rate, for exchange rate, cancellation, gain, loss. And please also note, we heard, or rather we read one more point, which is this. Interest is applicable wherever there is inflow and outflow. In case of post-maturity transaction, banks back-to-back rate will be considered. In other cases, back-to-back rate will be ignored. In case of early delivery, it is not considered. So what do they mean here is, when you are computing interest here, because it is delivery, early delivery, B2B rate is ignored. So if B2B rate is ignored, then how do you compute interest? Interest is on funds flow. Please note, what is the funds flow that is happening here? Please note, on 10/8 what happens? The banker has to honor his contract. So on 10/8 this other transaction also happens. Let me write here. 10/8 there is a third transaction also which happens. What is the transaction? Basically the delivery of this 50K. So this is an importer. Importers ask for early delivery, means importer wants the dollars earlier. If importer wants the dollars earlier, you purchase the dollars earlier. Right, you purchased the dollar earlier at 65.1 and you sold to customer at 66.84. Then you also entered into a fresh forward to sell same thing at 65.28 after 1 month. This is the contra of the B2B. That is where in the B2B you were going to buy something at 66.68. Okay, so please keep that aspect also in mind. Now, you are selling to the customer at 66.84. Okay. So, what is the funds flow? there is some sale happening. Where is the fund flow happening? When you have a buy and sell, not on forward but on spot basis. On spot, some transaction, some money is moving hands. So here you have sold at 66.84 and you have bought at 65.17. So let us see. Sold, that is 66.84, bought at 65.17. Now, both these transactions should have not have actually happened. This transaction should not have happened now. This transaction should have happened on 10th of September, not on 10th of August. So, between these two, there is a change. There is a funds that have flowed. What is the funds flow? If you have sold at 66.84, you are getting funds. If you have purchased at 65.17, you are paying out funds. In the spot market, when you purchase something, your rupee of money goes away, no? So here this is plus, this is minus. For what? For same $50K. So 66.84 minus 65.17 is 1.67. So rupees 1.67 into 50,000, you have got money early. You have purchased on the market at 65.17, sold it off to this fellow at 66.84. You have got this 1 rupee 67 early, into $50,000. So 50,000 into 1.67 is equal to 83,500 into what is the rate they have given? They have given some rate, no, 12% or something. Interest on outlay of funds is 12%, which is 83,500 into 12% for 1 month. Correct? You are taking delivery 1 month in advance. So 83,500 into 1%, that is 835. Now this 835 is gain or loss? This is interest gain. Why? Because bank is receiving the money early. So this also, this 11 paisa into 50,000 is also a gain for the customer, which is 5,500, and this 835 is also a gain for the customer, which is 835 plus 5,500 makes it 6,335. 6,335. Now let us see, let us go and fill this up. 6,335. 6,335 is customer gain, CG. Okay. These are the charges that a customer will receive. Why? Because he has agreed to purchase dollars at 66, but market has come down and is asked for a delivery on a much reduced date or a earlier date. There is some swap charges, there is some interest that is going to gain, which the bank will pass on to him. When will the bank not pass on? When any transaction happens after the due date, you come and do any harakiri, you say I want delivery now or something like that, then they will not pass off. Okay, this is the first aspect. Now we have looked at delivery. Next, now let us look at cancellation. What is cancellation? In case of cancellation, there is only one option, which is exchange gain loss. What is cancellation, exchange gain loss? Early cancellation at the same rate. So what is cancellation gain loss? Cancellation gain loss is the rate at which you agreed to buy versus the rate at which it is being cancelled. Okay, that is cancellation gain loss. Are there any specific requirements for cancellation gain loss? Cancellation gain loss is difference between the initial rate. It is the difference between initial rate and interbank rate entered into by the bank due to customer cancellation. So the rate at which the bank has to enter into interbank rate due to customer cancellation, that and interbank rate and initial rate. And please also note, over and above normal exchange margin, whenever interbank rates are given and bank has to enter into one-sided transaction due to cancellation request from customer, exchange margin will be applicable. It will be on the last cancellation by the bank. So in our case, interbank rate versus original rate. What is the original rate at which the customer agreed to buy here? 66.84. Correct, no? 66.84. So 66.84 is the rate at which customer agreed to buy. Original rate, customer to buy. 66.84. But what has happened because of this entire transaction? What is the interbank rate at which the bank is now forced to enter into a transaction? Please note, when we are talking about interbank rate here, please don't refer to the original interbank rate. Okay, what is happening here is, instead of delivering to the customer at 66.84, they are now having to enter into a contract at what rate? At 65.28, because that is the rate that now they are selling it in a forward date. So on the maturity date, I was supposed to sell to you at 65.84. But now on the same maturity date, I am being forced to sell at 65.28. So that is the cancellation gain loss. Now, this 65.28 is what rate? It is the rate on 10th rate applicable on 10th September. It is rate applicable on a forward contract entered into on 10th of August for delivery on 10th of September, where I am forced to enter into a new contract. Why am I forced to enter into a new contract? If there is an early cancellation, the customer is not asking for anything. He's not asking for any dollars. So the dollars is gone. He's neither giving me dollars or asking dollars. So the entire dollar question is gone. So I will write here, customer bank cancellation, early cancellation. Early cancellation, bank has to now whatever contract they have at 66.84, right? They cannot, they're supposed to buy something and sell it off to this fellow, but now they are not supposed to sell. So sell on 10/8, enter into forward for 10/9 to sell $50K at what is the applicable rate here? Same way we enter into a contract here, no? Fresh forward to sell 50K and 10/9 at 65.28, same thing will be applicable. Okay, so they are supposed to now sell it at 65. After 1 month, supposed to sell it off instead of selling it to the customer at 65.28, they have to now sell it in the market. Now, please note, when we looked at delivery, there was no concept of exchange gain loss or cancellation gain loss. But when we looked at concept of early cancellation, there is a concept of cancellation gain loss. And when there is a concept of cancellation gain loss, we read it also here. Where did we read? We read early cancellation. Bank will cancel the forward the opposite to the original contract date, matches with the original date, and the loss gain will be passed to the customer. And they said here, over and above normal exchange margin, whenever interbank rates are given, bank has to enter into one-sided transaction cancellation, exchange margin will be applicable. And difference between initial rate and interbank rate entered into due to customer cancellation is applicable. So, exchange margin is applicable and interbank rate. What is interbank rate here? Basically, the bank doing a transaction in the market is called interbank rate. In this circumstance, not the original interbank rate. Please don't get confused with it. So, you sell now, you are going to sell it in the market on in a forward contract at 65.28, but there is a margin of how much? Margin of 0.1%. No, that is what they gave in the question. So when you are selling, margin is deducted, less 0.1%. So 65.28 into 0.1% is minus 0.06528. Subtract those two, you get 65.21472. And here rounding off happens. Rounding off to 0.25 paisa. So it makes it 65 point. So last two here. So this 47 will become 50. 65.2150. Okay. So the rate applicable for cancellation, one leg is 65.2150. So you are now selling it at 65.2150 instead of selling to customer at 66.84. So the difference 66.84 minus 65.2150 is equal to 1.625. This is exchange gain or loss. And here it is loss very clearly, because the bank is selling agreeing to sell at a much lower rate than what was initially agreed. So exchange loss is 1.625 into 50,000 is rupees 81,250. Now, in case of early cancellation, the only charge that is applicable is exchange gain loss. So what is exchange gain loss here? 81,250. We'll go and fill it up. Okay. Now, if the customer says, now I want to extend the contract, not from 10th of September, I want to extend it, and extend it till when? Till it is valid till which date? It is valid till due on 10th of September. So on 10th August, he comes and says, I don't want the contract now for till 10th of September. I want it for 10th of October. And what are the rates for October? We already have this. I've already given you the details. For spot over October, that is 10th of October, it is 65.41 by 43. Now, whenever there is an extension from a early on an early date, what is the logic? Logic is exchange gain loss plus new contract. You see here, if there is an extension due to early action, it is cancellation plus new contract. So our cancellation gain loss will remain the same and the new contract is entered into. What is the new contract rate? I already have given the rates here. Where are the rates? Here, the applicable rate is this. For October, 65.41 by 43. On 10th of August, this is the rate. So the new contract, what is the contract here? The customer is willing to buy. If customer is buying, the bank has to sell. So the ask rate is relevant. So 65.43. So answer will be for extension, early extension. Customer has to pay exchange loss of 81,250 and new contract is at what rate? 65.43. This is the answer. So 81,250, 65.43. Let me fill this up. Okay, so this concludes first part. Now, in second part, on 10 September, if some activity happens, on 10 September, if any activity happens, first of all, there is no concept of interest. Okay, there is no concept of interest. And if it is delivery, then everything is super simple. You are delivering at 66.84. So there also no problem. So, and when does swap happen? When the bank has to do some plus or minus, there is a change in the dates or something like that, only then swap happens. So swap is also not there. What is there then? If it is cancellation, it is exchange loss. If it is extension, it is exchange loss plus new contract. Correct? That is what is there, no? Yes. In this, there is no impact. There is exchange loss with new contract. And there is no interest or there is no swap component when everything is done on due date. So we have to compute exchange gain loss on 10th of September. The goal here is to compute exchange gain loss on September 10th of September. So we have to compute that. Now let us see how we compute exchange gain loss. Please note, these are the rates on 10th August. So these are approximate rates I gave you. This is not there in the question. What is there in the question? The original question was, he came to you on 12th September. But I am now explaining to you, he came to you, let us say, on 10th September. That is the second scenario. First, I have finished the scenario number 1. This we have finished. Now I am coming to scenario number 2, which is 10th September. In the question, it is 12th September. That we will come again. But first, let us look at 10th September. On 10th September, if the customer comes to execute it, no problem. The customer comes to cancel, what will happen? And customer wants a extension. Let us take till 10th November. They have given till 10th November. We'll take those rates. Right. So for cancellation on that date, exchange gain loss. What is the exchange gain loss? Relevant stuff on that date. I'm cleaning this up just so that it is clear. On 10 September, if the customer is agreeing to buy from you at 66.84, but the customer is not willing to buy. The customer is not willing to buy. You are supposed to, you have to sell it off in the market. If you sell it off in the market on 10th September, you will sell it off at spot. If you are selling it off at spot, the banker is the customer now and banker is selling to interbank. So when banker is doing this, the bid rate will be applicable. The other party will buy from our bank at 66.15. So instead of selling at 66.84, now you are selling it in the interbank market 66.15. So there is an exchange gain loss. And even in this case of exchange gain loss, what did we say? Over and above normal exchange margin. Where was that written? Over and above normal exchange margin, whenever interbank rates are given, bank has to enter into one-sided transaction due to cancellation from customer, exchange margin will be applicable. So even in this, exchange margin is applicable. So what do you mean by exchange margin being applicable? Let us see. This is on due date. Delivery, no problem. Cancellation, exchange gain loss. What is exchange gain loss? Original, sell to customer at 66.84. Now, sell in spot. What rate? 65 point something, no? What is September correct? 66.15. Sell in spot 66.15. At 66.15 less margin. What is the margin? 0.1%. Because when you are acting as a when the bank is now on the customer side, that is bank is behaving like a customer and it is selling off an interbank, there is an exchange margin. So 66.15 into 0.1%. That is 66.15 minus 0.06615 minus equal to, that is 66.08385, and you round it off to 25, 0.25 paisa. So here 0.38 becomes 50. So 66.0850. Okay. So 66.84 was original sale price. Now you are selling in the market 66.0850, 66.0850 minus 66.84. That is 0.755 paisa loss into $50,000. The loss is 37,750. So the loss, exchange gain loss here is 37,750. I'll fill it up. In case of extension, then what happens? Same exchange gain loss and new contract. So 37,750. And what is a new contract? On this day, they want it for which date? They've requested for a new contract on 10th of November. So for 10th of November, what is the new contract? For 10th of November, the new contract is this. New contract to what? The importer will have to buy. If importer is buying, the rate is this. If importer is selling, the rate is this. So 66.61. 66.61. So this completes two parts, which is delivery, cancellation plus extension before due date, delivery, cancellation plus extension on due date. Now we are coming to the third part, which is delivery, cancellation plus extension within 3 days after the end of the due date. That is on 12th September. On 12th September, if the customer comes back, which is the exact question that you have given here. Now we have come to the main question, which is there in this problem. All other two scenarios we saw was what is not there in the problem. I created those scenarios so that you can understand. So on 12th September, they come to you and they come for delivery, cancellation or extension. Now, this is where the story gets very interesting. What is the interesting part of the story? So first, customer, bank, 10-7, agreed to buy $50,000 at 66.84. On 10-7, agreed to sell $50,000 at 66.84. Okay. Then 10-7 back to back, agreed to buy. This is on 10-9. On 10-9. Agree to buy in interbank on 10-9. $50,000 at 66.68. Correct? No? Those are the details, right? Yes, 0.84, 66.68, 10-7, 10-9. Okay. Now, on that date, if there is on 10-9, no action. Why? Because customer is not coming back. No action. So when customer is not coming back on 10-9, what is bank supposed to do? I told you there is something called optionally deliverable forward contract. So what you do is cancel the original contract. That is, you sell it off in the market, enter into optionally deliverable forward contract. Optionally deliverable forward contract. So when you mean, what do you mean by canceling the original? See, on this day, no action. When no action happens, the bank is forced on which date? On 10-9. On 10-9 itself, they are forced. They are forced to do something. What are they forced to do? They are supposed to liquidate that contract. What do you mean by liquidate that contract? So first part, that is, whatever they have agreed to buy from interbank at 66.68, they will honor it because interbank will have to honor. but they're not able to sell it to somebody at 66.84. So they will sell it off in the market. They will sell it off in the market on 10/9, sell 50K on 10/9 in market at what rate? What is the market spot rate? On that day, the market spot rate is 66.15. Okay, so they will sell it off in the market at 66.15. At 66.15. So this is the first transaction that is complete. Then enter into ODFC. What is ODFC? ODFC is entered for month-end rates. On which month-end? Which month-end? On 10/9, whatever is the month-end rate that is applicable. For that rate, you will buy. You will buy. Are you buying here? Is an importer. Importer is going to buy from you. So if you have to sell to the importer, if you have to sell to the importer, you need to have dollars. So you will buy dollars for month-end delivery to you. So what is the month-end rate? Month-end rate is on 10 September, the month-end rate is this for you to buy, and you will buy it at 66.3200. So you will buy it at 66.3250. You are also buying in the interbank market at 66 what is the rate? 32, no? I'm just looking here in the question so that, I need not keep swiping up and down, okay? At ODC at 66.32. This is what they will do. Now, they will do this for how long? They will do this for next 3-4 days. Okay, not 3 days, not 4 days, exactly 3 days. This ODFC is basically anytime they want, they can take delivery. Now, some of you may have a doubt. Sir, if this ODFC is entered into, why not they do all transaction ODFC whenever they do a customer transaction, any interbank transaction, any transaction, why don't they do it ODFC? No. ODFC, you are paying higher premium. Why you are paying higher premium? You are paying premium till month-end date, but you are going to take delivery any day. So you will never enter into ODFC contracts randomly. You will do ODFC contracts only where you have these, you are within these 3 days maturity. Okay, so you do this on 10th of September. Then come 12th September, our customer, okay, we have 3 scenarios. Let's say asks for delivery. If he asks for delivery, what will you do? What are the charges that are applicable? If the customer asks for delivery in this kind of a scenario, what are the charges applicable? If you recollect, exchange gain plus swap plus interest plus new spot. These are applicable. So these 3 charges are applicable. If the customer comes and asks you within 3 days after maturity, then for delivery. Now, what are the exchange gain, loss, swap, interest, and new spot? New spot is very simple. New spot is super simple. The customer wants on 12th, he is coming to you on 12th. On 12th, he wants some dollars. So you will give it to him at 65.99. So the customer will now have to buy at 65.99. And please note, for all these transactions where the customer is agreeing to buy at a different rate, or where the customer is entering into new rate, the margin will apply. So what is the margin? 0.1%. So at new spot, what is the new spot? 66 point, how much was it? 66.59, no? Sorry, 65.99. 65.9. Those are all similar. You have to be very careful in this. 65.99 plus 0.1%. Now, what is this 65.99 into 0.1? This 66.0560. That is 66.0560. You have to round it off to the nearest 25. So this comes to 66.0550. That is rounded off 66.0550. So this is the new contract. This completes the one part of it. Okay, but what about this exchange gain, loss, swap, and interest? Now we have to compute those. Those are the important things. So what is exchange gain loss? Exchange gain losses. Please remember, exchange gain losses. Whatever is the loss that is incurred by the bank due to cancellation. And loss also, we said something very, very specifically. The difference between the initial rate and the interbank rate entered into due to customer cancellation. So what is this exchange gain loss? It is the difference between initial rate and interbank rate. Now, initial rate, we know very clearly 66.84. This is the initial rate. What is this interbank rate? See, what happens is on 12th, when the customer comes for any action, delivery, extension, or cancellation, this ODFC, whatever was entered into, is reversed. So ODFC reversed. ODFC, optionally deliverable forward contract, is reversed. So what happens on this date? On this date, they have entered into an ODFC to buy dollars, 50K dollars, because it's an import transaction. Bank is buying an interbank at 66.32. Now what has to happen? This has to be sold off in the market. This has to be sold off in the market because this ODFC has to be cancelled. So on this day, what happens? On 12th, when the customer comes for asking for delivery, you have purchased from spot and given it off at 66.055. But you have an ODFC which is due for maturity on 13th because you entered into a contract on 10th, 11th, 12th, 13th. So on 13th, you are supposed to cancel. You will cancel it today itself. What was the original ODFC? ODFC, originally, you entered into to buy for any time till month end at 66.32. Now you are selling it off in the market at spot. What is the spot on this date? On this day, on 12th of September, the spot is 65.96 by 99. So you have agreed to buy at 32, but you are selling it off in spot on 12th. When you sell, you will get it at 65.96. Again, minus exchange margin. Please remember, 65.96. So you will sell it in spot at 65.96 minus exchange margin at 65.96 minus 0.1%. That will be 65.96 into 0.1% minus is equal to, and rounded off, will be 65.8950. Okay, minus 1%. After that, you round it off to the nearest 25th quarter paisa, you get 65.8590. So exchange gain loss is computed on this reversal rate and the original rate. What is the original rate? Original rate was 66.84. So this ODFC contract, you agree to buy, but when you reverse it, the ODFC you have sold. So originally you agreed to sell at 66.84, but you are selling at 65.8950. So the difference between these two, 65.8950 minus 66.84, that is 0.945. 0.945 is exchange loss into 50,000. Into 50,000, 47,250. This is the exchange gain loss. So you originally agreed to sell at this rate, but you have sold off in the market at this rate. So you are incurring a loss. Right. Now, this is exchange gain loss. What is swap? In case of a swap is there has to be a buy, there has to be a sell. One has to be a forward, one has to be a spot. Now, buy, sell, spot, forward. Let us see which is what transaction. Because of a customer cancellation, because of a customer initiated, or rather customer initiated late delivery, not even customer cancellation, because of a customer initiated late delivery, there has to be some kind of a forward contract and spot contract. What is the buy or sell? We don't know. Okay. What is the forward contract you went into? The optionally deliverable forward contract. Optionally deliverable forward contract. What is the optionally deliverable forward contract you entered into? You enter into optionally deliverable forward contract to buy, right, at 66.32. So forward 66.32 as buy. So meaning the other side has to be spot sell. What have you sold in spot? What is it that was there with you that you sold off in spot? You sold off in spot in market at 66.15. You sold off on 10th September. Whatever you were supposed to sell to the customer at 66.84, you sold off in spot. So the sold off in spot is 66.15. So you come here and sell it off at 66.15. Okay. You bought something at 66.32, sold off at 66.15. What have you made? You've made a loss of 17 paisa. Correct. Difference between those two. So 17 into 50,000. That is 8,500 swap loss. Okay, then interest. What is interest? Interest basically is with respect to cash flows. And interest also, we said something. Where is it? Interest is applicable whenever there is an inflow and outflow. In case of post-maturity transaction, please note, banks back-to-back transaction rate will be considered. In other cases, the rate will not be considered. In case of early delivery, interest is not computed. So interest, the second part is relevant. Banks back-to-back transaction rate will be considered. So what is original banks back-to-back transaction rate? They were supposed to buy at 66.68, if I'm not wrong. Yes, 66.68. This is the original transaction, because for that transaction, you have made a flow, right? That you have purchased from the bank, correct? You have purchased from interbank at 66.68. So from on that date, there's an outflow. When is there an inflow to you, or what is the inflow to you? We will see. Outflow 66.68 on 10/9. So there is an outflow there. Now, where is an inflow? Will you consider an inflow before 10th September? No. The inflow has to be between 10th September and 12th September. Correct? On the date on which the revised instruction is received. Now, where are inflows received here? There is one inflow here, sell 50K on 10/9 in market. Then there is ODFC reversal. That is, you agree to buy, you agree to sell it off. But ODFC reversal, there is a sell, but that rate has already been considered somewhere else. That has been considered for your exchange gain loss. So that rate will not be considered. What will be considered? What is the sell that is considered where there's an inflow? Is this, which is your 50K that you sold off in the market at 66.15. So the difference between the flows, inflow 66.15 on 10/9, right? What you sold off in the market, difference between those two, that is 53 paisa. On this, interest for how many days is computed? For 2 days. Because why 2 days? You came on 12th September, whereas initially it was supposed to be on 10th September. Correct? So into 50,000 into 2 by 365 into 12%. That comes to 0.53 into 50,000 into 2 by 365 into 12%. That comes to 17.42 rupees. So your swap is 8,500. Your interest is 17.42. Then you have this exchange gain loss. Exchange gain loss is 47,000. And your spot, new spot is also entered into. So let us add all these three. 47,250 plus 8,500 plus 17.42. Total is 55,767.42. 55,767. So total exchange gain loss plus swap plus interest. So when you ask for delivery, you have to pay 55,767.42 plus new spot. New spot on which date? 12th. What was the 12th new spot that we discussed? This is the rate. No, that's not the rate. This is the rate. 99 plus something. Where is the number? 66.055. 66.055. The new spot is 66.055 into 50,000. Okay, so the customer has to pay this 50,000 into 66.055 plus 55,767. If the customer asks for only cancellation, then this new spot will not be there. So the loss will be 55,767.42. That's all. In case of cancellation, because there is no delivery, no delivery related amount will be there. Only the cancellation gain loss plus swap plus interest will be there. And if it is case of extension, then it is same 55,767 plus new contract. What is new contract? New contract is for what date? 10th of November. What is 10th? On 12th November, what is 10th of November date? This is the rate. Will this rate of, so again have interbank margin? Yes, it will also have interbank margin. What is the rate here? The customer wants to buy. So 66.49. 6.49 into 0.1% plus is 66.5565. So it is above 65. So it will be 5575. 66.5575. Right. So it will be 66.5575. So this concludes the third part where the customer comes on 12th September, that is not more than 3 days after the maturity of the contract. Now, if the customer comes on 14th September, the customer comes on 14th September, then what will happen? See, when the customer comes on 14th September, exchange, see, first of all, there is no profit share. All contracts are automatically cancelled, everything closed, cleaned up. Okay, anything that he wants, delivery, there is no concept of cancellation. Okay, all cancellation losses will be to his account. There is no concept of extension, it is a new contract. There is no concept of delivery, it is a new contract. Okay, but what is the exchange gain loss on 14 September? For us to consider that 14 September, let us take, these are the rates on 14 September also. On 14 September also, same rates are applicable. Okay, let us assume for a moment. I know it is unreasonable, but let us assume on 14 September also, same rates, both on 12 September as well as 14 September or 13 September evening, because they are supposed to hold that OFDC till 13 September, right? End of the day, 13 September. So what will happen on that day is same logic. Whatever we have discussed for 12 September, same thing will happen. Where is that? We'll have this exchange gain loss, swap plus interest. And interest will be computed for 3 days. Swap will be computed the same way that we have computed. Exchange gain loss also is also computed the same way. But instead of taking the 12th September dates, you will take 13th day September evening dates, rates, not dates, rates. So what will be the exchange gain loss? Assume that the ODFC is reversed at the same rate. So your original buy, original sell, everything will be same. Your exchange gain loss will be the same value. Why is it will be the same value? Because I told you assume that 13th September also it is same rate. Why? What is the same rate? Your ODFC, you are reversing in the market at whatever is the current market rate. So that rate you will reverse, you will adjust for the margin and you will arrive at 47,250. So ODFC, if the rates are same, this will not change. Okay. Swap. Now, when you come to swap, so what is swap? Swap also same thing. There is no change. Your 66.32, whatever is the ODFC entering rate, 66.15 that at which you disposed of the original money that you, original dollars that you got in the interbank, both of them will be same. So this 8,500 also will not change. But what will change is interest. So in interest, you will not compute it for 2 days, but you will compute it for 3 days. Here also the rates will not change. Why? The original outflow is 66.68. You have sold it off and spot at 66.15. The difference is 0.53. On this 0.53, you will compute 0.53 into 50,000 into 3 by 365 into 12%. You'll get 26 rupees. So it will become 26 rupees. When 12th September, 13th September rates are same and the customer does not give any information about cancellation or delivery or anything. Even if they give the information, at the end of the day of 13th September, all those are ignored. At 4:30 p.m., which is the market ending time for foreign exchange, or 5 p.m., whatever it is, you compute this exchange gain loss, you compute the interest, you compute the swap and directly debit the customer's account. And here it is 26 rupees. So if this is 26 rupees, what will be the total? 8,500 plus 26 plus 47,250. So 55,776. So in this kind of scenario, $55,776, $55,776, $55,776. All three places, the loss is same. And if they want any new, and if they want extension or new contract, is completely new. They have to pay this entire amount and then only move forward. There is no concept of any extension or delivery. Everything is a new contract. So this is automatic. If you don't come back within 3 days, this is what is going to happen. I've assumed 13th evening or 14th morning. Both of them are same. Please assume it that way, because please don't go too technical. Exactly 13th evening, 5 o'clock, or 14th morning, 9 a.m. It doesn't work like that. Just 13th evening, 4:30 or 5 o'clock itself, everything will happen. Okay. So this is how, in a single example, I've tried to explain to you what happens if it is before due date, what happens if it is on due date, what happens if it is 3 days before, within the end of due date, what happens if it is 3 days after the end of due date. Okay, there are a bunch of problems. I have solved 7 or 8 problems in the classes. There are 7 or 8 problems available in P600 Plus also. You can go through them and then you can understand this. Before we wind up, I've actually gone through the last few exam papers also. based on those exam papers, there are 2-3 more problems I want to solve in addition to what we have solved so far. So after fate of forward contract, there are some, and these 3 are not part of these, 12, 13 varieties that we have seen so far. So these are not part of these 12 varieties that we have seen so far. So I would want to solve those 3 problems also and then move forward. Let us go and solve those 3 problems. Now we have understood fate of forwards. Let us move to the next 3. These are the last 3. With this, we will end the revision of Forex. These 3 questions have come in last 3-4 years exams, and these questions may have some twist or something unique which I would not have covered in the previous 15 questions. So I'm going to cover these 3 extra questions. These questions are, I think, question number 35, 43 and 66 from my P600 plus. So we'll go ahead and solve these questions, and then we'll call this entire revision session to then we'll conclude this entire revision session. Okay. First is this question number 35. Now this is a question where we are trying to compare whether what kind of foreign currency activity is better. That is, which kind of investment is better. That is, whether you have to invest in one kind of security or another kind of security. We'll see. As you read, you'll understand. This is from May 20, and I think a similar kind of question was also asked in May 23. Not same ditto, but something similar. I chose this question because this was slightly more complex than that May 23 question. Okay, because I wanted to solve those complex questions so that you are fully thorough. Now, let us read this question. The Treasury Desk of a global bank incorporated in UK wants to invest GBP 200 million on 1st Jan 2019. They want to invest, they are based out of UK, wants to invest 200 million GBP on 1st Jan for a period of 6 months. So, they have 6 months surplus. The equity trading desk in Japan. So, the same company has equity trading desk in Japan which wants to invest entire money in high dividend yielding Japanese securities that would earn a dividend income of 1182 JPY million. So, if you invest in high yielding dividend yielding securities, you would earn a dividend of 1182 million. The dividends are declared and paid on 29 June. So, this is on 1st Jan, 29 June means 6 months. Right. The dividends are declared and paid on 29 June, 1 day less than 6 months. Post dividend, the securities are expected to quote at a 2% discount. So, after the dividend is paid, the securities will quote at a 2% discount. The desk also plans to earn JPY 10 million on a stock borrow lending activity because of this investment. Stock borrowing and lending activity, if you remember in the derivatives chapter, I have told you, otherwise I will explain it to you in brief what it is. Let me finish the question. The securities are to be sold on 29 June with a T+1 settlement and the amount remitted back to the treasury in London. So, if the Japanese desk says, I will sell it off on 29, get the money on 30th and remit the money to you back on 30th. The fixed income desk of the US, so the same company has another desk, fixed income desk in US. It proposed to invest the amount in 6-month GSECs that provides a return of 5% per annum. So, other alternative available is 5% government securities, 6-month government securities. The exchange rates are as follows. On 1st Jan and on 30th June, GBP JPY, GBP USD, that is here what we are referring to is 1 GBP will give you 148 JPY and 1 GBP will give you 1.28 USD. As a treasurer, advise the bank on the best investment option. What would your decision be from a risk perspective? You may ignore taxation. So, what is the best investment and would that be the best investment even from a risk perspective? That is what you are supposed to evaluate. It's a fairly simple problem. It is not as complex as it is made to sound in this question. So, 2 things. I said I will explain to you what is this stock lending activity, and second thing is risk perspective, right? From a risk perspective, what is the way or where should we invest or how we should invest? Okay. So, what is stock lending? Stock lending is basically, let's say you own a stock. Okay. You have the stock and the stock is sitting idle in your books. You will earn whatever stock appreciation is there, the stock price goes up, you will earn money. Same way, if the stock price goes down, you will have unrealized losses, unrealized gains, unrealized losses. And if there are any dividends declared, you get the dividends. Now, instead of keeping the stock idle, there may be somebody else who may want to borrow the stock from you. So, they will borrow, and when they borrow, what are they going to use the stock for? When they borrow, typically people who borrow the stock sell the stock. That is, you are long, let us take you, then there is this person called B. You have some shares, okay, these shares. This borrow, and let us say the shares are quoted at 1000 rupees today. Now, this B, who is the borrower, believes that the price of the share should not be 1000, price should be only 800. So, this B wants to short. What do you mean by short? Selling is called shorting. If you don't have shares and then short, it's called short selling. Now, what do you do? Typically, if you believe that this price is to be not 1000 but it has to go up to 1200, you will buy the share and keep it. If you believe that the price should not be 1000 but has to be 800, if you have it, you will sell it. If you don't have it, you will borrow and sell it. So this B person will borrow from you and sell. Now, if they borrow and sell, it is your stock. You are still the owner. They have borrowed and sold it. How can they sell it? This is a mechanism which SEBI also allows, SEC also allows in US. So the borrower will sell it, and whenever you say, no, I want my stock back, the borrower is supposed to give it back to you. There are some rules and regulations against it. Let us ignore all of those for the moment. You will first lend the stock to the borrower will short the stock, borrower will get the money. That money, he will get the money is put in, some high yield, is put in high grade securities. So it is put in some government bonds or something, and it is kept as collateral. Okay. Whenever you want, let's say one day you come and say, I want my stock back. So this person is supposed to, either sell this collateral and buy the stock and give it to you or something like that. And because you are the owner, you are entitled to dividend. So whenever a dividend is declared, this borrower has to give you dividends also. And please note the keyword borrower. Because he is a borrower, what is the thing that he has to do? He also has to pay you interest. So a borrower of a security has to pay you interest, has to pay you all the dividends that are coming on the stock, and whenever you want the stock, they have to give it back. How is this interest determined? Different countries have different logics, something to repo rate and all of that, call money rate and all of that. That is not relevant for us to understand at this point. And what is the collateral? How is the collateral? All that is also irrelevant. But please understand, this is the process. Now, in our case, what are they saying? Japanese trading desk will buy some securities, then will lend those securities to somebody else, so that somebody else, let us say somebody else is called borrower. Japanese desk will lend the securities to the borrower will short, and the borrower basically will pay Japanese trading desk some interest, some dividends or whatever. Now what have they told here? In high dividend yielding stock, that dividend would earn a dividend income of so and so, and post dividend, the securities will quote at a discount, and the desk also plans to earn 10 million on borrowing lending activity. So see, I told you there is this dividend income that will accrue to the Japanese trading desk, 10 million, that which is the interest cost, that will accrue to the Japanese trading desk. But when after 6 months, when they are closing out the positions, that is, initially they had 2 million, when they sell off those 200 million on 180th day or 179th day in this case, then they will receive 2% less. So this is what you have to understand. So let us go and look at how we will solve this problem. Okay. Return to, what is the name of the company? Have they given any name? Global Bank. UK Bank on investing through Japan. Okay, first investment value, right, is how much, and see, please note there are currency conversions here, that is very important. Investment value GBP 200 million, okay, converted to, they have only one rate, right, yeah, 148.0002. equivalent JPY value at the rate 148.0002 is equal to 200 million into 148.0002 JPY per GBP. This is 200 million GBP. GBP cancel, you will get value in JPY. 200 into 148.0002. You get 296.00.04 million JPY. This is the investment made. Investment in, what is the kind of high yielding, what did they say? High dividend yielding Japanese securities. High dividend yielding JPY securities. Okay. 296.00.04. Then add dividend, add interest. What are dividend and interest? JPY 10 million is the interest and dividend of 1182 million. 1182 million, everything is in JPY million, and 10 million. So, closing investment value is this plus 1182 plus 10, 30792.04 million JPY. On sale of these investments, amount realized is 2% less. So, net amount is 98% of 30792.04. Now, it is realized at 2% less. So, do you multiply 98% into 30792.04? If you have made that, if you do that multiplication, you are absolutely wrong. Why? Because please note, they have very clearly said, what have they said? They have said the securities are expected to quote. It is not a reduction in the overall value of investment. Closing value of investment is this. On sale of this investment, amount realizes 2% less. So, this 98% is not on 30792. This 98% is on this 29600.04. So, if you have made this mistake, don't do that. So, the correct way to do it is 98% of 29600.04 plus 1182 plus 10. That will give you 0.98 into 29600.04 is equal to plus 1182 plus 10 is equal to 3020.0392. Okay. So, the net amount realized is this. Now, please note here there is a critical term that is used. What is a critical term? Securities are expected to quote at 2% discount. So, all of this is expected to happen in future. It is not already happened. It is not already done deal. It is expected. So, what you will do is, in order to log the expected profits or gains, you will also enter into a forward contract. For when? For 6 months later. Why 6 months later? Because you will sell the security on 29th of June what they gave, and with T+1 settlement you will remit the money back. So, this amount is remitted to UK on 36 at GBP JPY 150, right? GBP 150, correct, round figure 150, as per the forward contract entered into on 1/1 itself. Okay. So, amount of GBP realized is equal to 30200.0392 JPY million divided by 150. So, you will get 201.333,595 million GBP. This is the money that you got. Minus 200, that is, you got 1.333,595 million GBP return. We'll compute and see what percentage it works out to. Let us see. Divide by 200 is equal to into 2 is equal to into 100. Get 1.333595% per annum. This is the return in percentage. Now, we have to compare this against the second investment. What is option 2? Option 2 is invest in US G6 at what they said 5%, no? Yeah, 5%. Invest in US G6 at 5%. Now, 200 million GBP converted to USD on 1/1 is equal to what is the rate? At 1.28 USD per GBP. At the rate of 1.28 USD per GBP. So, 200 million GBP is equal to how many US dollars? Will it be more or will it be less? So, for per GBP you are getting 1.28 USD. So, it will be more. equal to 200 into 1.28, that is equal to 256 million USD. On this 256 million USD, add 5% interest for 6 months into 5% divided by 2, that will be 6.4 million plus 256. So, closing investment value is equal to 262.4 million US dollars. Convert to GBP based on forward rate entered on 1/1, that is at 1.333 something, no? 30331. So 262.4 divided by 1.30331. Okay, divided by 1.3. That is equal to 201.33352,771 million GBP. So net gain is equal to 201.33352,771 minus 200. That is equal to 1.33352,771 million. Okay, gain. Right, what was the gain in case of JPY investment? Gain, JPY USD. USD is 1.33352,771 million. And JPY was 1.333,595. So, if you see, if you round off both of them, 59466, in fact, I think that is what is the number, 5946. 594, how many? 3, 4, 5, 6, 7, 8. So, excess return in case of JPY is equal to A minus B, that is equal to 0.40. Four zeros, 6695 million. So if you multiply it by 6 zeros, which is basically a million, you will get 67 GBP higher return in case of JPY investment. See, on a 200 million pounds, 200 million pounds is what? 6 plus 2, 10, 6 plus 2 is 8 zeros. 2 8 zeros investment, you got 67 pounds extra. Purely from a arithmetic basis, purely from return basis, JPY investment may make sense. Why am I saying may? Because everything is expected. Makes sense. But from risk perspective, US G-Secs are far safer than JPY high dividend yielding stocks. And especially considering a paltry excess return of 67 GBP, the bank is better off investing in US G-Secs. Okay, so this is how you should solve this problem. Now in this, there was one point. Is there anything else they have asked? You may ignore taxation. Anyway, we have ignored taxation. Okay, and I told you, you cannot make this mistake of, you have to take here 29,600, you cannot take this total investment value including dividend and all of that. Okay, please be very careful on that. And yeah, so I think that that concludes this particular question. Let us move to the next one. What is the next one? Question number 43, which I told you. This is a question on, this is again a question, if I am not wrong, this is from November 19. It's a November 19 question, and this integrates your some elements of costing or SMPE with your some elements of costing with foreign exchange. It's an interesting question, simple question only. Let's not, there's again nothing complex, but just that, it is something weird and different, so I wanted to solve it. Okay, let's move forward. Following information relates to AKC Limited, which manufactures some parts of electronic device which are exported to USA, Japan and Europe on a 90-day credit terms. So the company is there in India. I guess it is India, right? AKC Limited, yeah, rupees, they've used rupees, so it is an Indian company exporting to USA, Japan and Europe on 90 days credit. Cost and sales information are given below. Variable cost is 225 rupees, 395 rupees and 510 rupees. So these costs, maybe are of a different products. Okay, don't think of that all of them are a same product. There are different parts of the electronic devices. Okay, and sale price is 650 yen, $10 and 12 euros. Okay, please don't think that all of them are same. Each one is different. Receipts that are due from sale in 90 days is 78 million yen, not 78, 7.8 million yen, $100,000, 95,000 euro, 95,920 euro. Forex information. Spot market, yen per dollar, US dollar per rupee, euro per rupee. Please note, yen per dollar is number of yen per dollar. US dollar per rupee is number of US dollar per rupee. Here it is not given in USD INR 85 or USD INR 90 or USD INR 80. It is not given that way. It is given as number of US dollars per rupee. So it is basically indirect quote, 1 by direct quote. Advise AKC Limited by calculating average contribution to sales ratio whether it should hedge its foreign currency or not. And what have they given? Spot, 3-month forward and 3-month spot. So what they are saying is today's spot is given. If today's spot is given, what is the point that they are trying to communicate here? They are saying if today's spot is given, is this relevant for us in any way? See, 3 months forward is if you hedge the forex risk, what will happen? 3 months spot is if you don't hedge the forex risk, what will happen? But then why is this today's spot given? Is it just a googly unnecessary information? I think it is unnecessary information only. I think it is unnecessary information only. It doesn't need to make any sense. But please note, advise that by calculating average contribution to sales ratio, whether you should hedge its foreign currency risk or not. So for all of these put together, that's why they said average contribution ratio. So that is for all 3 territories, geographies together, what is the average contribution ratio? Okay. Why are they saying together? Because you may say, hedge Japan, don't hedge US, hedge Euro, don't hedge US. Something like that you may end up saying. No, they're saying ignore all of that and compute the average contribution ratio if you hedge, if you don't hedge. Now, in this, what is the amount to be hedged? It is 78 million. Now, if it is 78 million, it is 78 million is receipts due. If 78 million is receipts due, what is contribution? Contribution is sales minus variable cost. Now, sale value is given in yen and dollars. Okay, variable cost is in rupee terms, but it is per unit. So, how will you compute the overall variable cost? Either you compute sales price per unit in rupee terms, or you compute, so you can do price and variable cost both per unit, yen and rupee, or total yen and rupee instead of per unit. Now you see here, they very clearly said the receipts due are 78 million yen after so many days. So, is spot rate anyway relevant here? See, if you wanted to compute per unit yen rate, so I will tell you, compute all the costs in yen. I will explain what I mean. See, you can say that this 225 is my variable cost in rupee terms. I will convert this rupee cost into yen cost by using what? This spot rate, and have all my costs in yen. Same way, anyway I have realizable price in yen. So per unit I have how much my contribution I am making, and I have total receipts of this much. So I divide this receipts by number of sale price, I will get units. So I will multiply the units with the yen. Okay, and then again that yen I will convert it into rupee using this either forward rate or spot rate. Is that the way? Or take rupee rates at rupee rates, yen rates at yen rates, and eventually convert the final receipts in yen terms. I am more likely inclined towards the second method. Why? Because I don't think the spot market rate is actually of any use. It is just given to confuse you. I will explain to you what I am saying. So let us take this case. What are the data that they have given? What is the data that they have given? Solution, receipts, due, JPY, USD, Euro. They have said 7.8 million, 102,300 and 95,920. Here, price per unit, what have they given? JPY 650, USD 10.23, Euro 11.99. Moment you look at this itself, you should get a hint. 10.23 and 102,300, they are perfectly divisible by each other. 102,300 divided by 10.23, you get 10,000 units. So, moment you look at these two, no, you should understand. Same way, 7.8 million divided by 650. How many units? 12,000 units. So, units cannot be odd numbers, so they have to be round numbers. Then 95,920 divided by 11.99 is equal to 8,000. See, pakka round numbers. Instead, if you thought, no, this JPY price per unit is there, then I have variable cost. What is variable cost? They have given some variable cost, no? INR 225, 395 and 510. I will convert this into JPY. This is wrong. Why? Because you see, this 225, at what rate will you convert? They have given bid and ask, both. How will you convert your expenditure in rupee into yen? Which rate will you use? You'll again use spot ka average. So, I think this spot is a general, red herring. It is not even to be bothered about. So, don't consider this, this exercise of converting rupee costs into foreign currency. Please, because it's an Indian company, think of it in India terms. And also, Indian company will compute its contribution margin in rupee terms. They will not compute it in foreign currency terms. So, when they compute it in rupee terms, you have to convert other currencies into our number, not our currency into other currencies. Okay. So, variable cost is this. Variable cost total, you multiply A into B, correct? 8,000 into 510 is 4.08 million. 10,000 into 395. 3.95 million. All of this is in rupees. Please note. 12,000 into 225. 2.7 million. Okay. This is your variable cost. Now, what is contribution? Contribution is equal to revenue minus variable cost. Now, what is revenue? Revenue we have here 7.8 million, 102,000 and 95,000. These are in their currency terms. So, you have to convert these. These you have to convert it into rupee terms. Okay. Revenue based on forward, revenue based on spot. Okay, what is revenue based on forward? I am using these rates. Spot is, I am using these rates. Now here, what do you use, bid or ask? This is the good point. Now in this case, in this entire question, no, again this is a very interesting part. That's why I chose this question, even though it's a sedimental question. You see, you are selling yen and receiving rupees. Okay, per yen, how many rupees is this? Per yen, 2.397 and 2.427. So, when you are selling yen and receiving rupees, the bank will give you lower rupees. So, the applicable rate will be this one. Or other way, banker bids to buy the base currency. What is base currency here? Here the exchange rate is INR JPY. That is for one INR, how many JPY? Here also INR USD, INR Euro. So, base currency is INR. So, the banker will bid to buy the base currency. Now, in this case, what is the bid-ask spread? What are the bid-ask quotes? 2.397 and 2.427. So, the banker will bid to buy INR, banker will ask to sell INR. In our case, what is he supposed to do? 7.8 million yen we have. So, we are selling him yen and we are buying rupee. So, banker is selling us rupee. So, the relevant quote is this. Also, please note, per rupee, how many yen will you get? Right? Per rupee, how many yen will you get? So, if you are giving yen, you will get lesser rupees. So, if you are giving yen, you will get lesser rupees. So, you will divide it by a higher number. So, that is why 2.427 is what is the relevant quote. 2.427. And in spot also same thing will happen. 2.459. Same thing for INR USD and INR Euro. 0.0216, 0.0216 and 0.02156 and 0.0178 and 0.0179. If you hedge it, if you don't hedge it. So, revenue INR, or rather money collected INR, collection INR. Here also I will not call it revenue, I will call it forward and spot. Okay, collection in INR. Collection in INR based on forward, based on spot. So, you just divide what? This 7.8 million number by this, either of these two numbers. 7.8 million, which currency? It is in yen. So, 7.8 million divided by 2.427. 427, yes. You get 3213844 and 2.42459, no? 459. 3172021. Okay, this many rupees is what you will get. Same way, what are these values? 102,300. 102,300 divided by 0.0216. You will get 4736,111.02156. 4744,898. Then third one what? 95,920. 95,920 divided by 0.0178. You will get 53,88,764 and 95,920 divided by 0.0179. 53,58,659. Okay, this is collection less variable cost. What is the variable cost? We have computed here 2.7, 3.95 and 4.05. 2.7 million, 3.95 million, all of this is in rupees only, and 4.08 million. So, contribution, forward and then spot. $3,213,844 minus 27 lakhs. 513,844 and 317,2021 minus 27 lakhs. 472021. Then 4736,111 minus 39,50,000. 786,111. 4744,898 minus 39,50,000. 794,898. Then 53,88,764 minus 4 lakh, it's 40,80,000. 40,80,000 is 130,8764. 53,58,659 minus 40,80,000. 12,78,659. So, contribution total forward spot 1278659 plus 794898 plus 1278659 plus 794898 plus 472021 is 2545578, and in the other cases 513844 plus 786111 plus 1308764 is equal to 2608719. This is contribution. What is revenue? Revenue is here. Revenue is summation of this and this. 3213844 plus 4736111 plus 5388764 is equal to 1333719 m plus 2608719 divided by memory recall is equal to contribution percentage is 19.55. Okay, then second one is 3172021 plus 4744898 plus 5358659 is equal to 13275578. I'll do m plus 2545578 divided by memory recall is equal to 19.17%. So, which has higher average contribution? Forward contract hedging gives higher average contribution. Okay, if you look at it also, you are in case of JPY and Euro, forward contracts gives better contribution, right? But in case of USD, spot is giving better contribution. So, forward contribution hedging gives highest average contribution of 19.55%. If individual product wise hedging is permitted, then USD exposure should not be hedged, but JPY and Euro sales should be hedged. Okay. Based on average contribution, 19.55 is the number, which is you are getting a better contribution if you do it on forward contract. That is the answer. But if at all they permit you to do individual product wise or geography wise hedging, then don't do it for USD, because on USD what is happening? On USD what is happening? You are getting better contribution if you hedge it, if you don't hedge it and if you leave it open and you collect your money on spot. Okay, fair enough. Now let us move to the next question, which is question number 66. This is regarding this LC. I want to explain the concept of LC and EEFC, which is why I want to do this problem. Okay, let us look at this. Mrs. Sky Products Limited of Mumbai, an exporter of seafoods, has submitted a 60-day bill for euro 5 million. No, 500,000. I'm sorry, 5 million, half a million, 500,000. Drawn under an irrevocable LC for negotiation. Now, this is the first term in this question. There are 5 or 6 terms, each of them is not been explained in the study material. I have explained them in the class, which is why I wanted to repeat here. The company has decided to keep 50% of the bill amount under EEFC. This is the second term. The rates for USD rupee dollar and USD euro in interbank market are quoted as follows. You have spot rate 1 month forward, 2 month forward, 3 month forward. Transit period is 20 days. This is the third term. Interest on post shipment rate is 8%. Post shipment rate, this is the fourth term. So, in this one question, I think this is Jan 21 question, they introduced 4 new terms. EEFC probably you guys would have known, but they made the life difficult for students. Okay, so which is why I wanted to solve this problem. Exchange margin is 0.1%, assume 365 days in a year, you are required to calculate what? Exchange rate quoted to the company, cash inflow to the company, interest amount to be paid to the bank by the company. Now, in this question, I also have a difference of opinion in the way in which the institute has solved and suggested answer. I will show you what they did and I will show you what I did also. I am telling you from my experience in practically having handled millions of dollars of LCs, in fact, billions of dollars of LCs. Okay, so first, what is an irrevocable LC? I have explained to you, or rather you know, LC is basically sort of a guarantee. It is issued between banks. So, if I am an exporter, you are an importer, you will give me an LC so that I can supply goods to you, so that I trust that letter of credit rather than trusting your words. Instead of giving you credit, without an LC, I will say, please route the documentation, let us do the shipment through an LC wherein your bank and my bank are involved, and your bank will ensure or guarantee that they will meet the payment as long as documents are in order as per the LC terms. So, that is what is an LC. Now, LCs are of two types, usance and sight. Usance means there is definitely a period. This period is usually 30 days or more, and typically it goes up to 180 days. Sight means pay within 20 or 25 days. Okay. So, as per FEDI rules for foreign LC, sight means 25 days. This 25 days actually refers to the transit period. So, it is the assumed transit period, it is not actual transit period. Within this period, goods are assumed to be received, and a site LC needs to be cleared within 25 days. Okay, it may be cleared before also, but on 25th day it should necessarily be cleared. If 25 days for foreign and 20 days for domestic. And if it's a usance LC, means the credit period, or rather the credit that the supplier is extending, is anywhere between 30 days to 180 days. So, by design, if it is a site LC, it is not a usance LC. If it is a usance LC, it is not a site LC. And brilliantly in our questions, they have given a 60-day bill, basically 60-day bill drawn under irrevocable. Irrevocable means it cannot be cancelled, LC. And they have also said transit period is 20 days. How does transit period matter? Transit period is relevant for a site LC. Ours is an usance LC. How is transit period relevant? So, this is where institute has goofed up anyway. Okay, so you should consider only 60 days as the credit. What they have done is they have considered 80 days as credit. Where have they considered? I will tell you, but this is wrong. I will show you what they have done also, because I don't want you guys to lose marks, because the way they operate is very different. Okay, that is first part. Then they have said post shipment credit. What is post shipment credit? Post shipment credit means when you as an exporter are exporting something, you will get money after 60 days in this case using an LC. So, you will say, go to the bank and say, dear bank, I have an LC against which I am going to get money after 60 days. Against this LC, please, and I have already shipped the goods, so please give me some money as borrowing. So, I want to borrow from you against the LC, against a shipment that I have made, for which the interest rate is 8%. So, if interest rate is 8%, on that 60-day period, for that 60-day period, I am getting a loan at 8%, and on the 60th day, as per the terms of the LC will be honored and the other party will send me money. With that money, I will repay the loan. That is what is post-shipment rate. There is something called pre-shipment rate also. When you get an order, you can actually show the order and take a loan. That same loan will be converted into post-shipment rate once you once you dispatch the goods. Okay. Here they are talking about post-shipment credit. Then what is the other term? EFC. EFC is nothing but you as an Indian company can maintain, and we all generally know that we maintain accounts in rupee terms. You can, if you are an exporter, you can maintain an EFC account also. So, the money that comes in, you need not convert it into rupee right away. You can keep some amount of money in an EFC account, and tomorrow use from the same EFC account, you can make remittance for your import transaction. So, that is an EFC account, exchange earners foreign currency account. In this entire question, what are they saying? Half the money is in EFC, half the money is received. And transit period is 20, interest is this many days, margin, exchange margin is 0.1%, assume 365 days, and you are required to calculate. So what they are basically saying is, you have done an export. Export value. How much? 500,000 euro. And what are the questions that they have asked? First question, exchange rate quoted to the company. What is exchange rate? What do you mean by exchange rate quoted to the company? Exchange rate quoted. See, they have given rupees per dollar, meaning USD INR, right? 67.81. Same way, USD per euro, that is Euro USD. That is, base currency here is USD, base currency here is Euro, right? And they have said what is the exchange rate quoted to the company. When they are asking exchange rate, they are asking you, you have exported in Euro terms, please tell us the exchange rate quoted for INR Euro. Here USD INR is there, Euro USD is there. So what is the exchange rate for Euro INR? See, they have given USD INR, they have given Euro USD, you need Euro INR. Basically, they have given INR per USD, correct? This is the base currency. USD per Euro. So, if you multiply these two rates, you will get USD will get cancel, INR per Euro you will get. And this is called Euro INR, where Euro is the base currency. Now, the point here, again here also there is an issue which I want to highlight. See, you are getting money in Euro. That Euro you need to sell and buy dollar, and that dollar you need to sell and buy INR, correct? That is what is the rate, right? Because you are an exporter, you are going to get the money in Euro terms. That is what they said. You have exported in 500,000 Euro. So when you sell Euro, you are buying dollar. So if you look at this, Euro USD quote, base currency is this. Banker bids to buy the base currency. Now you are selling of Euro, meaning they are buying Euro, meaning the bid rate here is relevant. Once you get the bid rate, you have USD. Basically, they are buying Euro and giving USD. Now, this USD, again you need to sell and get INR. Banker again bids to buy the base currency. What is the, in USD and in USD INR, what is the base currency? USD. So, banker will buy base currency of USD again at the bid rate. So, the relevant rates in both the cases are 6780 and 1.0775. But please note, these are spot rates. They are saying what you are going to receive the money after 60 days, and that 60 days we need to enter into a forward contract. So you need to add these forward points. So the relevant rate will be what? You have to add this bid to the forward bid points. So USD INR, Euro USD, spot is how much? Spot bid, we already discussed it is bid, it is not asked. So 67.80 and 1.0775, add forward points, bid 2 months, 0.21, 0.40. Now you see, I have taken 2 months. In the institute suggested answers, they have given 80 days. Why have they given, if they have given 80 days, why have they given 80 days? They have added 60 days of usance, or rather the bill tenure of 60 days plus 20 days of transit, and they have taken 80 days. So if you are given 80 days, if at all you are supposed to follow 80 days thing, you will get the money in 80 days, then you have to take a forward contract for 80 days. How will you take a forward contract for 80 days? See, you have been given a 2 months ka forward and 3 months ka forward points. You have to take a weighted average. So between 2 months and 3 months, you will get 2.5 months. So you basically have to take the difference between these two. The difference here is 11 paisa, 32 minus 21, 11 by 11. This 11 paisa is for 31 days between month 2 and month 3. They have not said how many days in a month. So you can take, let's say 30 days. So for 20 days, how much will it be? So by 3 into 2 you have to do. And add that to this 21 and 22. That is how that is called broken period forward date. Broken period forward rate. Okay, that is called broken period forward rate. That is how we used to compute. Now, not only they did not do that. They took 80 days, but then they said that, we will round it off to 60 days. Arey, aise thodi hota hai yaar. I mean, you do everything hodgepodge. Very unfortunate. Okay. Very, very unfortunate. But anyway, I am not going to do that. I am going to say that, it is 60 days because usance is 60. So your transit period is irrelevant. Then you get 68.01 and 1. This is 40, right? Or is it 0.40 cents? Huh? Please be careful. It is 0.20 cents. It is not 0.20 euro. It is 0.40 cents. See, when I looked at this number itself, I got it out. A cent is 1/100th of a dollar. So you have to add 0.0040. Please don't make the mistake of adding directly 0.4. That is a good twist in this. Okay, so you get 1.07 0.0775 plus 0.004, 0.0815. This is the rate. This is the rate. Please be very careful with this. See, what is happening here is you also have something called as margin. Margin is how much? 0.1%. No, it is not 0.01, it is 0.1%. Yeah, 0.1%. Now you see, there are two issues here. One is it is given in percentage. Typically it is given in paisa. When it is given in paisa, you typically add it towards the end, add or subtract. No? Please note, add or subtract towards the end. When is it added? When it is subtracted? When you are buying foreign currency, it is added for rupees. When you are selling foreign currency, it is subtracted from the rupees that you get. Okay. Now, if it is given in paisa, you typically do it in the end. But if it is given in percentage, whether you adjust margin here, that is A into 1 plus or minus 0.1% into B, or A into B into 1 plus or minus 0.01%, either way the answer is going to be the same. So now you see here, what is margin here? You are selling foreign currency. If you are selling foreign currency and you are going to get rupees, they will give you lesser rupees. So margin is deducted. So margin of 0.1% is deducted. If you make this mistake, you will not get marks. That is, if you don't write that this is deducted, instead you generally add in your hurry-burry, you add gone, marks gone. So 0.1%. So 68.01 into 0.1% is equal to 0. How much? 0.06801. So INR, USD INR post margin 68.01 minus 0.06801, that is equal to 67.94199 into Euro USD of 1.0815. You get 73.47926. We can take 93. We can round off. They have not said anything about round off, so we'll leave it at that. So what did I do? I multiplied this rate, then subtracted it and multiplied with euro. If instead of doing this, you directly take these two and multiply, which is 68.01 into 1.0815 is equal to, then I'll do m plus into 0.1% minus memory recall. I get the same answer. This is 73.47926. So 73.4793. So this is the exchange rate. This is the answer to the first question. What is the answer to the first question? Exchange rate quoted to the company. If at all they have given it in rupees instead of giving it in percentage, then you may choose to, in some cases I have seen the institute doing it directly at the first rupee leg itself. That is not market practice, but then institute is institute. What do I mean when I say at first rupee level? Like this only. Directly at the rupee quote itself, subtract the margin or add the margin. Then second question, what is it that they have asked in second question? Cash flow to the company. What is cash flow to the company? Cash flow to the company. 500,000 euro, of which 50% EEFC. Net amount received in euro is 250,000 into 73.4793 INR per euro. So euro gets cancelled. You get 18369815.55. So 1,83,69,815 rupees. So this is the net cash flow of the company in rupee terms, and in euro EFC 250k euro. Right. Then what is the third question? This is where again they have unnecessarily conflated it. Interest amount to be paid to the bank. When the company has shipped the goods, they are going to borrow. What are they going to borrow? They are going to borrow for an amount which they will repay using this particular bill. What have they said? They have said that 50% of the bill will go to EFC. So balance 50% only they will borrow. So amount borrowed is non-EEFC amount. That is equal to same what we computed here, which is 1,83,69,815.55. So here, please note, if you round off to 4793, you will get a slightly different number. If you round off to 4793, I think you will get a, I was noticing this, why was I getting, if 0.93, why was I getting a 0.55 ka number? 825, if you take a 4793 as a rounded off number. If you take that whatever I got earlier, 47926 or something, then you will not get a rounded off number. So I'm just correcting to that part. Okay, I was wondering why am I not getting a round number? Anyway, so this is the amount that you borrow, right? So on this 8% for 60 days. In ICA suggested answer, they have taken 80 days. Why? They have also included the transit period. You cannot take transit period because transit period is for not for use and sales, but for site sales. This is the use and sales, they themselves have said. So 8 period for 60 days is into 8% into 60 divided by 365. They very clearly said 365. That is equal to 241,575.78 is the interest. Now, if you take 8% for 80 days into 18 divided by 60, you will get 3,22,101. So, if you take for 60 days, the interest payable will be 2,41,000. If you take for 80 days, 3,22,000. They have given in suggested answers 3,22,000. I, however, believe this is correct. So this is a problem in which there are multiple complications, which is why I specifically wanted to do this problem for you guys. Okay, so this concludes our overall revision for Forex chapter, and as I said, we have solved how many? 15 plus 3 special, so I have solved 18 problems, and I think the total duration of this revision session will be roughly about 5 to 5.5 hours. If you go through this entire revision session and solve all these problems along with me, go through, and spend time on this, I am pretty sure as far as exam is concerned, your Forex chapter preparation will be 100% complete. Okay, fair enough. So please note, we have this P600 plus, the formula sheet plus the T380 plus, which is basically my theory compiler. Everything is given there in the description. Please have a look at it. Okay, and we are going to have more such revision sessions. They're already there, quite a few. Please share, like, subscribe, and comment on this so that more of your friends can get to know, and all of them can take advantage of the revision classes that we're providing. Okay, all the very best.